ASX 200, that's the Australian index, that's also trading in the red, and Shanghai is also trading with cuts of almost 1%. So overall, the cues in the Asian market are on the negative footing today. Nifty implied open, that is also indicating a red start for the Indian markets. Now it's down 85 points in as of now in terms of Nifty implied open. But that's what we're watching out for in terms of the indication from the Asian markets. But like I was mentioning, there's a lot that's happened on the global market front as well. And how is that going to be impacting our Indian markets is going to be important to watch out for, right? So we're going to be setting you up for trade, and we have our team of research joining in with us for just that. So before I go to them, let me set you all up for today's market action that we're keeping an eye out on. And like I was talking about, there's a lot of commentary that came in from Trump, right? So because of that, on Friday, what we saw, that US markets first saw a very sharp fall coming in, because what Trump said that yes, maybe that US-China trade war, that's back on the forefront. That is what we're keeping an eye out on. Then again, we got commentary coming in yesterday where Trump said that don't worry about China, it will all be fine. So again, what we're seeing now in terms of US market, the stock futures, that's a rebound coming in after that, after Friday's fall in terms of trading session. Now for Indian markets, FIIs were buyers for the fourth straight session even on Friday. So that is something exciting that we're keeping an eye out on. Is that going to be continuing this week as well? Will be key to watch out for. FIIs were buyers of 459 crores. DIs were buyers of around 1,700 crores on Friday. Now, other than that, cues that we're keeping an eye out on. We have CPI data that will be coming out today. Keep an eye out on that. Vodafone Idea, that should be the one on your radar as well, because Supreme Court is going to be hearing Vodafone Idea's AGR dues. So that is something that we'll see a reaction to. Other than that, earnings reaction, right? Today, we'll have Anand Rathi Wealth, HCL Tech, Just Dial, which will be reporting their numbers. And companies that reported their numbers over the weekend or post-market hours on Friday, Avenue, Supermart, Wari, Renewables, are some of the ones that we'll be keeping an eye out on in terms of reaction. Do not forget, in Friday's trading session, Nifty gained for the second consecutive day. It closed near the 25,300 mark. So keep an eye out on that. As of now, a dull start is what we're watching out for in terms of the Nifty implied open. Like I mentioned, it's down almost 85 points. So will be key to watch out for whether this actually comes back to the green side, given the change in stance of commentary from Trump and a lot of earnings that are coming in as well. But let's move on and talk about other individual stocks that are going to be in focus in today's trading session. We have Gaurav for that. Good morning, Gaurav.
Well, let's talk about Phoenix Mills, because the business update has come for second quarter. Retail consumption, that is up almost by 13%, while on the other hand, gross residential sales was at 139 crores. Other than that, Signature Global, here also we saw second quarter's update. It was a bit weak because pre-sales that declined almost by 28%, while area sold by the company declined almost by 44% on a year-on-year basis. Even collections remained flat, up just by 2% on a year-on-year basis. Wari Renewables came up with the results. Now, we saw net profit almost doubled, almost to around 116 crores, and at the same time, margins also expanded to 20% versus what it was at 13.6%. DMart, on the other hand, came with inline set of numbers, we could say, because net profit that increased just by 3.9%, while margins that declined almost by 30 basis points. Let's also talk about CAMS, because board has now approved stock split in the ratio of 1:5. Hindustan Construction, this company recently won an order worth 204 crores. Mahindra Lifespace, now two updates we have for the company. First is that company has acquired a land in Pune worth 3,500 crores, and they have also won a redevelopment project worth with a gross development value of more than 800 crores. Lastly, let's also not forget about Lupin, because US FDA concluded its inspection at one of the facilities in USA, and they concluded with one observation. And lastly, let's also talk about Axis Bank, because RBI has now issued a letter of caution, and this is because of the KYC norms. So definitely watching out on all these counters in a day ahead today.
Absolutely, Gaurav. Thank you so much for that. But what are we watching out for in the world of FNO today? Sudarshan is joining in with us for that. Good morning, Sudarshan.
Good morning, Vinny. So it was a week of short covering last week we have seen, but today it would be a test of water after the global cues that we are getting. It's largely it's a weak global cues after following Trump's tweets, then again tweets, and now today you are seeing all the Asian major indices are currently trading with cuts, and on the back of that, your GIFT Nifty is also indicating a start with cuts of almost 100 points. But if you take the cash flows on the both in the futures as well as in the cash market, FIs continue to be on the buy side. On Friday also, we have seen that FI is buying more than rupees 1,700 crore. Also in the index futures too, they have bought more than rupees 815 crore. They have reduced short positions by almost 4,700 contracts. Now their long exposure has seen a minor increase to 8%. But look at the options data. The major action on the call side was seen in 25,450 and 25,200. Both these call options have seen an increase in the open interest and also at the same time an increase in the premium. On the put side, 25,300 put has seen maximum addition followed by 25,250. So for support for Nifty remains around 25,150 to 25,200. Resistance would be 25,350 to 25,450. As far as Nifty Bank is concerned, support would be 56,200 and resistance would be 57,000. One stock that remains in the band is RBL Bank. One stock had entered into the band is Saman Capital, and some of the stocks that had seen fresh longs on in Friday's session were Divi's and Yes Bank, and one stock after earnings that has seen fresh short was Tata Elxsi.
Okay, so Darshan, thank you so much for that. We'll keep an eye out on those stocks in the world of F&O as well. Thanks for that. But on that note, we're going to actually slip into a very short break. Up next, we'll get you updates from the White House from over the weekend in our special segment, Trump Watch. Welcome back to Power Breakfast on CNBC-TV18. Now, getting you those latest updates related to Trump developments, we have Dia joining with us in a special segment, Trump Watch. Dia, over to you.
Starting off with a dramatic statement aboard Air Force One, U.S. President Trump declared that the war is over in Gaza. The announcement came as Trump departed on what he called a very special peace mission to Israel and Egypt. The visit follows a ceasefire and hostage release agreement between Israel and Hamas, one Trump described as fragile but holding. Officials say the U.S. president hopes to solidify peace terms during his high-stakes regional talks this week. With regard to U.S. and China, trade discussions are once again in focus. China has warned the U.S. to back off its threats of higher tariffs and urged renewed dialogue instead. Beijing's Commerce Ministry said it will not hesitate to retaliate if Washington persists with its new trade measures. In response, the U.S. has signaled a willingness to renew cooperation with China. Trump and Vice President J.D. Vance indicated that Washington is open to exploring a potential trade deal. Vance urged Beijing to choose the path of reason, while Trump struck a more conciliatory tone, saying the U.S. wants to help China, not hurt it. Meanwhile, remarks that could shape the war in Eastern Europe, Trump said he may consider arming Ukraine with long-range Tomahawk missiles, weapons capable of striking deep inside the Russian territory. But he added that he may first speak with Vladimir Putin in what he called an effort to end the war, not escalate it. Trump also added that he recently discussed advanced weaponry with Ukrainian President Zelensky over the weekend. And in New Delhi, a new reset in trade ties between India and the U.S. Newly appointed U.S. Ambassador Sergio Gore met PM Modi in his first official engagement since assuming office. The talks centered on trade, defense, and critical minerals, with both sides expressing optimism about deepening strategic and economic ties. That's all for today. Now back to you, Vinny.
Thank you so much for that, Dia. And talking about the U.S. markets, Wall Street ended with major cuts as Trump announced additional 100% tariff on China, saying that the country became very hostile with its restrictions on rare earth metals. We have CNBC's Bertha Coombs, who's getting us a wrap on what happened on Wall Street.
U.S. markets were down sharply across the major indexes in Friday trading, following social media posts from President Trump escalating the trade war with China. The Dow tumbling 879 points, the S&P 500 falling 183, and the tech-heavy Nasdaq slipping 820. Stocks fell sharply after the president posted on Truth Social Friday morning, escalating that trade war with China, the president threatening to slap a massive increase of tariffs on China over its policy limiting the exports of rare earth minerals, which are crucial components for everything from weapons, platforms to consumer electronics. President Trump accused Beijing of holding the world captive over the metals. However, rare earth stocks surged on that threat, with several of the major players up at least 10% during the session. The mass firing of federal workers has begun. The White House Budget Office saying Friday that the layoffs during the government shutdown have begun as the administration tries to put more pressure on Democratic lawmakers to end the impasse. The Budget Office said the reductions are, quote, substantial, but did not provide any more details. Several agencies across the federal government confirmed that layoff notices have gone out to thousands of employees.
Thanks so much for that. But let's talk about the U.S. stock futures. They rebounded from Friday's sell-off after President Donald Trump said trade relations with China will all be fine. The Dow futures are up over 0.8%, while the Nasdaq and S&P 500 futures rise well over 1% on the back of U.S. President's assurance coming in there. So surely will be interesting to watch out for where we are headed in terms of our trading session. But on that note, we're going to slip into a very short break. Up next, we'll get you the cues in the world of commodities. Stay tuned in for that. Welcome back to Power Breakfast on CNBC-TV18. Today also we have important earnings that are coming in. HCL Tech will be reporting their Q2 numbers. What is the expectation this time? We have Reema joining in with us to give us those details. Good morning, Reema.
Hi, good morning. So expect growth from HCL Tech this time. Dollar revenue growth seen up 1.8%. Constant currency revenue growth seen up 1.5% on a quarter-on-quarter basis. The company had indicated that growth will come back in Q2. So they've sort of signaled that the demand outlook is a lot more positive in Q2 given the healthy deal pipeline. There was strong demand seen in the BFSI vertical. Margins are also likely to see an uptick to 17.1%, and that will drive a bottom line jump of about 11-odd%. The margin will be driven by the INR tailwind, but what the street will track very closely will be any restructuring related impact. They had indicated that, but does that hurt? In terms of the full year guidance, the current guidance stands at 3 to 5%, likely to be maintained, and the EBIT margin guidance stands at 17 to 19%. Deal wins for the company are also likely to improve on a sequential basis because in the prior quarter, there were 2 deal wins which got deferred from Q1 to Q2. So last quarter was $1.8 billion. This quarter, analysts are working with $2 to $2.5 billion. So that's the broad expectations. But let's see if, but in the case of TCS, you remember they made some announcements about participating in the entire AI ecosystem, the data center place. So let's see whether we get some out of syllabus, statements from the company this time.
Absolutely, Reema. Thank you so much for that. We'll be keeping an eye out on any important statements that come in from the management. But on to some fresh developments now, and this is on the Tata Trust story. Sources close to the Tata Group tell us that Tata Trust is now divided on keeping Tata Sons private. Parikshit is joining in with us to give us more details on this front.
Tata Trust, which owns a 66% stake in Tata Sons, has long believed that Tata Sons should remain a privately owned entity. However, due to recent tensions among trustees of Tata Trust, there is now a feeling that perhaps it's better to get publicly listed. Sources close to the Tata Group have told CNBC-TV18 that some sections of the Tata trustees now believe that due to the rift between the trustees and also the removal of nominee director Vijay Singh, it is important to consider a public listing and also go by the RBI directors. This, they feel, is in the sake of transparency and public accountability. Sources are telling CNBC-TV18 that a section of the trustees actually agrees with the Shapoorji Pallonji Group's statement, which said that it is now important to call for the public listing of Tata Sons in light of the recent developments. Now, the Shapoorji Pallonji Group owns an 18% stake in Tata Sons. This issue was not taken up in the board meeting that took place on October 10. None of the contentious issues were taken up. But it is very important to remember that just a few months back, all trustees of the Tata Trust had unanimously passed a resolution that Tata Sons should remain private. Now, the Tata Trust seems to be divided over the issue, and some believe that it is very important to go by the RBI's mandate and regulatory framework as well. Let's see what happens in the days to come.
Okay, Parikshit, thank you so much for that. But we have Manisha now who's joining in with us to tell us what's happening in the world of commodities this morning. Good morning, Manisha. What are we keeping an eye out on? Gold, crude, silver? What's the key today?
Well, it all depends upon the U.S. president's statements. While we've seen a complete U-turn onto this one happening after threatening to impose an additional 100% tariffs on Chinese goods, he now says in a more conciliatory tone towards China that U.S. wants to help China and not hurt it. And this has led to most of these commodities really rebounding. So the crude oil prices, which fell 3 and 4% on Friday and hit a 5 and a 7-month lows for both the varieties, have seen nearly 2% of a gain coming in the Asian markets right now. The markets also will watch out for the ceasefire between Israel and Hamas, a third straight day on Sunday. So this could be yet another factor that could perhaps continue to put pressure on prices. We still are trading at below $60 a barrel for the WTI crude prices. The other thing to watch out for is copper. We saw 6% of decline on Friday. It's gained by more than 4% in Asian markets right now. Same is the case with gold and silver. Some bit of a buying coming back for both of these precious metals also. So you have silver trading above $50 an ounce and gold at $4,050 an ounce, not too far away from its all-time highs for both of these commodities here. Well, the strong physical demand in various countries, including India, delayed shipments, strong festival demand, very strong investment demand, premiums being traded in Indian markets, it's something that tells you the story clearly. And so gold and silver should be on your radar. Yet again, we are looking at very strong gains continuing in Asian markets right now.
Okay, Manisha, I beg your pardon. Thank you so much for that, Manisha. But let's move on now and a quick revisit on the US-China story. The Chinese ministry looks at a response to the fresh US tariffs as more of retaliation than an ambush. CNBC's Evelyn Cheng is joining in with us with a report on that.
What's unfolded over the weekend is this debate over was the latest Chinese actions, were they retaliation or escalation? And China, most recently from the Ministry of Commerce, is definitely trying to emphasize that it is not escalation, it is retaliation, primarily to some of the new U.S. rules that were announced in late September, just before China started its 8-day Golden Week holiday. But when we have the new kinds of negotiating tactics from U.S. President Donald Trump, I think there's more and more questions about what retaliation to that might exactly look like. Because the latest from China, especially in terms of rare earths, is really establishing a framework for China to have more control over the rare earths sector and build on its leverage that it has over the supply chain. One Chinese think tank expert who studies the U.S., he told me that one important point to note is that China is still trying to balance, they want to do business with companies they perceive as being friendly to China, but they also want to have the ability to restrict the flow of these key minerals or other sorts of inputs to these Chinese these companies that might not be as friendly to China. And so, it's interesting, we see the Vice Premier He Lifeng still playing up how they want to have more of this engagement for foreign companies and foreign investment. But again, this Chinese researchers emphasizing that China knows what's going up with the U.S.-China relations. A meeting maybe later this month between the presidents won't change anything, and it's just going to be much more back and forth from here.
Okay, and with that, we're absolutely out of time on this edition of Power Breakfast on CNBC TV18. As of now, Nifty implied open still indicating a red start for the Indian market, so keep an eye out on that. Up next, our Bazaar Morning Call to take you through all that action.
Brought to you by Candia, lifestyle jewelry from Kalyan Company.
Welspun and Adani. 100% owned by Vodafone Idea. 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 100% owned by Vodaf Every morning, the countdown begins for the markets with meticulous research and analysis designed to help you capitalize on the trading day. Beaming live from the CNBC-TV18 Motilal Oswal studio.
Good morning. You're with us here on a fresh new edition of Bazaar Morning Call. We are coming to you live from the CNBC-TV18 Motilal Oswal studios. It's a fresh new week and it's the week before, the happy festival of Diwali as well. So lots lined up in terms of interesting programming, content through the course of the next 5 trading sessions and beyond. I'm Prashant, with me, my colleagues Nigel and Reema is with us today. Guys, morning.
Hi, morning. Hi, good morning. I think this weekend was a reminder, I can't say a gentle reminder, but that the tariff risk is not dead, as of now. So Dow Futures is rebounded, but look at Asia, it's selling off fast and furious. So I think it promises to be a very interesting session.
Well, that's right. And we don't know whether taco is going to happen yet again, or this time he's going to stick to what he's saying, because there's been a lot of flip-flop just in the last 12 to 15 hours itself. So we'll have to see.
I know this morning I was thinking when I had to present it, I would go in the chronological order or go reverse order. So because both will work. But it's a lot of stuff to digest. And it's all kind of happened. The good thing, the silver lining in all of this is, as we if markets were trading the last 2 days, you'd know what to make of it. But as we come this morning, there is a little bit more clarity in terms of where this perhaps is going. So that's how I would look at it. Now, low volatility calm was broken by a tariff headline redux, right? I mean, markets were nice, absolutely oblivious of anything which was happening. Tariffs were ignored, what effective rate, etc. All that had kind of sort of faded into the background. And it was largely a very nice move, especially in the US markets and, of course, around the world. I mean, Europe was breaking out. Asia, of course, has done fantastically well, of course, with the exception of India. US-China clash at the forefront once again. So Trump basically said that he's going to impose new additional 100% tariffs on China with effect from 1st of November. He also basically said that critical exports of software, etc., are going to be banned. President Trump said this new 100% tariff, in addition to what is already there, is in response to China's rare earth restrictions. Now, China on Sunday, that is yesterday, put out a statement saying that its actions were in response to US's actions, which came a few days earlier. So, who started this entire thing? Both are saying, well, our action is response to your action. It's like chicken and egg. In any case, this morning, there seems to be a bit of walk back, a little bit of, sanity. So President Trump's post on Truth Social appears to kind of walk back on his threat of this 100% tariff. That's essentially the post that I want to highlight. And he says, don't worry about China. It will all be fine. Highly respected President Xi has just had a bad moment. He doesn't want depression for his country, and neither do I. The US wants to help China, not hurt it. President DJT. So, this looks like he's not really... the hope is that this is the first step in perhaps de-escalation with regards to this 100%. It's like... what was that tariff, right? 140%, doesn't matter, because at 100% no exports will happen. 140, 200, you can take it to 500, doesn't matter. And the additional new 100% tariffs are just disasters. So the hope is, with what we've seen with President Trump posting this morning, that perhaps he's appearing to walk back on his tariff threat. The one thing which I think is very clear, which Reem also highlighted, is that this tariff complacency was kind of exposed with Friday's sell-off. And the interesting thing is, and the complacency was there, right? The rare earth restrictions, China's rare earth restrictions came on the 9th of October. Markets didn't move. They just kind of ignored it. They only reacted when Trump reacted to China with his threat. And by the way, the markets reacted to the threat. The actual 100% announcement came after US markets shut. So this is the reaction to the threat. On Friday, sharp sell-off. S&P had its worst day since April. It was down 3%. Nasdaq was down 3.5%. Russell 2000 was down 3%. Wix, as I said, was very low volatility, nice trending higher market. It jumped 32%. So big one. You had oil prices which fell 4%. Yields sold off 10 basis points in the 10-year. Dollar index was down 0.6. The entire shebang. Basically, the entire macro complex reacting, moving in one way, like it used to around the Liberation Day, etc. But since then, you know, sort of it looked like the markets have kind of sort of moved on and put all this tariff, etc. behind. I think we perhaps this morning, with President Trump's not clarification, but essentially, you know, his outreach to China and saying, well, all will be fine, and you know, they don't want it, we don't want it. Perhaps implication being that something will be worked out. Perhaps start off on a slightly better note. Had this post not come this morning, I mean, I think perhaps the reaction would have been a little more sharp. So I'll just tie in the levels here. We've had a nice move on last Friday, the last trading session. The Nifty took out the earlier high of 25,220, which was the high which was made last week, the weekly high. The next stop, the next resistance in that sense is 25,652. So not in a hurry, some distance between where we left off and, of course, where this level is at. Support remains the same, 25,008. The Bank Nifty, it closed above the previous high, like the Nifty, of 56,502. The next stop is 58,163. Again, not nearby, but we've had a nice, decent run. And if the markets got to break out of this range, I mean, you know, the extension levels are higher for both the Nifty and the Nifty Bank, and the support at about 55,821. That's the levels as far as the Nifty and the Nifty Bank go. GIFT Nifty is, I think, indicating about a 100-odd point lower start, and we'll pick up from there. But as I said, with President Trump's post this morning, I think markets will be hoping that this means de-escalation and not further escalation. But how's the F&O positioning looking like? Nigel's walked across to the wall with exactly that. Nigel, over to you.
Well, you know, year to date or even in the past 1 year or so, India has underperformed. I think now the time has come probably that we could outperform from year on. And the reason I say that is that a few factors are moving in our favor with regard to liquidity, with regard to flows, and with regard to the other data points as well. So Brent crude prices moving down is good. Dollar index has cooled off a little bit, and the 10-year yields as well has cooled off. So the troika is well behaved, so to call it. But the bigger positive is with regard to what's going on the flows. The FIs, remember, they were net selling 2,500, 3,000 crores. That came down to a net sell number of around 1,500 crores. Then they were selling closer to 500 crores. And now that's done a U-turn. And now we have positive FI flows. And mind you, this is the fourth straight day that we have positive FI flows. So you like that, because remember, they have been underweight on the Indian markets and they have been selling all through the year itself. So the FI is turning a corner. We'll keep an eye out on that, whether or not that can hold, and it has more ground to go. The short positioning, that's something that we have been highlighting. And just in the last week, take a look at the shorts that have got covered. From close to around 2 lakh contracts, we're close to around 1.8 lakh contracts, which would effectively mean close to around 8% of their short positions have got covered out. But even after this sort of short covering, still they're aggressively net short, right? They have 1.8 lakh contracts on the short side. In percentage terms, that's close to around 92% of their positions are still on the short side. So the FI is buying in the cash market and in fact covering their shorts. That spells some good times and gives you some kind of cushion. Even on stock futures, if you look at it, earlier they were selling in cash and they were long on stock futures. Now it seems they seem to be reversing that arbitrage, because now they're buying in cash and there is some kind of covering that we have seen in in stock futures itself. So the bit of a short covering bounce did play out there. The FI as well on index options as well, as we've been seeing the last few trading sessions, they've started writing more puts than calls. And because of that, the PCR that had come down to around 0.85 middle of last week, that's moved back up to around 1.3. Because the put writers, they feel they're back in the game. Whether you're looking at the 25,200 put, 25,250 put, 25,300 put, all of them were fairly active. Now, if you want to look at a tighter range, last week's low becomes important, which is close to around 25,000 odd. So that's the reference point you have on the downside. You know, you'll want the Nifty to make a higher high. And the high that it made in Friday's trading session was 25,330 approximately. But if you're looking at a range, then the recent high at around 25,450, that becomes a level of resistance. So they're going to be important which side of the band we can break. Moving to stocks that I'm looking at, well, a couple of them will be in focus in today's trade. Sammaan Capital, that's back in the F&O band. The stock has been a bit of a range. Keep an eye out on that one. The other stock we look at is Tata Motors, because tomorrow is the record date, which effectively means today all the future contracts will expire today. So they're having an expiry for Tata Motors in the futures market. And if you want to play that demerger, well, today's the last day to buy it. And finally, since crude oil prices have cooled up, I'll keep an eye out on OMCs as well, whether or not there is some interest on these names. So those are the bunch of stocks that I'm looking at.
Thank you very much for that. We should pull up Asia once again. So despite the conciliatory tone coming in from Donald Trump, Asia started off the week on a shaky footing. Hang Seng is down 2.2%. The Taiwanese markets 2% now down on Hang Seng. Taiwanese markets 1.6. Shanghai has opened with a cut of more than 1%. The Dow futures, though, is still up nearly 400 points, but this follows a decline of 900 points almost in Friday's trades. So it's rebounding, the Dow futures, but not to the extent of the fall that we had on Friday. Let's get in. William Lee, Chief Economist and Executive Director at the Milken Institute now. He joins in. Thank you very much for joining in. You know, if you look at the chronology of events over the last 3 days, the first offensive, perhaps you could say, was from China, restricting the rare earth, then the retaliatory measure from Donald Trump imposing the tariff, and then again a softer tone. What do you think China's response is going to be? Will it signal escalation or de-escalation? And will the markets take the events of the last 48, 72 hours in its stride?
I think Prashant was really accurate when he said that there was complacency in the market, but he was wrong to say it was tariff complacency. I think it was China complacency. The markets have been buying into these little minor victories that have been achieved in Madrid and London, where a deal about TikTok was considered a major victory, when the real game was supposed to be about rare earth supply and sustaining that, having China open up its markets, allowing China to be really part of the negotiations, serious negotiations, as to where the future technology, future AI is going to be. Those are the serious negotiations that we were so-called given frameworks for, but no agreements. And I think the markets had taken those very, very complacently. And I think now the market is waking up and saying, hey, there is no agreement with China outside of maybe TikTok. And even there, the U.S. has agreed to allow its citizens to be addicted to a Chinese algorithm. So there again, I'm somewhat dismayed by how the Trump negotiators, Secretary Bessent and company, are taking these really small victories, what they call victories, and letting go the big picture.
William, just one thing though, right? The restrictions from China, morning, but you know they're not aimed at the U.S. in that sense. They're aimed at the U.S., but basically it hits everyone else as well. You know, so for example, the restriction on exports of equipment needed to manufacture batteries for electric cars. You know, as I understand it, it's actually pretty damaging for companies here in India as well. They're saying, well, we will license one off, but no one really expects those licenses to come or be approved. Your thoughts, William?
Precisely. I think China is trying to maintain its monopoly control over those new technologies that it worked so hard in the last 10 years to achieve a leading position in. This was all about Made in China 2025. These were exactly the strategies put in place 10 years ago by President Xi to say, we want to control the standard setting, the license giving of these new technologies. And that's exactly what's being done. And they're demonstrating they're serious about that. And that's why I said the negotiations should have really addressed that head on. Jensen Huang was pleading with everyone, saying, we've got to allow U.S. companies or somehow get U.S. companies present in the marketplace for selling AI technology. If we don't, China truly will carry out its Made in China 2025 policy and dominate the world, including in India.
All right. Hi, William. That's what I want to come back to India then. Where does this place India? You know, going that, Trump is going after China a little bit more now. Those markets have had a good run. For the Indian markets, we have been underperformers. Do you think there is a case that from here on, we could see some kind of an outperformance? The flows seem to be turning the corner with regard to the FIs. Domestic liquidity is good. And we've done quite a bit on ground with regard to the fiscal policy as well as on the monetary front. Your take?
India clearly has to get its own house in order. It has to put in place the infrastructure that's needed to advance the economy, especially in the high-tech areas. The supply chains have to be set in a way that's durable, but part of that requires the supply of materials that come directly from China. And there, I think President Modi is going to have a very tough game to play, which is to say he's got to cozy up to China and say, we're really your friends. And he's doing the same thing to Russia, and at the same time, not alienate U.S. and more importantly, U.S. investors that are so interested in investing in India. So India is in that middle position where it needs to secure its supply to ensure that it has a significant position in the production of new technologies, which require a lot of China inputs, but it also requires a lot of American and Western inputs as well. And that's the balancing game that I think is going to be the future for India and how it's going to be able to negotiate those tough currents.
William, any particular, any asset classes or commodities or anything in particular which you think see an outsized move from here? We've had many outsized moves. Gold, silver, Bitcoin, oils, of course, lately moved a little bit. What's your sense?
I've been a big champion of the new technologies, especially AI and its productivity enhancing properties. I think that's what's a part of the American exceptionalism story. And the U.S. economy in the future is highly dependent upon getting productivity gains in place from these technologies. But I think what we've seen so far in the reaction of the markets is that perhaps all this bubble talk might have some substance, because people are worried that the pricing of the AI technologies has gotten ahead of itself, because we haven't really seen the applications that are productivity enhancing. We see a lot of infrastructure being put in place, necessarily so, but we saw that game before with the internet, where cables were laid and not all of it was used until much lower prices occurred. So I think the real issue now is if we may see a significant move, but on the downside, because investors might pull back, given the catalyst that this China rare earth supply is giving it, to say, hey, we might as well take our profits and cut back on some of these multiples until we see some real improvements in the applications. And by the way, all the applications that we've seen so far, at least many of them, are coming right out of China. So that's why Jensen Huang's words of warning about we cannot abandon the Chinese marketplace, because the AI innovators, half the world's AI innovators and researchers are located in China. So that's why it's so important for American companies, technology selling companies, to be present in that Chinese market.
Thank you very much, William, for joining in. The high valuations in AI and tech perhaps had made the markets vulnerable for a pullback, and the tariff threat became the trigger. Thank you very much for joining in. Sharp sell-off seen in Wall Street on Friday. Let's tell you quickly what the interactions that we've lined up for you on our show today. So first up, 8:35, we've got Richard Ridoglia of Matrix Global, who will be joining in to discuss the key trends in precious metals. 9 a.m., Jiganshu Gore of Bernstein will talk about the demand trends in the retail space and Avenue Supermarts Q2 earnings. 9:20, Tahir Badshah of Invesco Mutual Fund will be a market master for the day. 9:35, Kunal Dhamesha of Macquarie Capital and Neeraj Sharma of OneSource Specialty Pharma will join in to discuss the opportunities for Indian pharma as the US Senate approves the Biosecure Act. And following that, Dharmesh Shah of JM Financial Institutional Securities will be chatting with us at 9:45 to talk about his expectations from the cement sector ahead of Q2 earnings. And in our special segment, it's the economy. Lata will chat with Rikin Shah of IIFL Capital on the banking sector outlook, post the RBI deregulation and expectations from the Q2 earnings.
Well, time to slip into a quick break. We've got a lot of stock-specific action to track for you on the other side. For the time being, I'll run you through the top 10 list. Phoenix Mills, Mahindra Life Space, Travel Food Services, Scams, Welspun Enterprises, all of them will be reacting to positive news flow. Add to the list, Adani Energy. On the flip side, Avenue Supermarts, Axis Bank, Signature Global and BLS International will be reacting to negative news flow. Take that break, come back. We get into further detail on all of these names.
Welcome back. Our research team is now standing by with CNBC-TV18's list of top stocks for the day. And first up, markets will react to Avenue Supermarts earnings. Mangalam, we already had the Q1 pre-quarter update. How did it fare versus that, and what's your own read?
Well, it was in line with the Q1 update, but importantly, the EBITDA was slightly softer than street expectations. So these numbers, while largely in line with muted expectations, will go down as a bit of a miss, largely because, the revenues, which grew by around 15.5%, offered not much in terms of same-store sales growth. The EBITDA actually grew by just 11%. There was a margin compression of about 30 basis points. And at the same time, the net profit, which was further impacted by higher depreciation and finance costs, grew just by 2.3%. The reason why the margins were lower was because the mix of foods in their overall sales increased from 56.5% to around 57%, and that's a lower margin business, whereas the non-foods and general merchandise business actually decreased in their overall contribution. And even if you look at DMart Ready, grew by just around 16% for a category that is growing extremely fast. The state would have liked this to grow a lot faster. The company is consolidating operations out here, and as a result of which, DMart Ready consolidation and expansion will be extremely crucial to track, along with the overall store expansion, whether that picks up or not. And finally, in the third quarter, this quarter as well, we saw some remnants of revenue coming off because of the price cuts in GST. We'll see a large part of that in the third quarter playing out as well. So that's something the street will be watching. I would go with a mild red on this because a large part of the reaction has already happened in the first quarter update. But now, after the results, there would be a mild red on DMart.
Okay, all right, Mangalam, thanks a lot for that. Well, let's hop across to Gaurav. He's tracking Axis Bank. Morning, Gaurav.
Well, good morning. A little sentimentally negative news for Axis Bank because now RBI's high level committee, they have issued letter of caution for the bank. They are also guiding the bank to ensure the strict compliance with the RBI's KYC norms. Now, upon this, bank has said that they have already initiated the corrective measures, and at the same time, they do not see any kind of material impact on financials, operations or other activities. But let's not forget that there are a few other things also to focus on Axis Bank. First is that the results are likely to come on 15th, and at the same time, when we have seen the growth rate, credit growth has been in a single digit for the last 3 consecutive quarters. In fact, even if we look at the price to book now, the valuation that also trades below the 3-year and a 5-year average, and that is something which is already being factored in. But at the same time, with this letter of caution from RBI, let's see how the impact is going to be on the stock price. Currently, we do not expect any kind of a major setback because there won't be any financial impact, material financial impact, but let's see how the stock reacts today.
Absolutely. Thanks very much for that, Gaurav. Sonal is here with more stocks with news flow. Sonal, good morning.
Good morning, Prashant. Some quarter 2 updates that have come by. Phoenix Mills, they saw consumption growth of 12% in the quarter gone by in their malls business. As far as the commercial office is concerned, they saw occupancy at around 76% in their 2 commercial assets, which compares with around 67% in March 2025. For their hospitality business, the occupancy was flat in St. Regis and their average room rate grew just 2%. They say quarter 1 did see some benefits which did not come by in quarter 2, but all eyes on quarter 3 because that's the consumption season and also GST cuts. So Phoenix will be in focus. For Signature Global, it was a weak set on a YY basis in terms of their business update. Pre-sales were down 28%, volumes were down 17%, but their collections went up by 2% on a YY basis. For Mahindra Lifespace, 2 updates that came by. One is that they have bought a land in Pune, 13.46 acres, and it is expected to yield a development potential of 3,500 crore rupees for the company. The second one is they have again won rights for a redevelopment project in Mumbai. This is in Malad, and they will be seeing a development potential of around 800 crore rupees here. So some real estate stocks will be in focus today.
Thank you very much for that. Let's get to Vinny now for some more stocks which are in the news.
Hi, good morning. So firstly, keeping an eye out on BLS International. Now, the Ministry of External Affairs has temporarily restricted the company from participating in Indian mission tenders for a period of 2 years. Now, Indian mission tenders contributes around 12% of the consolidated revenue of the company and 8% in terms of the EBITDA of the company. So there is some bit of that impact maybe we could see coming in the future. But the company has given a clarification saying that the current contracts which are there in this Indian mission tenders, that continues to be there. So they're not expecting much of a financial impact going forward. Obviously, in terms of just getting new orders, I think that just becomes a concern for the company. So keep an eye out on that. No impact on financials is what the company is highlighting. Travel food services, that is the one we'll keep an eye out on as well. We're expecting green here. The company's subsidiary has entered into a license agreement with Delhi International Airport. This is a license agreement for 3 years, and they will be operating around 14 food and beverages outlets over there. So keep an eye out on that. And lastly, CAMS, that's the one we should focus on, as the board has approved a subdivision of its existing shares into one share for into 5 equity shares is the split that is coming in there. So keep an eye out on that one. Green expected here as well.
Okay, all right. Thanks a lot for that, Vinny. Well, going across to Vivek, he's here to tell us about Welspun Enterprises and Adani Energy. Morning, Vivek.
Well, good morning. Welspun Enterprises will be in focus. The company says that there's a board meeting scheduled on October 15 to consider a fundraise. The fundraise could be via the issue of convertible equity shares, convertible equity warrants rather, and this will be done via preferential issue route. Along with that, the company says that post Q1, they have been declared as lowest bidders in 2 important projects. The first project is in Maharashtra, where the company is looking or is the lowest bidder for a construction of a 6-lane highway corridor. The total project cost is in excess of 7,300 crore, with the construction period expected at 4 years. Along with that, the company will also, a company along with its JV Malaysian partner, is the L1 in the construction of a new 910 million litres per day water treatment plant in Maharashtra. It's both a building EPC contract as well as an O&M contract for 15 years. The JV bid value, including GST, is little over 3,100 crore. So totally, the company has received orders worth over 10,000 crore in Q2. Now, along with that, keep an eye out for Adani Energy as well. The company has given a Q2 operational update. The company's transmission business added close to 190 kilometers of transmission lines. System availability healthy at 99.6%. Distribution business loss contracted to 4.36%. Collection efficiency in excess of 100%. And lastly, smart metering business. The revenue potential now stands at in excess of 2,300 crore, and the total order book now stands at 2.46 crore meters.
All right, Vivek, thanks very much. And Adani Energy Solutions, Welspun Enterprises are stocks in focus. Well, just a quick recap of things as far as the top 10 stocks are concerned. So stocks with positive news flow: Phoenix Mills, Mahindra Lifespace, Travel Food Services, CAMS, Welspun Enterprises, and Adani Energy. Stocks were on the negative side: Avenue Supermarts, Axis Bank, Signature Global, and BLS International. So that's the run-through of stocks. Let's get you the quick commodities check as well in terms of what's happening. Oil fell sharply, but I think everything is seeing a little bit of rebound across the board. Manisha is here with exactly that. Manisha, good morning.
Morning, and thank you for that, Prashant. Well, absolutely. How the way the other asset classes are behaving is exactly how we've seen in commodities as well. So after that very, very sharp decline that we saw on Friday and crude prices hitting 5 to 7 month lows for both the crude varieties, there is a 1 to 2% of gain as we're looking at right now. This is after the U.S. President Tata Trust return towards China, wanting to help China and not hurt it. That seems to be really turning it around. But it's a 1% of gain, and we still are trading below $60 a barrel for the WTI crude. This is because ceasefire between Israel and Hamas in Gaza enters 3rd day in Sunday, 4th day today. So that also is keeping the prices under check. So trading below 60 even at this point in time. What we have seen a smart rebound, though, is in copper prices. Fell 6% on Friday, is trading 4.5% higher in Asian markets right now. So almost getting back all that it lost in the previous week. What also has seen very smart gains has been the precious metal prices. So gold prices trading at $4,050 an ounce, not too far away from its all-time highs. Silver is also trading above $50 an ounce, not too far away from its all-time highs. Gold and silver trading firm as the dollar has declined, and as the U.S. government shutdown enters a 3rd week, we are looking at strong support continuing into this one.
Thank you very much for that. Let's get back to stock-specific action then, and for some brokerage calls for this morning. Sudarshan now joins in.
So first one is KFin Technologies. Citi has come out with a note. It has upgraded the stock to buy, and target is raised to rupees 1,215 per share. It says company is well positioned to benefit from robust mutual fund flows and also rise in international clients. Also, it will be aided by Ascent's global capabilities and near-term growth that we are seeing in primary markets. Unlike CAMS, KFin benefits from first, lower pressure of telescoping pricing, and second, higher share of smaller clientele. Company continues to augment its product capabilities, and that is driving revenue diversification, but overhang of promoter stake sale persists for KFin Technologies. Second was AU Small Finance Bank. Jefferies has come out with a note. It has initiated coverage with a buy call, and target is rupees 910 per share. It says it's an it's at an interesting juncture, and transition to universal bank can first lower funding costs, second, lift fees, and third, strengthen brand to aid growth. And profitability can improve from December 2025 with fall in deposit rates and credit costs. And over FY 25-28, Jefferies expects strong deposit growth, and that is going to aid credit growth to 22% CAGR, and expects ROA to rise to 1.7% by FY 27. Also, growth and profitability that Jefferies believes will aid valuation premium for AU Small Finance Bank.
All right, so thank you very much for that. So those are some brokerage calls as well, and more coming up a little later. We'll take a quick commercial break here. We'll talk about commodities, oil, copper, gold, silver. Richard Redoglia of Matrix Global will be with us to discuss key trends in exactly that. And of course, a special focus on oil, which Richard specializes in. Stay tuned, coming up.
Welcome back. You're tuned in to Bazaar Morning Call. Well, as promised, let's focus on the commodity market. We're now joined by Richard Redoglia, the CEO, Matrix Global, who joins us on the show. Hi, Richard. Always good to have you on the show. Thanks a lot for joining in. Well, the big story overnight is crude oil prices. They have slipped and moved to the lower end of the band. What's your reading of the situation currently? And do you expect crude oil prices to stabilize at these levels? Or do you think there is more downside in store?
Good morning. Thank you for having me. I think, as we've been talking about, I think I was on your show over the last 4 or 5 months. My sense is that the prices do exactly what they're doing. They're trending lower. The bounce we're seeing today, I think, is just that. It's a bounce. The market has found, I believe, we have too much crude in the world, and the supply-demand balance is in favor of the barrels or prices moving lower. So I tend to think that we're going to see this market down to around $55. It's been an area I've been looking for the last number of months. I think, as mentioned on your show a number of months ago during the first Iran crisis, that what that caused was a covering of all the shorts that were in the marketplace. Those shorts over time are starting to come back into place. And that's what we're seeing right now. The market is under pressure. The world is finding itself with too many barrels in place. There has been movement on the U.S. side as far as the threatening of tariffs. And I think there's something important to realize here. When you look at this threat by Trump as it relates to India, and I agree with India about their desire to buy cheap Russian oil. The question really becomes is, what is the effect on the U.S.? And really what we're starting to see is that the tariff threat is having less effect on U.S. prices. For if you increase tariffs in India, but particularly on China, what you find is there's going to be a slight price increase. But at the same time, if you see a 15 to 20% decrease in the price of crude oil, you see that offset. And so from a consumer perspective here in the U.S., when I go immediately to fill up my gas tank, I see a significant decrease in the cost of my oil. When will I see the increase in tariffs or the price on goods that I buy from different countries? And those costs are spread out over time. So I think what we're seeing is Trump is playing a proper game. He is doing exactly what he said he was going to do. He is using the tariff regime to direct economic policy, which is the first time in my life, which I think anybody's life has seen this type of approach. And his Secretary of Treasury, Bissett, is right on board with this strategy.
Richard, it may be a bit far-fetched, but if it plays out, Brent crude prices or crude heads down to levels of $55 per barrel, then perhaps would it make sense that, India reduces the purchases of Russian crude oil prices because now crude on the whole is so much cheaper? And that could help strike that deal between India and US?
That's yes and no. Again, we get down to the particulars of crude oil, because what is happening is Russian oil is being sold at a discount to Brent. So even most likely the Russian oil right now that India is buying is probably $55. So where it might be 61, 62, here I see 63, 67. I imagine Russian priced into India right now is probably around $57. Probably could even be a little bit less. And so remember, oil as it's priced is a function of a fungible market. And so the benefit of always buying cheaper oil, no matter what price it is always going to be a benefit. And because India is such an advanced refiner and is selling products outside of its own market, being able to buy Russian oil, even at $55, if that's where Brent is trading, they'll be buying Russian oil at $50. That gives them a competitive advantage against other exporters or consumers who are looking to buy oil, or in this case, products, right? Because crude is not really crude; it's just refined products. And so, not necessarily it would be the answer to your question, if that made sense to you.
Well, it did. Thank you very much for coming in this morning and chatting with us. Let's move on and invite Dharmesh Kant, Head of Research at Chola Securities. He joins us on the show. Dharmesh, the stock to watch will be Avenue Supermarts. On the top line, it's come largely in line with the pre-quarter update, but there is a decline in the operating margins by 30 basis points. Will that be a dampener?
Yeah, good morning, Rima. Definitely, yes. I mean, the numbers are very muted, and if I may say so, it's a dismal set of numbers by Avenue Supermarts. And this is a trend for the last 2 years. the numbers have been consistently declining from 25-30% kind of a growth to 15-10, and now 6-7. And this quarter they have posted around 3.8% kind of a PAT growth, which will not augur well with the kind of valuation they are setting on. And 5 cities, they have closed down stores. I mean, Amritsar, Chandigarh, Ghaziabad and all, the stores have been closing down and they are not finding traction in the non-food business. So that's a big worry. This is the place where others have been finding pretty traction and the attractive valuations are given to those kind of companies. So I think further stock price correction is likely on the cards, and maybe 10-15% from here on. In next one quarter, the stock price should correct. And then they have to do something out of the box to pull out of this, declining trend of growth, depleting operating margins. And I don't know how they are going to fix this up, but it's a sell from our end.
Okay. All right. Hi, Dharmesh. Good morning and good to see you, Ben. We've got initial numbers coming in from the tech space, TCS, Tata Elxsi as well that came out with the set of numbers today. We have HCL Tech as well. How are you all approaching tech and what do you like from the pack?
Yeah, good morning, Nigel. I mean, TCS numbers were like just run of the mill. Nothing new on that count. Tata Elxsi was a disappointment, definitely. The narrative has now changed from, normal, BFSI or other verticals of the software products which they were providing to AI-enabled products. So AI narrative is definitely in place. How much this catch up and how soon the catch up can happen and how it translates to better deal wins with a longer time horizon is yet to be seen. I think HCL Tech will also be more or less around the estimates of the numbers they are likely to report today. But I think it's more to do with a bottoms-up approach, and there we have come out with an initiating coverage on Orion Pro Solutions Limited. The company has seen a remarkable turnaround since 2022, post the change in the management at the top level. And this is one company which has consistently delivered 30% kind of a revenue and profitability growth with stable margins of 20 to 22%. And we had interacted with the management. They sounded very, positive on the run rate of 30% kind of a growth being maintained for next 2-3 years. And thereafter, they are more aggressive about the run rate on the growth types. So banking and transaction, which is 53% of the revenue, has been doing well. They have won an order from SBI, which opens the door for other, private and non-private banks and other NBFCs in place. Because once you get an order from SBI, it's easier to get your iCash Pro, that is the cash management product, to be enrolled to other banking systems. They have also bought REII, which is again artificial intelligence enabled. And what REII has done, it has enabled all their products with AI inbuilt. So that's doing good cash benefit for them. Data center is one play which they have been pretty aggressive about, and it's the architecture stack of the data center, where again we see a good traction going forward and open loop transit mobility. So we are penciling in a profitability of around 300 crores for FY27. And even if you value at 30 times PE multiple, so 1675 is the target price which I have come out with, where the PEG ratio is less than 1.
That's Orion Pro. Dharmesh, good morning. Thanks for joining us. So HCL Tech, which reports today, and we'll put out a preview as well, you think should be good? Should be better than expected?
Yeah, good morning, Prashant. I mean, HCL Tech has a habit of surprising straight. So the guidance is 3 to 5% for this FY26. So one has to see how the guidance pans out, whether they maintain this 3 to 5% or there's some tweaking out 20-25 basis point forward. And the deal wins, how they are going to report on that 2 counts. Margin, more or less, it will be around 17 to 19% kind of a trajectory. We don't expect that. I am very interested in looking at the body language and the commentary of the management, because that is what can, give reflective. Last 2 years, if you have noticed the body language of all IT companies, though they have said they are cautiously optimistic, but the body language was very weak. Even the TCS management, I found a very muted kind of a body language this time around. So let's see how HCL Tech does it. But structurally, we are not a buyer on large cap IT companies as yet.
If you can put these weekly charts up, right? The IT index last week was up 5%. That is the Nifty IT index. The capital markets index, lesser talked about, and we'll talk about this one with Dharmesh in just a bit after a break. The capital markets index was up 5%. BSE there was up 14%, by the way, for the week. Hospitals were a big buzzing area. The index was up 3% and the real estate space was up about 2.5% as well. So some of this we will get back with Dharmesh in just a bit. We have to take a break though. Some technical trading ideas for you as well. Sudarshan and Videsh should be with us in just a bit. Hormoz also joins us with some of the big volume movers from Friday and of course the action that we saw. Welcome back. There's 8 minutes to go for the pre-open session. Let's rewind the clock back to Friday and look at some of the big movers that we saw. and the price action, volume, delivery, stats, etc. as always. Hormuz is here with exactly that. Hormuz, over to you.
Good morning, Prashant. And there were lots of movers in the broader markets on Friday's session. And you start off with a name like South Indian Bank, and the Bank Nifty, of course, did really well in Friday's trade. Now, South Indian Bank has done well in the last 8 sessions, has gained in 7 of them. The stock was up 10% on Friday, as the biggest single-day gain since January of last year. And more than 11.5 crore shares were traded on Friday in comparison to a 20-day average of just 85 lakh shares. And out of those 11.5 crore shares, 4 crore were marked for delivery in comparison to a 20-day average of around about 50 lakh shares. So delivery-based buying seen in South Indian Bank. The stock is up 20% so far this month, making it the best month that the stock has had in this calendar year. Gokuldas Exports, we mentioned this on Closing Bell on Friday. The stock is gaining around about 8%, the biggest single-day gain since May. Volumes were the highest in over 2 months. 22 lakh shares were traded, 20-day average here being 4 lakh. And out of those 22, 8 of them were marked for delivery, a 20-day average here of close to 2 lakh. The stock is closed above its 50-day moving average at 753. The next level on the upside comes up the 100 DMA, which is around 839. Tata Communications was one outperformer on Friday among the Tata Group names, and in the broader markets in general. It was the 6th day of gains for the stock. That 10% gain was the biggest single-day advance since April of 2020. The intraday gains were even higher. The volumes of Friday were the sum total of the last 35 sessions put together. And you saw over 1.5 crore shares that were traded on Tata Communications compared to a 20-day average, which is just 2.5 lakh shares. And out of those 1.5 crore shares, 23.4 lakh shares were marked for delivery. Here too, the 20-day average is only 1.5 lakh. And lastly, Yes Bank, among the outperformers on Friday, has gained in 8 out of the last 9 trading sessions. The stock, 55 lakh shares were traded on Yes Bank, 20-day average of 9.5 lakh, and 19 of those were marked for delivery compared to a 20-day average of 4.5 lakh. The other good bit is the fact that the stock trades above the SMBC deal price, which was around 21.5 rupees a share.
Thank you very much for that. So for Tata Communication, the overall volumes went up by more than 50 times. But delivery as a percentage of the volume on Friday, when the stock surged 10%, was about 16%, whereas the 20-day average of the delivery percentage is in excess of 50%. Lots of action seen in Tatacom. Dharmesh, Tatacom got very excited, 10% up. TCS's data center play could potentially benefit the entire Tata ecosystem, but particularly Tata Communication for the data center to data center connectivity, perhaps monetization of real estate, if TCS decides to set up a data center in the land owned by Tata Communication. I mean, are we reading too much into this?
Yeah, difficult to say that, Rima, but logically it does fit the entire, synergies out there. And I think it's more of a pre-positioning with the Tata Communication, the type of build-up we have seen. So there's a scope headroom of the stock price to may go up even 20,000 or 2,100 is likely on the cards. And they also rolled out their 4G network, so on a pan-India basis. So that is also likely to benefit them on the revenue count. So net, I think it's difficult to, exactly guess what, but logically, all the points which you have highlighted does fit the bill.
Dharmesh, great chatting with you this Monday morning. Thank you very much for joining in. Get into break. On the other side, pre-opening rates. Brace yourself for some impact if Nifty is down 100-odd points. Also, we'll talk in detail about Avenue Supermart in the retail space. Jiganshu Gore of Bernstein will join in next.
Co-powered by SBI. Best है सबको पता है. Presented by Bank of Maharashtra. Ek Parivar, Ek Bank. Co-powered by National Stock Exchange. Soch kar, samajh kar, invest kar.
Welcome back. Let's get the Gift Nifty up for you on your screen. Perhaps there will be a break in the recent uptrend. In 6 out of the last trading sessions, markets were actually moving up, inching higher, except I think Wednesday of last week when we took a bit of a pause. And in the entire last week, the Nifty gained close to about 400 points, an up move of 1.6%. But this morning, there will be a bit of a break and we will head lower. So brace yourself for a downtick. That's the first stick on the Nifty. Not too bad. Gift Nifty was down 100 points. Nifty now down 30 odd points. But we'll wait for the rates to settle down. Sudarshan Sukhani is now joining in along with him, Mitesh Thakkar. Good morning, gentlemen. Good to see you this Monday morning. Sudarshan, let me start with you. What would the approach be if we do get a gap down?
Yeah, good morning. See, we are likely to get a gap down, and the approach is to hold on to your long positions. Do not add to any positions now because the markets are a little unsettled. But the trend is still up, and this gap down which we are seeing is likely to be a minor correction. At least that's what the indication is now. But we have to protect our trades, and on a closing basis, if the Nifty is closing below 25,100, exit your long positions. Until that doesn't happen, stay with what you have. Do not add.
Mitesh, would you concur that perhaps what we're seeing right now could be a minor correction and long positions should be held on to 25,100?
Good morning. So, my view was that primarily we'll head towards 25, 350, 400 zones. And that's where some important supply pivots exist. And once we cross that, then I think, we will see some kind of a strong continuation on the upside. Now, we hit 25, 330 and slightly tapered off. I would not even call this gap down as a correction. I would just call it a minor pullback. My sense is that the directional bias on indicators, averages, the chart setup remains on the positive side. So unless until we start, breaking below the levels of 25,000, 25,100 zone, I think every decline would be a buying opportunity. My sense is that we might not actually even get there. So I would maintain a very positive view on the index. But yes, I think tactically, a close about 25,400 would confirm strong momentum on the upside. So waiting for that, but the bias is definitely on the upside.
Okay, let's get to stocks then. Is it going to be all long positions, buy the dip? Sudarshan, your stock calls?
Almost, but not all. 361 is a buy with a stop under 1,050. Axis Bank is a buying opportunity with a stop under 1,160. My only intraday short, and that means I do have a short suggestion, is Jindal Steel, which has been suggesting a strong distribution. Look for a short sell intraday with a stop above 1,050, and finally a buy in ONGC with a stop under 230. Primarily, the bias is still on the long side.
Yeah, no, absolutely. Bias is on the long side. Mitesh, what about you? Individual trades?
On individual trades, I have a mix of buys and sells. On the buying side are two banking names. Bandhan Bank, which had a very strong price action on Friday. If you get it on a mild pullback, say a point lower, 168 is the area I would recommend to buy the stock. Keep a stop at 165, look for a first target of 175. Similarly, AU Bank is a buy around 760 with a stop at 749 for targets of 785. A couple of stocks which were looking slightly on the negative side on intraday charts where we have some sell signals is Ashok Leyland, which I would recommend selling with a stop at 139 for a mild target of 133, and ICICI General Insurance, ICICI GI, which is sell with a stop at 1880 for a target of 1820.
Thank you very much for that. If you list out the cues, the events to track for the day, one, we've got the India September CPI inflation print that will come out post-market hours. Then at 10 o'clock, you'll have the Tata Capital listing. It was a mega issue, 15,500 crore. Overall subscription was 1.95 times, but retail was a bit subdued, just 1.1 times. On the earnings front, HCL Tech, Just Dial, Anand Rathi Wealth. And on the Supreme Court side, the Vodafone Idea AGR hearing will be today at the Supreme Court. So Ashmit now joins in. So we'll talk more about the Supreme Court and why Vodafone Idea should be on your radar this morning.
Well, this is clearly a big talking point in the Supreme Court today. Vodafone Idea's application for relief is to be taken up. Mind you, they had begun by asking only for a recomputation of the AGR due. Subsequently, they amended their application and expanded the scope of relief they're seeking. They're now also seeking a waiver of the penalty interest and the penalty interest on penalty component. What is interesting, however, from this round of litigation is that the government is clearly batting from their side. The government made it clear that they are 49% stakeholders, they have skin in the game. The facts on the grounds have changed, and now they want some form of resolution, some solution from the apex court. What that solution looks like, well, we have to wait to hear from the government counsel on what a possible solution may be. We're yet to get more clarity on the way forward. Hopefully, at the hearing, the Supreme Court will begin to give a better picture of what the road ahead for Vodafone Idea looks like.
That's today. Well, do we know the time, Ashmit, this comes up?
Well, the hearing is scheduled in the first half. We can expect it roughly around 11:30. That's when I believe the case is likely to come up. But like in all things court-related, it is unpredictable. It is subject to a whole lot of factors such as availability of lawyers, when the case gets taken up. So various factors, but roughly expect around 11:30.
Got that. I mean, a lakh odd crores on market cap for Vodafone Idea, and government's government's got about 50,000 odd crores in terms of that market cap to in a way defend, right? And as Ashmit said, the stance seems to have changed, and the government keen intent on finding some sort of a resolution. Stocks on your screen in the pre-open session. Mangalam is here with just a look again at Avenue Supermarts and what's the bull case, what's the bear case. Mangalam, tell us.
Well, it's a stock which has always had divergent opinions, right? Some speak about the strength of the franchise, some speak against the valuation. So HSBC, for instance, has a reduced rating and they have a target price of 3,700 rupees. They're saying that even as gross margin decline stabilized this time around, the operating expenses actually elevated, which was contrary to the analysts made, and as a result of which EBITDA margins were lower and moderation in the like-for-like growth as well, along with the DMart Ready reducing their exposure to 5 cities, makes them reduce their view on the stock with a PE multiple of 60x because they believe that key concern remains moderation in like-for-like growth given competition. CLSA, on the other hand, despite these numbers, has a high conviction outperform rating with a target price of 6,300, which is among the highest target prices that we have in the stock, because they're saying that it was whether private label price deflation and lower sales density for new stores that led to a bit of a miss. But the company is on a growth path, and that's reflected in the employee costs growing 33%. And also, we saw, the expansion. Finance costs were higher because the company had taken a bridge loan to fund network expansion. And this, they believe, will be the next delta or growth trigger for DMart, which has accelerated store expansion. CapEx as well has been higher, 10% higher than what the company did same time last year, which was also a high base. So they're saying that the company is on a transition period right now. And the second half will see higher store rollouts.
All right, Mangalam, thanks a lot for that. Well, to discuss this and more, we're now joined by Jignanshu Gaur, who joins us on the show. Hi, Jignanshu. Good morning. Good to see you, Ben. I believe you're leaning towards the bullish side. Tell us the rationale. You believe that the company is in a transformational period right now. Tell us more.
Thank you. Thank you so much. It's always a pleasure to be here. I am on the bull side of the case, as we saw Mangalam say that the result had everything for everyone. My rationale is it is a transformational phase where they need to fight off the competition from quick commerce, which at 6.8% LFL is a decent job of their core business holding up well. Second, they've realized that F22, 23, 24 network growth was under what they should have done. And hence their overinvestment into employees, into new stores, is the transition phase that they are going through. If we see just on store growth, they have spent 3.5, almost 4,000 crores in the last 3 years. And the capex for H1 itself, again, was another 1,500, 1,600 crores. That bodes well for accelerated network expansion. I think the competition pressure will ease out as we move towards the next few quarters, and so will the cost pressure. Because and that's the reason for the bullishness for us.
Jignanshu, so according to you, what is the valuation now? Avenue Supermart is trading at 70, 75 forward. What's the number?
Yes. Yes, it's around 70, 75 forward. I think there is a difference in how people value it because there is almost a 10% delta on standalone versus consolidated. So the way I like to think of the valuation is you do it on standalone and then think of what valuation you want to give for DMart ready business.
So how do you justify a valuation of 70, 75 times? Because growth has been moderating. And plus, investors also have an option to play, say, an Eternal or Swiggy, where the growth rates are a lot higher.
Yes, so I think it's a choice that investors have of playing a business model which is solid, which has potential for growth, but hello.
Yes, we can hear you. Go ahead, Jignanshu.
Sorry. It's a solid business model which has potential for growth, and it's about replication, where the margin profile is at the bottom, versus a business where a lot of the expectations in the pricing are already built in. How do I justify valuations? Is imagining a scenario even in 2030. Do we expect the entire modern trade business to go out and everything be replaced by e-commerce, or do we feel that there is a space for modern trade as well? So I feel it's coexistence rather than a question of existence. So I think the growth, when the margin profile comes back and the operating leverage comes back, the PAT growth will exceed expectations, which is where our delta versus consensus numbers also exists. It's not on growth, not on valuations, it's on margins.
Okay, all right, Jignanshu, we appreciate you joining in and giving us your take on the sector. We look forward to having a longer chat with you, but we've taken your point on board that for Avenue Supermarts particularly, it's in a transformational phase and you continue to remain bullish on the stock.
He said margins will also, I think, have bottomed out.
Yes. All right, well, let's get in Sudarshan back on the show for his 9-10 call. Sudarshan?
Yeah, it's Axis Bank. Buy Axis Bank with a stop under 1160.
Okay, got that. Axis Bank is a stock that we're looking at. A bit of a negative news flow that came in, mild negative, but Sudarshan is sounding a little optimistic on the prospects there. Mitesh as well as with us. Mitesh, tell us, what is your 9-10 call?
I'll go with the buy on Bandhan Bank for targets of 175 and a stop below 165.
Okay, all right. Mitesh, I wanted your view since you're giving us Bandhan Bank. What about the Nifty Bank? That's got into a very, very good rhythm, right, in the last few trading sessions. And there were a lot of shorts in the system as well out there. So the levels on the Nifty Bank, just to revise?
So I think my belief is that this rally has, a chance of hitting the highest ever weekly closing of 57,440, maybe even surpassing it. But in the short term, with the Bank Nifty rallying from 54,350 to about 56,500, if there's a pullback, it could see the Bank Nifty test 56,000, but that would be a very, very good entry point for me.
By the way, the stock we could watch today is BLS International, because as Vinny was earlier pointing out, the company has been debarred by India's Ministry of External Affairs from participating in any future tenders or contracts related to Indian missions abroad for a period of 2 years. And this is effective immediately. And, it looks like it's going to be a slam dunk, 17% gone down. And lower for BLS International. And MEA's decision stems from unspecified complaints and legal proceedings involving visa applicants. The exact nature of the complaints has not been publicly disclosed. Existing contracts are unaffected. Remember that existing contracts are not affected, but the company cannot participate in future tenders related to Indian missions abroad for a period of 2 years. So that is quite a bit of a hit to the company's future growth potential, and the stock is taking a bit of a knock. But it's about 0.5% down now, Prashant, the Nifty and the Sensex in pre-open.
So not so bad, right?
100 points, right? 100 points.
So par for the course in that sense. Markets, of course, have come up very, very nicely to almost 25,300 kind of levels as of Friday's close. And we're giving back a little bit this morning. So we'll pick up from where, we kind of sort of left off, slightly lower, and then we'll start to spot individual stocks, etc. as well. BLS is one, and there are a bunch of others as well, which we want to highlight. Here's a quick recap of what we've put out in terms of news-related stocks, etc. from the morning. Avenue Supermarts will come up 1% lower. Phoenix Mills, the Signature Global, which is down about 0.5% as well. Welspun Enterprises, It's positive news in terms of orders. Adani Energy Solutions, Axis Bank is the other one. And of course, we highlighted BLS. CAMS, of course, is also about 1/3% higher. News related, not very much at all. And we'll see if, the other two areas do any better, which is IT and capital market names, right? 25,190 is where the Nifty is at, 25,200. So it's just a 0.25% cut. The Nifty Bank is down 0.17, so nothing at all. This is, routine kind of start to begin the session. Small cap index is up 0.75%. Or is it? No, it's down 0.4%. It's just opened up. And the mid-cap index will also come up. It's down about 1/3%. So it's, absolutely fine in terms of what the start looks like. Let's just look at what the Nifty heat map is looking like, how many stocks up and down, and then we'll move on from there. So just 10 names higher, and the rest of the 40-odd names are lower. Trent is on one end and Indigo is at the other end. Indigo is looking up. So 25,200 on the Nifty, which is, by the way, no longer last week's high, but the high which was taken out on Friday's session. So we are back there once again, guys.
Well, that's right. From the broader markets, you have BLS International, the stock that Rima just spoke about. That's the one that's taken a pounding. It's down close to around 15% now. So clearly the news flow negative, and the street is reacting out there. GK Energy, that's a newly listed company, came out with a set of numbers. On a low base, actually, the numbers look good. But that stock as well is getting sold in too. So just keep an eye out on that particular name. What else? In terms of the Nifty, we're down close to around 100 points. But one would say it's par for the course because, the GIFT Nifty was suggesting a 100-point downtick as well. The Nifty Bank is doing a relative outperformance yet again. Another stock from the broader markets, I think, that came out with a set of numbers is Affordable Robotic. That's up close to around 7%. Volume's not high at all, though. Only 35,000 shares traded so far. Dreamfolks, after coming down by close to around a fourth from the peak, that's popped up and trade. That's up close to around 7%. Moving on decent volumes as well. So that's another stock that you should keep an eye out on. Rima?
Okay, in the frontline pack, it's IT, which is a bit on the back foot. Remember, the Nifty IT index was up close to about 5% last week. It retraced, or it was flattish on Friday, and today it's down nearly 1%. Infosys, HCL Tech, Wipro under pressure. These three heavyweights are seeing a cut of more than 1%. HCL Tech reports the numbers later today. It comes out usually around 6 o'clock. That's when the press conference is scheduled. And HCL Tech is likely to report a growth this time, 1.5% on a quarter-on-quarter basis. And the company had also said that last quarter, 2 of their large deals got deferred to Q2. So if that closes, then deal wins should improve for HCL Tech on a sequential basis. But they had also spoken about a restructuring, both on the employee and non-employee front. So we'll wait for details on that. So HCL Tech, basically IT, is a bit on the back foot. Trent was one of the biggest losers last week. Trent had reported, Trent's stock had declined nearly 4% last week. And when they came out with the quarterly update, it was about a 17% growth in their standalone revenues, which is lower than what the analysts were penciling in. I think the company's own long-term guidance was about 25% growth. So Trent has taken a bit of it continues with its downtick. ONGC, BEL, ONGC in focus, crude prices too. So ONGC is now your top Nifty loser. The stock is perched at the 200-day moving average. So ONGC down 1.7, BEL down 1.25. Tata Motors, Adani Enterprises losing nearly 1%. IT is a bit shaky, seeing profit booking. Axis Bank, we spoke about it with Gaurav, and that's open in the red. On the way up, it's the auto names, Eicher Motors, Bajaj Autos. So the two-wheelers are in top gear. Apollo Hospitals, Asian Paints, Bharti Airtel are up close to about 0.5%. The bias is on the way down. The Nifty is lower by 83 points at 25,200.
So BLS, of course, is down 16% as we speak. It's the number one volume-led loser right now. And of course, I think as you guys highlighted, Reliance Power is down 7%. There's regulatory action against the CFO of the company. So look at the volumes there coming down sharply. Tata Communications, we highlighted. Telecom, of course, had a big up move on Friday, so just giving back some. Reddington is something similar, big move on Friday, giving back a little bit. And I think for something like a Vari also, it's something similar. GK Energy is another one, down about 2% or so, but we're just sort of starting up. and we'll have to give it some more time. Wari is up 9%. Wari is the biggest volume-led gainer on the NSE. So 1,234 is where Wari is at. MCX had a massive move, I think, on Friday or on Thursday. It moved big, some 5-6%. K Fintech, the double upgrade coming in from Citi, 2.5% higher. Silver ETFs are once again making a move, right? So look at Silver Bs, it's up 3%. If you have these up, there is 2-3 of these. HDFC Silver ETF, that is up about 3%. So no stopping. We had a bit of a pullback on Friday, but they are moving up once again. Matma India is up 4%. There is SBI Silver ETF, which is also up about 3% or so. So you got moves coming through on many of these names. Tahir Badshaw.
Not just Kotak, I think UTI Mutual Fund and SBI Mutual Fund have temporarily suspended lump sum investments in silver ETFs. So that continues.
Yeah. In silver ETFs? Or
silver ETFs. And I don't know.
ETF fund of funds?
I guess.
But
that's what Kotak had told us. Yeah,
because Nilesh had told us that by law, you can't restrict flows into ETFs.
Correct.
But fund of funds which invest in turn into ETFs, they've stopped lump sum. So we'll have to just
we'll
check
have to wait by
if that is what it is.
Fund of fund.
Fund of funds, yeah, exactly.
It's the fund of fund.
Tahir Badshaw is with us, Chief Investment Officer at Invesco Mutual Fund. Tahir, great to have you with us here. Good morning. Appreciate it. We are talking about gold and silver. So let's just let me ask you, you're an equities man out and out, but I don't know if you have any views here. It's just a massive one-way move that we've had. What's your sense, Tahir, from here?
So while I'm an equity guy, but over the last 1 year, we've been running a multi-asset fund. And to that extent, I've started to keep a little bit of a tab on gold and silver as well in the more recent months. And by and large, I think we have been constructive, pretty constructive, I would say, over the last 12-odd months since we've been running that fund very actively. And I think we still continue to like the space, but we have to remember that, a lot of the demand in gold, as we all know, has come because of the large elephant in the room, which is basically the central banks. And I think on last count that I probably happen to see, in terms of the reserves position, gold now starts to probably form nearly about 35% of global reserves. And this has moved up from probably more like 10-odd% in the last 3 odd years or so. So there's been a massive amount of, diversification of reserves of key countries, which has happened over the last some years, and that has driven a lot of the gold interest. So I would like to think that this is something which is kind of, reached a reasonably decent proportion. Of course, you can argue that it'll probably go to 40 odd or 50 odd %. But beyond a point, gold is an asset which is relatively liquid. And while it has its own attraction today, given the global geopolitical and geoeconomic circumstances, but I would like to think that investors probably who are investing in gold, and even for us, likes of us as well, we are moving with an expectation that probably cannot outperform equities for the near term, maybe Indian equities on the headline index, etc., for about 10, 12, 15 odd %. That's what probably we are looking forward to from here on, not necessarily the 30, 40 odd % or 50 odd % that gold and silver have delivered in the recent past. And between gold and silver, I think our relative preference for silver has been higher in recent times.
So Tahir, in your multi-asset fund, what is the holding of gold and silver, and how much are you comfortable holding? How much can that go up to?
So we are at about 19, nearly 20 odd % in gold and silver. That's what we've probably been at for a while, but within which we've changed the composition of gold and silver over the last some months. But by and large, the aggregate number on the precious metal side has been in that vicinity.
Would you look to change it from the current 20%, and how has the composition changed internally?
We moved a little more towards silver. I think we are now nearly, we were almost virtually everything in gold about a few months back. We're probably now more like 12-8 between gold and silver in our overall allocation, by and large. I mean, as per the latest disclosed fact sheet figures. But yes, we have moved our proportion towards silver relatively quickly in the last some time.
All right. Hi, Tahir. Good to see you, and good morning. Tahir, but what's the view on the markets? investors actually have shown quite a lot of maturity, the domestic money at least, because they have been watching, no returns for the last year or so, and yet the flows continue to come in. How are you reading the current market setup? Because ultimately, earnings need to pick up in Q3 and Q4. Do you think that could be the case and markets could actually start looking up from here on?
Well, at a level, I'm reasonably constructive, at least as far as global equities is concerned. I mean, we think US is in a good place, China too is in a good place, primarily driven, of course, by tech, AI, etc. But having said that, I mean, there is still a fair bit of resilience as far as our economy is concerned. There will be certain temporary challenges on account of inflation, but maybe even that too can probably be offset given where oil is, and it's been pretty soft and for the good of all of us, not just the US and China or the other countries. But I think to that extent, therefore, I think, US is quite sorted at this stage from an economic standpoint, and so is probably China. I think from an India standpoint, we have a little bit of struggle for sure. We have already underperformed a fair bit. You mentioned about earnings, and earnings is something which obviously at the end of the day has to materialize, and that is where the rub is. We still are a little languid as far as our earnings momentum is concerned. We probably might get to closer to double digits or early double digits by the March quarter, but this will still be short of market expectations, which are more like somewhere in the 13 to 15% range. So my broader sense is that I think we will probably see the headline indices struggle, but we still are very comfortable. We are still very constructive, at least as far as the broader market in India is concerned, particularly in the mid-cap and small-cap space. And we continue to probably, ideate, we continue to find opportunities along the way, particularly given some of the recent underperformance in certain parts of the market. So it is still a stock picker's market. I think the best chance for investors to probably generate alpha, get to closer to their target returns, lies through the mid-cap and small-cap parts of the market.
Have you been finding opportunities in that space lately? Or in what areas, what segments, Tahir?
On and off, I mean, we're not necessarily dried up in terms of investment, opportunities. I think at various points in time, certain sectors do provide that opening. Primarily, it might be at sometimes it has been industrials at certain points in time, parts of industrials, defense, and sometimes it has been real estate at, those again, pockets of the market which have underperformed. I think more recently we have been very excited about the consumption space. You would know that we are in the midst of an consumption NFO as well. So that's an area which is quite appealing across various sub-segments of that space as well. Basically, I think to us it looks like policy is essentially an important determinant, and generally follow the policy. I think if you follow the policy, you'll follow the money, and probably that is what has happened in the last 3 years. We've looked at how industrials have performed, PSUs have performed at various points in time. Certain specific thematic funds have performed. I think probably we think that the confluence of policy and various other factors is making the consumption space now relatively more attractive. So that is where we are finding incremental opportunities across the space, whether it be consumption retail, consumption tech, it could be autos, it could be, like as I said, real estate, and healthcare, for example, domestic healthcare, and so on.
Although in the other areas like defense and all of this, right? I mean, those are areas where there was direct, it's like almost industrial policy in that sense, right? Government is spending directly, and the companies and the stocks that you buy are essentially recipients of order wins, awards from the government. In consumption, it's a little indirect. We don't know. So it's a bit more, you don't know where that money is going to go, right?
Yeah, but Prashant, if you look at all the policy measures since the start of this calendar year, they've all been consumption positive or consumption pro. Look at it from the point of view of tax cuts in the budget to interest rates cuts to GST now and few other, state-specific measures, plus also the upcoming, 8th Pay Commission, which gets active from probably 12, 18 months from now. All these are going to be pro-consumption. I mean, of course, if we have to check as to what happens over the next some months, particularly after the festive season is over, because that will be the true test of how consumption holds up. But I think we've seen many more factors coming together that increases the probability. We can never be sure. But I think many more things are in place. It's not just one factor, but a multitude of factors, and that probably makes the whole thing probabilistically lot more stronger.
Tahir, when the entire industrials, defense, the capex theme, that upcycle started a couple of years back, it was under-owned, there wasn't too much conviction, and therefore you got outsized returns in the stocks. Now, suppose if the next leg of the alpha in the market will come in from consumption, many of these stocks are also very expensive to begin with. So if someone buys a consumption fund, for instance, right now, what kind of returns can they expect?
Rima, typically when some of these themes have, found the right confluence of factors, and we have a good starting point probably in terms of valuations, etc. If that mix is all favorable, then generally the first 2-3 years tends to involve a fair degree of re-rating as well, along with recovery in earnings growth. And I think that is where, you probably have maybe significantly higher than average returns. You could probably get past 20%. That's quite possible. We've seen it on several occasions in the past on a CAGR basis. And then obviously after which it will trend down to relatively more sedate or probably more like trend growth. But consumption, I think what we've also seen generally over its history is that typically it has been something which has done reasonably well, even without any triggers. I mean, on 7 out of 10 occasions, it has probably beaten the broader market with a decent amount of alpha. So it has its own bit of resilience, but if you are front-ended with a few factors which can probably propel growth significantly, then I think the first 2-3 years could be very rewarding.
Okay, all right. Final question, Tahir, before we let you go. You had briefly mentioned autos, I think, and that's a space that's come to life, particularly in the last 2 months or so. And post this GST rationalization, it appears the market is quite hot on it. How do you approach this theme? What do you like, across categories, whether it's the leaders or ones that are making a dent into some of that leadership?
So I think there are few pockets that we like. We like, for example, two-wheelers, of course, because that's where we will probably see a larger part of the action, within which we probably like we like the EV players within that segment. We, within the four-wheelers, particularly PVs, we are obviously, there it is about following the formula of follow the model launches and the model pipeline. And I think in that maybe there are a couple of companies which at various points in time do turn attractive versus the other. So that's also something that we like. We are probably not too significantly exposed as far as the CV cycle is concerned, I would say. But maybe there could be some attraction out there. And we have some bit of exposure as far as auto components is also concerned. But I think that is by and large the print as far as autos is concerned.
Tahir, great chatting with you this Monday morning. Thank you very much for joining in. You have a good day. Getting back to the markets, the Nifty is now below 25,200, 120 points down. It's still about a 0.5% fall, but it slipped a bit. Tata Motors is now your top loser. After that, you've got ONGC, BEL, Adani Enterprises, Tata Steel. These are the top 5 Nifty losers. Let's talk about Fintech, double upgrade. Sudarshan now joins in with the details. Sudarshan.
So the stock is currently up almost 3% after Citi has come out with a note upgrading the stock to buy, and target is raised to 1215 per share, implying an upside of almost 10% from current levels as well. And it says company is well positioned to benefit from robust mutual fund flows and also rising international clients. It will be aided by Ascent's global capabilities and near-term buoyancy that we are expecting in primary markets. Unlike CAMS, KFin benefits from first, lower pressure of telescopic pricing, and second, higher share of smaller clientele, and it also continues to augment its product capabilities that is driving revenue diversification, but overhang of promoter stake sale persists as per Citi.
Right, no, absolutely. Thanks very much, Sud, for that. We just want to put the spotlight on BLS International, which of course is the big casualty. Vinny is here with exactly that. Vinny, morning.
Hi, good morning. So yes, BLS International, that's ranking in trade today after the Ministry of External Affairs has temporarily restricted the company from participating in India mission tenders. This is for a period of 2 years. Now, India mission tenders accounts to around 12% of the consolidated revenues and 8% in terms of EBITDA. The company has given a clarification and they are saying that the development does not impact the company's current financials or any ongoing operations in this mission that is there. And the orders will not have a significant bearing on the company's financial outlook. But nonetheless, when you look at it, obviously 12% of their revenues coming from these missions, right? The India mission tenders. So because of that, there could be some pressure. If they do not get any new orders on that front for 2 years, we could see some pressure coming in over there.
All right. Thanks very much for that, Vinny. Appreciate it. Well, let's talk about the pharma space. Now, the U.S. Senate has revived the Biosecure Act, a law aimed at cutting ties between American biotech agencies and companies flagged as national security risks. This is expected to create opportunities for Indian pharma and biotech firms in the global supply chains. We have Kunal Dhamesha, Pharma and Healthcare Research Analyst at Macquarie Capital, and Neeraj Sharma, CEO and MD at OneSource Specialty Pharma. Gentlemen, great to have both of you here. Thank you very much for joining us. Let me, Neeraj, start with you. Prashant, this side. It's good to be speaking to you after a while, Neeraj, once again. And I want to talk about your specific business as well. But then let's just get this Biosecure Act out of the way. One line of, and I'll start with perhaps the pushback that I've heard from some, that the Biosecure Act was part of this National Defense Authorization Act, which is the NDAA, even last year. And in the last minute, it was kind of sort of knocked out from that act. The skeptical view is don't celebrate yet. So just wanted your thoughts, how you think about this entire issue.
Yeah, thank you, Prashant. Thank you for having me here. See, while I hear your skepticism on the act itself, but I think we should look much beyond that, right? It's not what the act says what is important. It is the strategic direction towards supply chain diversification. I think that is what we need to look for. And I think what has happened here is that what this act, whether the first version or the version now, what they have done is basically change the conversation in the American pharma boardrooms. Where the boards have given a very clear direction to the companies to really look at diversifying their supply chains and look at alternatives and to reduce concentration, and dependence on one country. And I think that particular point is really irreversible, whether this act, whatever shape or form it takes or doesn't.
Do you think, the other bit is that this is a much more diluted version as compared to what was proposed last year. Do you agree with that, Neeraj?
I think, while I understand that the tone may be softer, but I think the central essence remains as it is. And I think as a central essence is very clear, which is towards diversification, towards reducing dependence, towards finding alternatives to having too much concentration in one country. I think that essence remains absolutely intact. There has been no change in that direction.
Got that. Now, can you run us through, Neeraj, if this sort of were to become law, become an act, both House and Senate pass it? What are the implications? Will American companies have to stop working with sourcing from China? Will they have to divert sourcing to other countries like India? Is that a big shift? How large? Any way to think about the numbers here?
Sure. See, it's very clearly there is a significant upside for Indian CDMOs, including like us in OneSource. Any CDMOs and companies with adequate infrastructure, with the right regulatory strength and the agility to enter into long-term partnerships with global pharma will be beneficiaries, right? Because we have been building capabilities and And while the time, how much time it takes for the companies to really find alternatives, these are long gestation businesses. It will take some time, but I can tell you, we at OneSource, we have been seeing a significant uptick in RFPs and queries over the last many quarters, and I hear the same from many of our other competitors in this space. So definitely there is an upswing. Definitely there are queries and RFPs coming in. How they will convert into numbers over the next few years remain to be seen, but it's a definite upside is what I tell you, because there are very few alternatives to China here. Of course, South Korea was much earlier in this field, but after that is India, and I think from the base where we are in, we have a very even a small shift towards India will actually end up as a significant driver of growth for Indian CDMOs.
Mr. Sharma, just stay on. We also have Kunal Dhamesha, Pharma and Healthcare Research Analyst at Macquarie Capital, now joining in. Kunal, thank you very much for joining in. Mr. Sharma was just saying that they and the industry, as what he's learned, has seen a significant uptick in the request for proposals, queries, and he's very bullish. But you believe that what has passed, by the Senate is a very watered down version, and therefore the benefit may not be to the extent as what perhaps the street was hoping for. I mean, give us your first thoughts.
Sure. So I would not say, it's a watered down version. I think for Senate and House to kind of basically pass the Biosecure Act, they have made some amendments so that, it doesn't face a lot of opposition. So right now they have removed the names of the companies which are kind of classified as a biotechnology companies of concern, with which the businesses cannot be done. And the current version basically links, the biotechnology companies of concern to another list that is published by the US government, which is called 1260H list, wherein US government lists all the Chinese companies which either are Chinese military companies or they have ties with the Chinese military. And so the act will basically put all these companies in that list as a biotechnology companies of concern, rather than actually naming the companies in the act itself. Right now, I believe it's much more forward-looking, because the list of the 1260H list gets updated every year. And given that it is linked to this list, I believe that there is a much more uncertainty for the innovator companies, going forward, because the list can get updated every year. And hence, while earlier only 5 companies were mentioned, now it could be any one of the Chinese CDMO list. So I believe that right now, while it looks like the scope has been diluted, but the scope, in my view, has been broadened, and it can impact any of the Chinese CDMO companies, which makes it very uncertain for the innovator companies to kind of, go ahead and give projects to any of the Chinese CDMO companies. So while diluted, but broadened is the way I would put it.
Kunal, this still has to go through the House and gets the president's signature. So in that sense, it's still a wait and watch. And as far as we understand, I think last time it got blocked after the Senate?
It was not blocked. It was supposed to be tabled on the Senate for the votes with the National Defense Authorization Act of 2025. But it was not included in the NDA package of 2025. And hence, it didn't pass as an act, because generally the older Congress, when they know that the administration is going to change, they generally don't work on this kind of key piece of legislation, because the next US administration would come in and they would have everything kind of given to them. So that's why it was not tabled on. Now, in terms of timeline, when I see, generally the NDA needs to be passed by House before the end of the year, or before the House goes on the year-end break. So we believe that we'll see a lot more news flow coming in from the House of Representatives side on this by the end of this year.
We're running out of time, so I just want to get in one question to both of you. So if you could keep it short. Kunal, one stock, if you had to bet on to play the CDMO opportunity, basis this Biosecure Act, which one would it be?
For me, it would be DB's Labs. I think it's kind of very well positioned.
Okay.
Can't ask Neeraj for the stock because his stock is going to be one sold.
But Mr. Sharma, how soon can we get a deal signed? You said you've seen a lot of, requests for proposals and queries. And what could perhaps come in the way?
See, I think it's only a matter of time because these are long gestation businesses. I think it's the request for proposals will convert. How many? It's difficult to say at this time. I think one thing which companies will have to really focus on is also to build on the IP infrastructure, because what we as in the industry have to give comfort to global pharma is that their data and intellectual property is going to be safe in India. And I think that's the comfort we'll give. And once we do that, and with all our track record, I think we have got a lot going for us.
Got that. Neeraj, if I can ask you for your, on the semaglutide GLP-1 sort of opportunity, you still maintain that that these partnerships on GLP-1 will yield about $400 million in revenues by FY28, which you've stated earlier.
So we have said we'll reiterate our guidance, but just so that we are right now in silent period as far as OneSource numbers are concerned. So I would really not go beyond that. We will have this conversation after our results are out early next month.
No problem. But it's all on track in that sense, right? Because at the margin, I'm not talking about not talking about OneSource per se, but at the margin there was some not concern, but maybe there is a lot of fill finish capacity which is coming up. So maybe by the time a lot of these patents a lot of these drugs go off patent and then generics start to make it, and many of the top generic companies are your clients, there will be a fair amount of sort of supply in the market. So just a quick comment, if you will.
No, I think I said that earlier. I still maintain that there will be, as the markets get formed, there will still be constrained supply, to begin with, and it's not going to ease out very soon. It will still take a couple of years. And also, these are very complex products. Not everyone who have filed the product is going to get approved. So it's still going to be a restricted play, both from the supply, and the companies who get approved, and the companies which can really supply the market and the actual demand. So I think what we have said is going to stay put at least for the next couple of years.
Neeraj, it's a pleasure. Thank you very much for joining us. And thank you very much for your time. Kunal, really appreciate your time here on CNBC-TV18 as well. We're going to take a quick commercial break here. We focus on the cement space in just a bit.
Co-presented by Bank of Maharashtra, Ek Parivar, Ek Bank. Co-powered by National Stock Exchange, Soch Kar, Samajh Kar, Invest Kar. Presented by Punjab National Bank, the name you can bank upon. Co-powered by SBI, best hai sabko pata hai.
Welcome back. Let's talk cement now. This is our special segment, Quarter Se Quarter Tak, and Nigel has moved over to the big wall to give us the expectations from the cement industry in Q2.
Well, that's right. Today, we're breaking down the Q2 FY26 earnings preview for the cement sector. A quarter that's marked by strong EBITDA growth despite soft volume trends. Let's dive into the key drivers then. First up, the cement sector is expected to post a strong 50% year-on-year growth in EBITDA. That's going to be supported by around 5 to 6% year-on-year increase in cement prices and benign input costs as well. This comes on the back of a soft base that we saw in Q2 FY25. However, the volume growth remains muted, which is eating partly into the benefits of improved pricing. Industry-wide volume growth is expected to remain under 5% or around 5% on a year-on-year basis, which is continuing the weak trends that have been observed over the last few quarters. This has been impacted by heavy monsoon season, an early festive calendar, and dispatch disruptions in the lead-up to September 22nd, when the GST rates were revised. That said, M&A activity has supported volume growth for some players among the large names. UltraTech and Ambuja Cements were there expected to lead with volume growth of around 10 to around 15%, thanks to the recent consolidations that we have seen in both those two names. Among mid-caps, JSW Cement as well as JK Cement, they could post as well 15% and around 10% growth respectively. On the weaker side, Shree Cement, Dalmia, Nuvoco, all of them are expected to see sub 5% volume growth. And Ramco, there's a chance that it could possibly report a flattish to a mildly negative number as well for the past quarter. Sequentially, the industry EBITDA per ton is expected to fall by around 200 rupees, could come in closer to around 900 rupees, around 880 rupees per ton. That's because of the modest price correction, seasonal cost uptick, as well as weaker operating leverage. Though on a year-on-year basis, the EBITDA per ton will look much better. The pet coke prices, they have started rising, but the full impact of this will only be seen in the fourth quarter. This could also set the stage for another price increase, which could effectively come in the second half of November itself. On the EBITDA per ton front, going by company-wise, well, UltraTech, the EBITDA per ton could dip to sub 1,000 rupees per ton. Shree Cement, with its focus on North India, it could clock the highest EBITDA per ton at roughly around 1,200 rupees per ton, while JK Lakshmi is expected to show strong improvement of a low base. However, Ramco's EBITDA per ton may improve by only around 120 rupees, but the overall EBITDA growth could be limited to just 15% growth because they'll be hurt by lower volumes. Well, from a valuation standpoint, while earnings momentum is strong on a year-on-year basis, well, investors will need to watch closely for sustainability of price hikes, volume recovery post the monsoon, and margin resilience as well, as fuel costs have hardened a little bit. Well, to help us out with how he's seeing the cement sector's numbers, we are joined by Dharmesh Shah, the research analyst at JM Financial. Hi, Dharmesh. Thanks a lot for joining in and good to have you on the show. Well, let's get to the profitability aspect first up, Dharmesh. The EBITDA per ton. Some brokerages are talking about 180 to 200 rupees per ton improvement on the EBITDA per ton front for the industry on the whole. What are you working with? If you could give us a rough number.
Sure. Good morning and thank you for inviting me to the show. So on a year-on-year basis for our coverage companies, we are expecting around 35% improvement in the EBITDA per ton, which is like broadly 250 to 260 rupees per ton. And this will be led by the 5 to 5.5% improvement in the realization on a pan-India basis, around 4% kind of volume growth and marginally lower cost on a year-on-year basis. But being this will be a seasonally weak quarter, on a sequential basis, we are expecting around 200 rupees decline in the EBITDA per ton, which is like 16 to 17% decline. And this will be mainly led by the price fall, which is around 1.5% sequentially on a pan-India basis adjusted for the GST and operating deleverage. So overall, we are expecting around 250 rupees improvement in the EBITDA per ton on year-on-year basis and around 200 rupees decline on a sequential basis.
Got it. Dharmesh, I want to ask you about the volumes. These numbers are going to look good on an absolute EBITDA, because of some price increases, benign input cost as well. But the volume growth is still not coming, Dharmesh. Gone are the days where we used to see 8-9% growth. Now we have to be satisfied with around 5%. However, there is optimism the second half of the year things will improve. What are the volume growth estimates you're working with for the industry on the whole? And do you foresee a recovery in the next 2 quarters?
Yeah, so generally we don't see both the things come together, volume and price. So the first half will be the largely the price gain, where the industry has seen a 5 to 5.5% kind of price improvement. And despite the low base, the volume growth is likely to be just 4% in the first half. Given the base of the last year is also strong in the second half, where the volume growth has happened 8%. So in this year also, in the second half, we are expecting the volume to improve, and it will be like in the range of 7 to 8% volume growth for the second half. So for on a full year basis, overall, we are expecting 5.5 to 6% volume growth versus earlier expectation of anywhere between 6 to 7%. So we are tapering down our volume growth estimate by 50 to 100 bips for
Got it.
FY26.
Okay, all right. Dharmesh, if you have to look at a positive surprise from this past quarter's numbers, if you could name a couple of stocks where you see a positive and maybe a negative surprise as well.
So I will say that the result will start from the 15th October onwards. But on a relative basis, the price decline in the northern market is relatively lower on a sequential basis. So Sri Cement in terms of the volume growth will be muted, but in terms of the profitability, unitary EBITDA, they can see a much better EBITDA per ton compared to industry and lower decline as compared to industry. Given that their focus is on the brand improvement side, and secondly, the north region had witnessed a lower price decline. So the north-based company can relatively outperform compared to industry, which is like Sri Cement. While on the other side, the southern-based companies like say Ramco Cement, where also the volume growth muted, but sequentially we have seen a higher price decline in the southern region. So the Ramco Cement kind of company can see a relatively higher decline in EBITDA per ton compared to industry.
Got it. Okay, so North will continue to do well, and South could lag a little bit just for the past quarter. Wondering about the UltraTech Cement's commentary post the first quarter when they said that they believe South could be the new North, and they went ahead and then did that OFS on India Cements. That discussion for another time. But tell us, what are your top buy ideas and how do you position yourself? Some of these mid-cap companies, if consolidation has to continue, there could be some kind of M&A activity. So would you be staying with the top bosses, the big large cap names, or do you like some of these mid caps as well?
So see, this post GST cut rate implementation, and gradually we expecting that the next few months or the next couple of quarters, the industry will focus more towards the volume growth rather than the prices. So we will likely to bet on the large caps only. So we will prefer to go with the companies which are having a pan-India presence and the stronger balance sheet. So in the large cap, we will prefer the UltraTech, while in the mid cap space, we will prefer the JK Cement. And from a consolidation perspective, we believe that the large part of the consolidation is over, so we don't want to play consolidation theme for the next couple of quarters perspective.
Okay, all right. And on pricing, since that has been the positive for the last couple of quarters, I spoke about volumes, which are still lagging. But on pricing, at least the prices have held out, and in fact, they're marginally moved up. Even in the monsoon, we didn't see that kind of deterioration in prices. Now, X of this GST adjustment, what is the expectation with regard to pricing year on? Do you think for the remainder of the year, if these prices hold, will be good enough? Or are you factoring in a couple of price hikes as well?
So those GST rate cut implementation and second half can also see a good capacity addition. We are not expecting any material price hikes to happen. Rather, if the prices is hold on, that will be also be positive from the industry perspective. So we are expecting if any material price hikes to happen, it can happen only from the starting of the next financial year onwards. And we are not building any material price hikes to happen from here on for the next couple of quarters. And the industry may shift towards the volume side rather than the price improvement.
Got it, Dharmesh. Good to have you on the show. I think it's one of the first times that we're getting you. Thanks a lot for joining in and giving us, your take on the cement pack. And we request you to join in once the results start flowing in and give us your first take on that front as well. So that's about the cement pack. Watch out for, good improvement in terms of EBITDA. However, volume uptake needs to come about, and pricing, according to Dharmesh, if it holds steady as well, will be good enough in terms of an outcome. Well, we have Siddharth Rai, who joins us back on the show to help us out with the technical call. Siddharth, good morning. Good to see you in on a Monday morning as always. The markets are down 80, 90 points thereabouts. The good news is at least we're not seeing deeper gashes, and it appears there is some kind of buying at lower levels. What would you do? Would you buy into this dip, or do you believe there is still some bit of a pullback?
Hi, Nigel. Good morning, and thanks for having me, first of all. See, if we talk about Nifty, Nigel, since the index is reacting to some unexpected global updates over the weekend, it is very crucial to see how exactly does the index price in this newly found information. So today's session in Nigel is going to be very crucial for the index, specifically in spot 25,200 is the level which we have to watch out for today. Yeah, we've seen the index playing zigzag above and below this level since morning, since opening today. So if the index manages to sustain back about 25,200 today in today's session, we'll be back on track to move towards those big 25,400, 25,450 levels. But on the other hand, if we fail to do so, if the index goes down and around those 25,150, 25,100 region, we can see a quick dip back towards those 24,900, 24,850 levels. So today's level is going to be today's session is going to be very crucial, and 24,200 is the level which we have to watch out for in today's session, because that will decide the move in index going ahead.
Thank you very much for that. Let's get Tata Capital's first stick. 330. So
wow, that's Chandra. And Chandra, Chairman Tata Sons there, along with, of course, Mr. Sabharwal, the CEO of the company. So, I mean, that's saying something, right? Chairman of Tata Sons showing up for the listing of Tata Capital, and 330, it's about 1% higher. So, we should stay on the visuals, and big volumes, huge volumes. Rima.
Yeah, but this is the flagship financial services company of Tata Group, and Tata Sons participated in the offer for sale. So it was a very large issue of 15,500 crore, and it also included an offer for sale in which Tata Sons brought down their stake from 88 to about 74%. And Tata Sons chairman Chandrasekhar Chandra, he himself is present at the listing. It had seen an overall subscription of 1.95 times. In that, the retail participation was not gung-ho. It was fully subscribed by the retail 1.1 time, and the opening today is at 330, slightly higher than the 326 in terms of the issue price. This, remember, is India's third largest NBFC in terms of the overall loan book, which stands at about 2.3 lakh crore. It's been growing well at about 37% is the loan book CAGR over the last 3 years. But the net interest margins for the company are lower than peers. And that's because the company's focus is on perhaps lending more on the secure side. So the unsecured book as a percentage of overall retail is lower than the industry at 12%, which is why their NIMs are lower, but the credit profile, the return ratios have also been higher than peers. So it's sort of the approach of the management has been balanced towards risk and reward. And it's a stable opening for Tata Capital. That's the early tick on that. Okay, let's get back to the market technicals. Siddharth, you were giving us the index view. What about stock recommendations?
Yeah, sure, Rima. See, I think in this market, we should stay where the momentum is good. So when I say this, we should automatically move towards the autos. And right now, the auto stock which comes in my radar is Bajaj Auto. See, 9,000 was a very crucial level for this stock. For the past 2 days, we've seen a very good move, and it's back above the 9,000 level, and it's showing good momentum. So the move can definitely extend from here. Right now, the spot is trading around 9,056. So Bajaj Auto can be bought. The stop loss will be at 9,015, and our targets being the first target being 9,150, second target being 9,190. The second stock is Indigo. See, again, for the past 15 days or so, the stock is consistently showing good momentum to us. And right now, it's trading around a very crucial level of 5,800. And I think in some time, it will be able to go back above this level and sustain. So a fresh good move can be seen here as well. So Indigo can also be bought. Right now, the spot is exactly at 5,800. It can be bought. The stop loss will be at 5,779. And our targets being the first target is 5,890. Second target, 5,930.
Okay, all right. Thank you very much for that. useful to get that perspective and those trades as well. Time for a quick commercial break here. Commodities back in focus. Manisha is here with exactly that.
Welcome back. Still down 100 on the Nifty, and the advanced decline ratio is firmly in favor of the stocks in the red. 800 stocks in the green for 1900 in the red. But let's talk commodities now. Manisha is here with us. Manisha.
Well, thank you for that. I want to talk about silver right now because we've seen a strong rebound in the Asian markets right now, so much so that we are holding around all-time highs on your screen, and that number should come to you. 51.5 is an all-time high that silver prices are at, and the MCX silver is trading at a discount of around 151 right now. But when you look at the spot markets, the ETF markets, those are trading at huge discounts. So when you look at the silver prices, when you look at the December 2025 futures, that is trading at 48.03. That tells you that silver is trading in a backwardation right now. So spot at 51.5 and December futures at 48 therein. If you look at the physical demand, that has been very, very strong in various areas, and that has been supported supportive. The Indian silver premium also is trading at around 10% right now. So if you step out to buy silver today in physical markets, you have to give 10% premium for that. Well, various reasons for that, but let me come to the prices first of all. So in last 1 week, we've seen silver prices gain up by 6%. It's up 20% in last 1 month. And in one this year, we are looking at silver prices gain up by 78%. So huge gains coming in. This is the best yearly gain that silver has seen in a couple of decades now. Well, India is looking at strong physical demand, investment demand, physical festival demand as well. There is buying and there is a FOMO as well coming into the markets because silver, after breaking $50 an ounce, markets believe that you could be looking at higher highs. The fundamentals are quite supportive, and that is the reason you have a lot of buyers continuing in case of silver there. If you look at the overall markets then, and this is about MCX, remember the prices have been very volatile. So MCX as well, starting tomorrow, is revising initial margin requirements for gold and silver, both of those. So that is a circular that has come in, that came in on 12th of October, which says that gold initial margin now stands at 7%. This was 6% earlier. And for silver, it stands at around 10%, 11.5% right now. Earlier was 10%. So we've seen an increase come in for that one as well. That's about Indian futures. Take a look at the London silver now. For 4 decades now, it has been London silver that the world has been following, but that really seems to be breaking down right now. So London silver is trading at a $3 premium to New York right now. New York markets are trading slightly on the weaker side. There's a lot of arbitrage that we're looking at in the international markets also. The short silvers are struggling to source silver. People who've gone short, there's a short squeeze that seems to be happening at this point in time also. And the short silver holders are forced to buy record borrowing costs to roll positions to a later date. We also do understand that nearly an estimated 15 to 30 million ounces of withdrawal is what we've seen from New York. That has been the highest in last 4 years that a one-day withdrawal has come. And the expectation is that much of this silver really is coming in from New York into London there. Why silver surging? Well, one, it is about the rising debt that we've seen in the Western world. The $37 trillion just in US is something that is mind-boggling. Devaluation of currencies is yet another factor. And then the US government budget standoff and finally shutdown entering a third straight week. The markets also are looking at strong rising demand from India in sense of festivals. The physical demand in India seems quite strong. At this point in time, the street is working with 5,000 to 6,000 tons of import of silver in this year. But that number could increase is what the markets are working with. And then apart from that, there's a falling supply of available bars to trade. The London inventories have declined by 25% when you look at the last 5-year chart there. So everywhere that you look, there is a deficit. The trading liquidity is nearly empty. The inventories have been declining. This is the 5th straight year of deficit. And the physical investment demand seems to be really surging, including India, where we are working with the premiums of around 10%. All of that keeping silver higher, and 51.5 is where we are trading, is an all-time high for silver yet again in the day today.
Thank you very much for that. Just one stock, MapMy India or CE Info. That's up 6.5%. And look at the volumes, 20 lakh traded in the first 1 hour of trade. The usual daily average volumes is about 50,000, and already it's seen 20 lakh. And earlier in the month, Ashwini Vaishnav, he had posted on Twitter when he was making a cabinet presentation. He spoke about the reliance on technology, and he said how this presentation was made by Zoho. The maps were by CE Info, CE Info Systems or MapMy India. So just once again talking about self-reliance on technology. And since then, CE Info has quite shot into the limelight. Big move. Price and volume. Get into a break. On the other side is a special segment. It's the economy. Lata will chat with Rikin Shah of IIFL Capital on the banking sector outlook post the RBI deregulation and expectations from Q2 earnings.
The earnings season starts in full throttle this week, with most of the big banks lined up to announce their numbers over the next 8 days. The pre-results announcements show actually better than expected both deposit and loan growth for most of the big banks. The HDFCs, Kotaks, all of them have reported better than expected deposit and loan growth numbers. But markets are going to watch out in the actual results for the margins. And that may continue to shrink because the repo rate cuts pass-through is still underway. The added negative for banks could be that bond prices have fallen and therefore treasury income will not be a very big positive. Separately, of course, the Reserve Bank has announced a bunch of deregulation for banks, or you can call it ease of doing business. We will, of course, ask from bankers what they make of it in their post-results announcements. But to prepare us for the results season and for the year ahead, for the banks, I have with me Rikin Shah, Senior Vice President at IIFL Capital and a master of financial sector. Thank you very much, Rikin, for dropping into our studio itself.
Thank you, Lata, for having me over.
Okay, well, let me first start up with this general thing that the Reserve Bank has announced, the series of deregulation, the ability to do acquisition finance, to give unlimited debt against debt securities, and, even ECB rules eased. Do you see that as a future rise in loan growth?
So, Lata, if we look at the regulations which were announced, which can potentially aid the loan growth, there were a few of them. The first one was they repealed 2016 circular restricting the supply to the large borrowers at the banking system level.
The 10,000 crore
10,000 crore cap. But of course, the individual banks will still be governed by their large exposure framework. So this can potentially move some of the credit to the banking sector from the bond market in the longer term. But again, we think that banks are better off focusing on higher yielding retail and SME rather than superiorly higher rated corporates where the pricing is too thin. And as the bond market depends, this is unlikely to change it meaningfully.
What about acquisition finance?
So the M&A financing is, of course, one of the things as well, which now it is opened up to the banks. We'll have to see which large private banks who are better geared to, cater to this demand as well, especially the likes of ICICI, Kotak, Axis, HDFC, who have multiple financial conglomerate subsidiaries can cater to that. But again, we need to be very clear about the underwriting that you do here, because in the past, in the 2008 and in the earlier periods, we have seen that this can potentially lead to stress for the sector down the road if people go out after the leveraged buyouts, etc. So that's the second one. And the third and the final one is on the no caps on the listed debt securities. I think that's okay. So all in all, slightly positive, but I don't see the demand for the credit to go materially higher. So if I were forecasting 10.5% kind of a banking system loan growth, potentially 11.5 in a longer term, but not a materially significant positive.
Okay, I guess we will have to see the appetite of the conglomerates or of the companies who want to do acquisitions. Okay, now let me come to the results itself. The loan growth has surprised you also. Was it positive?
Yeah, absolutely. I mean, because if you look at the latest fortnight data available until 19 September, the banking system loan growth was 10.5% YOY. And most of the banks that have reported, they have reported loan growth which has beat our and consensus expectation by 2 to 4 percentage points. So the loan growth has been ahead. It probably could be due to two reasons. First is in the last fortnight, there was actual acceleration in system credit. Potentially led by festive demand or the postponement in buying due to the GST cuts. Or also secondly that not all the banks have reported the business updates, as some other banks like ICICI, SBI, etc. report the numbers. There could be some market share loss in for some of the banks who have not reported so far.
Okay. Oh yeah, that's possible. But let's take HDFC in particular, where we saw that mid-single digit loan growth for a whole year, for 4 or 5 quarters. You think that period of adjusting to the HDFC balance sheet is over and now we will start seeing the old HDFC bank again?
I mean, still not there. Probably we are still a year away from seeing the balance sheet reverting to the pre-merger balance sheet levels. But clearly the worst in terms of very low loan growth, sharp decline in the margins and any asset quality issues is behind. So we have seen the loan growth accelerating from 3-4% to 8-9% right now. it's still lower than the system.
Lower than there, yeah.
And I think by next fiscal, when we reach there, they can probably start growing similar to or slightly faster than the system. So FY28, I believe, would be the first year when you'll see HDFC Bank reverting completely back to the pre-merger run rate on most of the financial matrices.
Now, if I remember right, that was Shashi Jagdishan's guidance about a couple of quarters during the results that in FY27 we will catch up with the system. But therefore, is it attractively priced because of the past?
Yes. So, you know, from our medium to longer term perspective, preferred picks, the ones among the larger private banks which we like is Axis, ICICI and HDFC among the larger private banks and SBI among the PSUs. Of course, in the near term, there are multiple other factors at play as well. And given that you asked about valuations particularly, it is now trading only at 3-4% discount to ICICI right now. I think we are probably at least a year and a half away before we can have a debate whether HDFC should go back to commanding premium versus ICICI. But given where we are, I think the near-term relative outperformance could be kept due to ICICI not doing as well.
Okay. What should the investor look at? Perhaps HDFC Bank will not catch up in terms of margins also to its 4% plus scenario. Is a good ROA enough? I mean, if the ROA were to impress above 2, would that be good enough?
Yeah, absolutely. So as we speak today, the bank is doing 1.7, 1.8% ROA. There is no doubt or skepticism in our mind whether this can go back to 2% ROA. It will happen over a period of time as erstwhile HDFC Limited's 8.5% bond borrowings come up for maturity and you'll replace them. So that journey is there. I think what you'll see from any investor looking at the stock from a longer term perspective, HDFC has demonstrated that they are gaining sustainable market share gains over a longer period of time on deposit. Loans is a problem in the near term as they are adjusting their balance sheet. But once that is done, I think you will see a decent high-teen earnings CAGR growth trajectory for the bank.
Okay. What about mid-cap banks? We have 3 results from RBL and a few others. Did anything stand out for you?
I mean, so if we look at the business updates that were out, Karur Vysya, Bandhan and RBL reported loan growth which were anywhere between 1 to 4 percentage point higher than what the consensus was expecting. On the deposit side, it has been generally in line or weaker across most of the banks. Among the mid-sized banks, the one stock which we have liked and we have been recommending to investors is also RBL. Even for near term as well, our estimates are around 10% higher than the consensus.
Oh, okay.
And the bank is in a fundamental turnaround story wherein the ROAs are likely to improve from 0.5% as we speak today to 1% by exit FY26. There are a couple of other mid-sized banks like KVB, etc., which are also good banking franchise.
Okay. You're not impressed by the gold financiers? I mean, there's only one bank which stands out over there.
I mean, yes. So a lot of the gold financiers have had the tailwind of the gold prices, and you will see a lot of them reporting very stellar loan growth backed by the increase in the gold prices. So yes, the growth should be very good for them as well.
If I remember right, in RBL, you're saying that that is the only bank which may report rising margins. How will they do that?
So yes, Lata. So in this quarter, we are expecting banks to report margins in margin contraction of 5 to 20 basis points. On the lower end of the spectrum, you will have the PSU banks and a few private banks like Kotak, etc. But RBL bucks the trend and should be reporting 3 to 5 basis point higher margin QOQ. The reason why this is happening is mainly because of sharp reductions in the cost of savings account rate. So the last quarter, the cost of savings account rate was 5.8%. This quarter, you'll probably see that coming down closer to 5.4, 5.3.
Okay.
So any pressures on the loan yield will be more than offset by the lower cost of fund. And that is where you will see the margins starting to improve for RBL.
Okay. Well, to go back to the regulations which the Reserve Bank announced, they have also announced draft ECB rules, which seems to give the impression that banks with foreign branches will now be able to finance M&As and any end use from their overseas branches. Does that put BOB in a better position?
I mean, a lot of these banks like BOB, SBI do have the foreign branches and have the wherewithal to do this if it is required. So again, I mean, the large private banks, select PSU banks, they have the capabilities to do this. We'll just have to see how the appetite for this is and what the boards of this respective banks are comfortable in terms of underwriting this risk.
Yeah. Yeah, I know. I guess we're counting the chickens a bit too early. We don't even know what the final rules will be. These are draft rules, and there are a lot of grey areas. What's your sense about Kotak? I thought you all have upgraded Kotak.
Yes, so Lata, we had reduced rating on Kotak for almost 2 years, and we have recently upgraded and made it to a ad rating, which is more like a neutral rating. The thought process behind this recent upgrade is the operating backdrop for the banks is improving. We wrote this report sunny days ahead a month and a half ago where we said that operating backdrop for banks is improving. So naturally the banks which were hurt more either in terms of liabilities or asset quality, they'll see a better recovery vis-a-vis other banks where there was no problem.
Okay.
So for instance, the likes of Axis and Kotak have seen sharp deterioration in asset quality. As this macro backdrop improves, you'll see that this will be the beta names which do better, and hence we upgraded the stock to a ad rating. It still doesn't feature in one of our preferred picks from the longer term perspective due to certain reasons.
Okay. Yeah, I know Q1 was not very happy for them in terms of asset quality, and likewise for Axis. So you see those Axis Bank also reporting better numbers. Okay, finally, I wanted to ask you about PSU banks. You know, they've had a superb run of credit cost. And they had the advantage of, last quarter, very good treasury income also. This time the treasury income is not going to be good because we saw bond yields rising. I mean, the 10-year, I think, rose by 20, 30 basis points from June 1st to September 30th. So both this, will credit cost advantage continue, and will, treasury income fall be very sharp?
Yeah, so the treasury income, I think it's pretty obvious that given this sharp spike in the GSEC, the treasury gains will be materially lower versus what we saw in 1Q. And 1Q was again an aberration. The numbers were very strong vis-a-vis the historical run rate. So no doubt across the banks we'll be seeing them declining materially. We still, our discussions with the lot of treasury desks still don't suggest that banks will be reporting losses, but it will be materially lower. Credit cost, yes. I mean, nothing at this point still suggests that there is going to be any marked deterioration in the credit cost for these banks from a near-term perspective. The only one pocket where I'm a bit watchful for PSU banks is micro MSME segment, where they have slightly higher exposure and historically the credit costs have been elevated. But again, it's not going to be as big a problem as retail unsecured because a lot of this are backed by hard collaterals and covered under the government guarantee schemes.
And they're small, even the total book. Just a final word. What is your, this is more a head of research question. Where does finance stock stand in IIFL's hierarchy of picks?
Until the report, the sunny days ahead that we wrote a month and a half ago, it was not featuring in one of the key recommended sectors. Since then, we have recommended investors to add more weights to the financials. So it is now one of the few sectors which we really like, especially because if you look at the banking sector in particular, we are talking about high teen earnings CAGR for next 2 years versus broader Nifty 13-14% earnings growth. And more specifically, the valuations are far more reasonable, 12-time PE versus 22-23 time. So naturally, it's now one of our recommended.
So finance has come up in the hierarchy. Thank you very much, Rikin, for that ending on that optimistic note. Let's see, next weekend, same time next Monday when we meet, we will have a bunch of banking results and we will see how they have done. That's it on this edition of Bazaar. Thanks for watching. After a break, Chartbusters.
Presented by Punjab National Bank, the name you can bank upon. Co-powered by SBI, best hai sabko pata hai. Co-powered by SBI. Best है सबको पता है. In association with Think Equity, Think Motilal Oswal.
Axis Bank trades under pressure after receiving a letter of caution from the RBI advising them to exercise extreme caution and diligence to ensure strict compliance with KYC norms.
Shares of BLS International Services fall as much as 13% after the Ministry of External Affairs debarred the company from participating in any future tenders with the ministry for the next 2 years.
It's a flat debut on the bourses for Tata Capital. The shares list at 330 rupees against its issue price at 326 rupees, holding just around 330.
Shares of Avenue Supermart trade lower after reporting its September quarter numbers. The revenues grow by close to 15%, while higher depreciation impacts the profitability. Well, hello and welcome to Chartbusters. We're coming to you live from the CNBC-TV18 Motilal Oswal studio. I'm Nigel, and with me is Mangalam. And for starters, because of the global backdrop, the Indian markets are down, but we're not out. We're down by close to around 80 points, which is par for the course. Most of our Asian peers are down more than 1% in today's trading session. And in the last few minutes, as you can see, the Nifty Bank has moved into the green as well, Mangalam.
I just moved under the Nifty Bank, Nigel, but be that, as it may, it's the temporary worries that were there for Axis Bank, which was basically sentiment negative. The stock opened lower, thereafter it's moved higher. And in that, what it's done is it's taken all the other stocks higher as well. So we have something like an IndusInd Bank, which has moved higher. ICICI Bank has done well. HDFC Bank and Kotak still under, the flat line right now, but have recovered from the low. So the Nifty Bank doing well for the frontline index. And so long as the Nifty holds above this, 25,180 to 25,200 sort of level, which was earlier a bit of a congestion, now will become support after the Nifty broke out beyond that on Friday. Let's see whether it sustains and pulls back from here on or not. Let's get in Shivangi Sada of Motilal Oswal Financial Services for a quick check on the market. Shivangi, slightly lower in today's trading session, but coming off the lows.
Yes, very good morning, Mangalam and Nigel. Thank you for having me. So we've seen that the indices have, kind of made a comeback, and we've seen that despite India VIX, showing some sort of volatility, there has been the put-call ratio, which has kind of jumped to 1.3 levels, which is supporting the entire broader market. And in the last 6 sessions, we've seen that the index has been, witnessing very strong support-based buying, which is acting well for the index. Now, of course, we are going for buy and decline strategy, even though the market is a little range-bound today. But we are recommending to put a support near 25,150, which is the close support for the day. And positionally, 25,000 would be important to watch out for the upside move towards 25,450 and then 25,600 levels. So this would be the take on Nifty. Talking about Bank Nifty, of course, this index has been the one which has rallied the most in this entire 10 trading sessions. And we've seen that, of course, strength can be seen across the heavyweights, be it the PSU and the private names. We've seen revival even in the private names. Of course, the PSU has been leading the pack, but we've seen strength overall. And Bank Nifty is comfortably holding above its immediate resistance levels of 56,500 levels. So clearly a role reversal has taken place here. Now, there has been good amount of long build-up in most of the banking counters, which is now acting well for this one. So, we are recommending a buy on the Bank Nifty as well. And the next targets that we're looking at is 57,350 levels with a support near 56,350 zones.
Okay, all right. Shivangi, also wanted to ask you on individual stocks, what's in your radar?
So, Nigel, there is a problem of plenty today. A lot of stocks are having a good setup. And, first up on my radar is exchange-related counters. Comes up BSE, which has performed quite well from the last 7 trading sessions. And we've seen short covering convert into long build-up from the last 3 days now. And the way RSI is also placed very positively, this one's looking quite positive as it has negated, the downward sloping channel on the weekly basis as well. In fact, this entire space is having a good momentum, so tailwind from that will help the stock as well. So recommending a buy here with a target of 2470 levels and with a stop of 2330 zones. Second stock on my radar is Federal Bank. We've seen that, of course, Bank Nifty has outperformed, and with that, PSU space has been one of the star performers. Federal Bank has been one stock which has resiliently held on from the last 5 sessions. We've seen excellent volumes along with price action here. Now, there is a strong follow-up buying in this one as well. IVs have cooled off, which is quite positive for this one, and overall looking quite positive. So recommending a buy here with a target of 220 levels and a support of 207.
All right. Wonder if you have a call on Maruti, because Maruti's picked pace as well as we move towards, the festive season. That stocks actually moved to a high once again, the day's high. Maruti. Shivangi, you have any thoughts?
Yes, absolutely, Manglam. Auto space are ones which are shifting gear right now. And if we talk about Maruti or Hero MotoCorp for that matter, both of these stocks are looking quite positive. Maruti specifically has, given a wise spurt of the last 9 trading sessions. So this one's looking quite positive for the next up move. This one would be a stable one for the next quarter as well. And we are roundabout looking at targets of 17,000 on Maruti with a support of 16,100 levels.
All right. Thank you so much for joining in and giving us your calls on the index and individual stocks, Shivangi. With that, let's get you some more ideas for profit. This one comes in from our colleagues at Money Control Pro, and today we have Madhuchanda De joining in.
Hi, we are talking about Inventurous Knowledge Solutions, or IKS Health, which is a technology-enabled healthcare solutions provider offering a care enablement platform assisting physician enterprises in the US, Canada, and Australia with a predominant focus on the US markets. The complete deployment of IKS platform has demonstrated the ability to improve EBITDA margin by close to 8.5% to 9% for the physician enterprise, thereby making it a compelling proposition. The opportunity size in the US healthcare market is huge, and the relative penetration of outsourcing on the provider side is relatively less. The growth journey of IKS has been driven by expansion within the top clients. The company has steadily evolved its business model to expand its addressable market and is also at the forefront of AI adoption. The acquisition of equity, which was done in 2023, is also turning around with steady improvement in its margin. While there are inherent risks in the business in terms of a single country and single sector exposure, the growth journey of IKS cannot be ignored.
All right, we take that point. Thanks a lot for that. With that, we'll slip into a short break. And on the other side, we have an interesting conversation lined up with Pramod Amte of InCred Capital. He'll talk stocks, market, and the strategy from here on. Stay with us. Welcome back. A couple of stocks doing very well. Adani Ports has moved higher. SBI Life is the other one which is spiking as well. And Axis Bank continues its recovery from the lows. But one stock which is lower in double digits is BLS International. A bit of a dampener coming in the form of the government debarring, or the Ministry of External Affairs debarring them for future contracts. Vinny joins in to take us through the details of this one. Vinny.
Yes, the stock is tanking in trade today. And like you mentioned, the Ministry of External Affairs has temporarily restricted the company from participating in the new the Indian mission tenders that will come in for a period of 2 years. Now, currently, as of now, when you look at it, this Indian mission tenders contribute around 12% of the consolidated revenue, 8% of their EBITDA of the company as well. The company is given a clarification saying that they're not expecting a financial impact coming in here in terms of the current business of the company. The existing contracts will continue is what they're highlighting. But obviously, the concern remains, what about the renewal of the contracts? What about newer contracts coming in and the revenue growth going forward? So that is a major concern that comes in for the company, especially Indian mission tenders, which is the government of India. When that side, you are not getting orders from your own country, what will it pan out for them in terms of the global front? That will be key to watch out for.
Right, thanks a lot, Vinny, for joining and giving us a quick update. To be fair, actually, the stock has recovered close to 5% from the low point of the day. But that said, let's welcome our next guest. We have Mr. Pramod Amte from InCred Capital, who joins us on the show. Hi, good morning, Mr. Amte, and thanks a lot for joining in. How are you feeling about the markets? You know, we have earnings season that's upon us right now. And the hope is that we'll see some kind of basing out in terms of earnings downgrades. And things could actually start looking up. Do you believe that could be the case? Or do you think there is still risk to the Nifty EPS assumptions?
Yeah, morning, Nigel. Broadly, we have seen the last 2 months slide in Nifty is being withheld, especially in September, where we have seen some improvement on back of the policy actions by both the government of India and also by the RBI, with which we feel that the near double-digit type of earnings cut on consensus happening for CY 26 and 27, hopefully maybe bottoming out in the September quarter. And definitely there is a reason to hope out or rise the wall of worry versus the slide on the hopes which we had in the last couple of months to turn around in the next quarter onwards. So hence, in the earnings season, it will be apt to look at the commentary of the management commentary versus the actual numbers for the September quarter.
All right, so more commentary than the actual numbers would be extremely crucial to track this time around, Mr. Amte. But you know, I'm looking at your list of outperformers and underperformers, and you've made an addition to that list, Apollo Tyres, and you've made a deletion from that list, E2E Networks. Can you give us the rationale on both, and what is the kind of target that you're expecting on Apollo Tyres from here on?
So clearly, with the post-GST cut, we are looking at two types of plays in the marketplace. One are the companies which will benefit from the volume side, where the customer demand elasticity is much better. Or the second one is where in the last couple of quarters, the intense competitive pressure has led to the margins hitting to the cyclical bottoms. Apollo falls into the second place, where the tire prices or discounting has been phenomenal, and clearly 7 to 8% type of price cuts to respond for GST may not move the needle drastically on consumption, but I think it will bring back sooner the normalcy on margins, especially where the natural rubber is also correcting. So hence, along with that, they have also done a corporate action for the high-cost Netherlands centers being closed and taken into P&L. So that favors broadly the tire stocks, and within that, our preference is Apollo. We clearly exited the upside which has come through from E2E, which we added around 2 months back after nearly a 50% rally on the AI infrastructure boom. We exit in the recent month.
Okay, very quickly, Container Corp is a company that you'll still like. You know, that's been a relative underperformer. You think things will look up from here on? If I look at the list, Container Corp, Camlin Fine, you know, those are the stocks that the target price actually is the highest. Even Globus Spirits, So give us quick rationale. Which is the best among these three?
So clearly, in terms of a short-term triggers, Globus is where we clearly see some upsides, especially where the recent tenders for ethanol also clearly favor the space for grain-based players, in which Globus is a play on the broader side, along with the brand building which they are doing on the liquor front, where some of the brands are well recognized now and the traction is pulling through. So that's in the short term. But otherwise, if you look at the drivers for Concor, is still the connectivity for the DFC happening in the second half. So the volume growth we are expecting to come through as we get into the second half. That's the better one. Camlin is a proxy beneficiary of the duty tariffs which are happening on the global space, especially both in US and Europe, where India is relatively better off versus the peer countries like China. And we expect the production shortfall which happened in the previous quarter to be overcome in the coming quarters and build up from the pricing and the volume action.
Okay, so Globus Spirits as well as Camlin Fine, couple of stocks that you like, which are very, very high target prices from these levels. Appreciate you joining in, Mr. Apte. A small but effective chat. Look forward to hearing your views in the time to come. Well, for the time being, we slip in a short break. Come back, continue focus on markets and stock-specific action.
The market's taken a leg down once again. It slipped below the 25,200 mark for the Nifty, and this time the culprits could be, the FMCG stocks and the IT stocks. So if you pull up the IT index, Infosys, TCS, both of them at the low point of trade. And alongside that, we have HUL as well as Britannia. Both of them are lower as well. But beyond the markets, we have live visuals coming in from Israel as Hamas has released hostages under a ceasefire agreement. The exchange sees 20 Israeli captives held in Gaza for nearly 2,000 Palestinian prisoners. US President Donald Trump has declared the war in Gaza as over as he flew to West Asia, where he will address and co-chair a summit in Egypt on the ceasefire deal between both Israel and Hamas.
Well, on that note, though, we'll wrap up on this edition of Chartbusters. You stay tuned. Trading Hour comes up next.
Co-powered by SBI. Best है सबको पता है. In association with Think Equity, Think Motilal Oswal. Powered by SBI. Best है सबको पता है. In association with Think Equity, Think Motilal Oswal.
Hello and welcome to Trading Hour, live from the CNBC-TV18 Motilal Oswal studio. I'm Sonal Bhutra. With me as always is Hormuz Fatakia. A brand new week. It's a Monday morning, but Nifty is on the back foot. But that was something which was expected, considering that we closed at a one-month high on Friday. That was the second consecutive week of gains that we saw. And so, yes, taking some rest right now for the Nifty. But yes, that's what we are seeing globally as well. 100-point downtick there. And we have all the sectoral indices in the red as we speak. The biggest one in terms of loser being Nifty IT. Then we have Nifty Oil and Gas, Metals, Energy, all of them not doing so well. Of course, FMCG continues to be on our radar. We'll discuss that in greater detail as well. But the FMCG index also has taken a knock from the highs of the day. In terms of specific stock action, we do have Infosys, which is at the day's low. There's Wipro. HUL is the other one, which is a heavyweight and contributing to the losses that we are seeing on the Nifty as well. That's from the Nifty pack. Even the Midcaps are not doing so well, 0.4% lower there. So there are a lot of moving parts in the broader market. So let's go across to Hormuz, who's gone to the big wall with all the movers in the broader markets. Hormuz.
News flow, earnings, everything is going to start dominating proceedings now as we go into the earnings season in full flow. But you start off with a loser in today's trading session at BLS International. At one point, the stock was down almost 17%. So there is a marginal recovery, if you could call it that, from the lows of the day. Now, volumes are set to be the highest since January of this year. We've already had more than 1 crore shares that have changed hands on BLS International. The 20-day average is less than 4 lakh shares. And it was already trading below its key moving averages. And with this fall, it has now slipped further below all of those key moving averages. It's been an underperformer so far in 2025, down 40%. It's going to be the first negative year since 2019 for BLS International, and this is also the biggest single day fall that the stock has had since 2020. The other news flow driven name today has been Mapma India, or its parent company CE Infosystems. At one point, the stock was up almost 10%, so it's cooled off slightly from those highs, and the stock has declined only twice in the month of October so far. We had close to 25 lakh shares that have changed hands on Mapma India today. The 20-day average is just over 11,000 shares. Now the stock trades above its 200-day moving average of 1739 and its 100-day moving average of 1762. The stock is up around 15% so far in 2025, was down around 20% last year. Dreamfolk Services is making a move today, and it's seeing double-digit gains. It's now price band also been revised to 20% because it was making upper circuits of 5% all this while. It's gained in 6 out of the last 7 sessions, and during these 7 sessions, the stock has given gains of more than 40%. Now, 15 lakh shares of the company have been traded. 20-day average is only 95,000 shares. Breaks above its 50-day moving average at 130. Now, the 100-day moving average is at 173. It's the 5th straight day of gains, but of course, needless to say that the stock is way below it's the recent highs that it had made earlier this year. And lastly, GM Breweries has been a very significant rise in trading activity ever since it reported results last week, up 8% today as well. It's gained in 7 out of the last 8 trading sessions. But take a look at the volumes of the last 3 sessions. More than 1 crore shares have changed hands in GM Breweries, almost 1.5 crore. Even today, we have had 13 lakh shares that have been traded. 20-day average is around 1.3 lakh shares, and the stock is up almost 40% in the month of October so far. It's on course to become the best month that the stock has had since June of 2021, Sonal.
All right, take that point. Thank you so much for joining us. By the way, the Bank Nifty, watch out for that one. It is recovering from the lows of the day, courtesy HDFC Bank and SBI. So the BSU Banking Index also has seen a sharp recovery from the lows. Watch out for that one. But we do have Vivek joining us on Vari Renewable Tech and why he is tracking this one. Vivek?
Well, that's right. So the company over the weekend declared its results, and very strong set of numbers in line with what most of the analysts on the street were penciling in as far as solar EPs as well as module makers were concerned. Revenues high by almost 48% on a year-on-year basis. The EBITDA up more than doubling, in fact, up 2.2 times. Margins also expanding almost 650 basis points. Profitability more than doubling on a year-on-year basis. The unexecuted order book for the company remains quite strong at almost 3.48 gigawatt power. And when you're looking at the unexecuted order book, at 3.48, but look at the execution. They expect it to be done within the next 12 to 15 months, again giving strong revenue visibility over the next couple of quarters. Bidding pipeline, the company says, is at greater than 27 gigawatt peak, and what they're saying is that the company this time has approved investments for almost 28 megawatt peak IPP solar power plants of 14 megawatt peak each at 2 locations in Maharashtra. Company has also set aside the capex budget for the same. Strong set of results. No wonder then the stock is up over 11%.
10% higher now on Vari Renewables. Strong results, Vivek. Thank you for that update. The other one driven by news flow today is KFin Technologies. It's a double upgrade that has come in from Citi, and Sudarshan is here to tell us just that. Sudarshan.
So it's one of the amongst top mid-cap gainers after Citi has come out with a note upgrading the stock to buy, and target is increased to rupees 1215 per share, implying an upside of almost 10% from current levels. And Citi says company is well positioned to benefit from robust mutual fund flows.
All right, Sudarshan, we'll come back to you, but let's go cut across to the conversation we are having with Tata Capital, the recent listing.
Been always very important for us. One, ensuring that governance standards always are very high. Two, we want to keep customer at the center of whatever we do. So in terms of creating more convenient options for customers to access us is going to be a priority area for us. We also want to ensure that we keep increasing the proportion of cross-sell in our book. We want to retain customers for life. As far as use of technology and now Gen AI is concerned, we've invested a lot in that space. We're seeing the benefits of that accruing to customers as well as to Tata Capital, and we want to continue the same. As far as extending our distribution reach is concerned, we do follow a completely digital strategy. While we are growing our physical presence, we are also using digital as a means to make the access easier. As an organization, we've always believed in responsible lending. We do focus a lot on risk practices so that we keep our credit costs the minimum, and that will be our agenda in the future too.
So since you mentioned Gen AI, can you take us Gen AI come into the picture? Additionally, I also wanted to understand now that the RBI's listing mandate has been fulfilled, now where do you plan to prioritize to capitalize the newfound credibility and to expand the lending portfolio?
So as far as the capital which we are raising, it will primarily go to fund our growth. It will help us increase our tier 1 capital. Capital adequacy will go beyond 22%. And we do believe that this will be sufficient for us to fund the next 2.5-3 years of growth. As far as Gen AI is concerned, we truly believe that use of technology should be for the reason of making life more convenient for customers, to make access better for customers, to make things more transparent for customers, and to ensure that our turnaround time becomes faster. We've used, in our case, Gen AI to ensure that our credit processes become more robust and our turnaround times become faster. Similarly, on the service side, we've used Gen AI so that we can respond to customers almost in a real-time basis, and that will be our endeavor, that to use technology for the benefit of customers and to improve operating efficiency for us.
All right, that's the word coming in from Tata Capital, 1% higher, and it listed around those levels itself, the biggest IPO that we saw in this year itself. Let's slip into a short break now. Up next, we'll focus on the crypto market with Manisha Gupta on the other side.
CNBC-TV18 presents Crypto Corner, powered by CoinDCX.
Welcome back. In Crypto Corner, we're talking about the kind of moves that we've seen in crypto as an asset class. Remember, it has been a lot of statements coming in from the international markets, mostly from the US President Trump on China, that seem to be making waves in various asset classes. To begin with, major cryptocurrencies have rebounded post that very heavy sell-off that we saw on Friday and Saturday as well. Remember, crypto trades 24/7, and the weekend volumes sometimes are much higher than what you see during the weekdays as well. But what we've really seen is the kind of moves that have been coming in from many of these. So Trump's threatening to impose 100% tariffs on Chinese goods is what led to a complete sell-off, whether it was about currencies, commodities, metals fell by between 5 to 6%. Most of the currencies saw sharp declines as well, and the equity markets were also sharply down. If you look at the steepest sell-off is what we've seen in US equity markets in a matter of one day, and that is exactly the kind of sell-off that you saw in many of these cryptos as well. So Bitcoin, which was trading at around 115,000, that's where it's trading right now as well. But during that sell-off, went all the way down to $103,000. Same is the case that we saw in Ether as well. That fell by nearly 14.5% from 43 plus to $3,700. Solana fell nearly 20% from $223 to $178. Of course, there's a bit of a rebound coming in for many of these altcoins, crypto assets, etc. If you look at the overall liquidations, well, that totaled to nearly $18.2 billion. Now, this is the largest one-day liquidation or a sell-off or profit-taking that you have seen in cryptos in the history ever. So the kind of sell-off that we saw, much of that clearly came in from Bitcoin, $5 billion of profit-taking or liquidation there. Ether saw $4 billion lost in matter of just one day, and Solana was down by $2 billion as well in sense of sell-offs and liquidations there. Overall, when you look at the prices then, we've seen sharp declines in the matter of last 1 week. But because it has been very volatile in last 2 or 3 days, if you look at month-on-month moves there, it is seen a sharp decline as well. So Ether, Solana down anywhere between 10 to 18%. Bitcoin, even as it has seen a very sharp decline, is down just about 0.2%. There you have Ripple, Cardano, Polygon, all of them down between 15 to 25% as well. So the matter of last 1 month and last week, it has been very sharp declines in crypto, but that is as what you have seen in other asset classes as well. When you look at year-on-year numbers, many of these cryptos continue to do quite well, by the way. So you have Bitcoin, which is still up 75%, Solana is up 25%, Ether is up 59%, and in some of these altcoins, you have triple-digit gains as well logged in as you look at last 1 year. So while Ripple is up 370%, you have Binance up 120%, Cardano up almost 100%. So year-on-year, crypto as an asset class continues to give you very strong returns. The last 1 month volatility and the kind of liquidation that we have seen clearly had been quite shocking. But with that, that's all that we have on Crypto Corner. Go for a break, come back and talk more market and stock specifics.
CNBC-TV18 presents Crypto Corner, powered by CoinDCX.
Welcome back. Still continuing to trade within that 80 to 100 point downtick is the Nifty. Getting a quick chart check now. Nagaraj Chetty of HDFC Securities joins in. Nagaraj, good morning. Well, with the Nifty having this 100-point fall, would you buy this dip? Some key levels that you're watching out for on the index and your stock recommendations for the morning.
Hi, good morning, Aman's market. Yes, hit the roadblock around 25,400 level, showing downward correction. I'm not expecting a bigger weakness from here onwards. I think at the lower levels, 25,000 is going to be the strong support, and this correction could be short-lived. In the next few sessions, we could see Nifty bouncing back from the lower levels, from the lower support. At the same time, I have two stocks from a long side. First one is Fintech. Fintech chartically was in a larger downward correction over the last many months. Recently, it has formed important bottom reversal, and the last few sessions upside breakouts is indicating the important turnaround for the stock price from the lower levels. Currently trading around 1125 levels. One can look to buy at this point of time. Immediate upside target would be around 1185 levels. One can place a stop loss at 1075. Second one is the banking side, Federal Bank. Federal Bank has been in a spectacular uptrend over the last couple of weeks. Currently trading around 212 levels. It has broken out decisively above the hurdle. One can look to buy at this current price, and upside target would be around 225. One can place a stop loss at 206.
Take that point, Nagaraj. Thank you so much for joining us. So those are some stocks from a technical angle, but we'll slip into a short break. Our big story comes up next. Welcome back. You're still tuned into Trading Hour. This is the big story for the day. That's the decline in Avenue Supermarts. The stock post its quarter two results. Manglam is joining in now. Manglam, first up, how do you read the numbers and what's the verdict overall?
Well, so if you look at the numbers, you have to look at it in three parts. The first part is the revenue, which is up around 15.5%, which is pretty much in line with what the street was anticipating because the company had given their second quarter update itself. The EBITDA, that had seen a bit of a softness. The EBITDA grew only 11% as against the revenue growth of 15.5%, which implied that there was margin compression. But more importantly, the net profit grew just 2.3%, a measly growth because the depreciation was higher. And at the same time, as was the employee cost and, we saw the finance costs higher too. The revenue mix of the company, 57% came in from foods, which is a lower margin business, as against 56.5%, and non-food general merchandise apparel saw a bit of a reduction in their overall contribution. But despite that, the gross margins were fairly stable, and that's a positive. But overall, these numbers slightly subdued.
But any other important details beyond the headline numbers, Manglam?
Beyond the headline numbers, some interesting insights. The first one is that the revenue per store increased by just 1%, but more importantly, the bill cuts increased by 14%, which implies that footfalls have increased. At the same time, we've seen, basket sizes become slightly smaller, maybe because of purchases decisions, or maybe because of the fact that GST-related price cuts have come by. Employee costs were up 33% because the companies increased their employee base per store and at the same time increased the number of stores as well. And finance costs higher because the company's taken short-term bridge loans to accelerate stores. The important number, the most important number, capex of nearly 1,750 crores, which has been incurred this year as compared to 10% lower the same time last year. So these numbers tell you that the company is looking to transform itself.
What about DMart Ready?
DMart Ready, you typically imply the numbers standalone minus consolidated minus standalone. And out there, the revenue has been close to 16% in terms of growth, but the EBITDA continues to be loss-making because the company obviously is in the investment mode. The important part is they're consolidating DMart Ready operations. Last quarter, they exited one city, and in the second quarter, they exited about 5 cities. So from 26 cities, now they're back to, or 25 cities, they're now down to 19 cities. So while this business is growing, they're consolidating out here their presence and maybe optimizing for which are the more profitable, more growth-related cities. So that's something I'll be watching very closely.
Brokerages are a divided house, aren't they, Manglam? And what's the valuation picture indicating now?
So if you look at DMart from here on, there are three important things to track. One, store expansion because of the capex that they've done. Secondly, impact of GST cuts on sales value in the third quarter because prices of products have come down anywhere between 5 to 15%. And thirdly, DMart Ready consolidation and expansion. How does that pan out? Those are the three theses on which all the analysts have built their estimates on DMart. And now it's a mixed picture. HSBC has a reduced rating, a target price of 3,700 rupees. They're saying that gross margin decline has stabilized, but OPEX actually was elevated. And their key concern remains around moderation in like-for-like growth, given the sort of competition that there is. CLSA, on the other hand, is a high conviction outperformer with a target price which is the highest in the street, 6,300 rupees. They're saying store additions were better year on year. And at the same time, like-for-like growth came in at 6.8%. So they believe that the company is in a transformation phase. So from here on, things will accelerate and improve.
All right, take that point. Thank you so much for explaining DMart's quarter two numbers and the road ahead as well. But with that, we'll move on and talk about market fundamentals and individual names as well. Sumit Rohra from Smartsun Capital PTE is joining us now to discuss just that. Sumit, good morning. Thank you so much for joining in. I was going through your presentation. PSU names, these are some of your bigger bets. But there are always concerns with PSUs, and that's the reason why they do see lower valuations as well. Your take, why you are looking at PSUs and any specific names there as well?
Sure, Sonal. Thank you so much for having me on your show. A very good morning to you and Hormas. And firstly, wish you and your viewers a very happy festive season coming up. So yes, Sonal, the matter of fact is that, there is a space in the Indian market today, which is extremely compelling, is the PSU oil and gas space. I happened to, attend a conference which was hosted by the PSUs, and it was graced by the Honorable Oil Minister, Mr. Puri, and the Petroleum Secretary. They actually came, and, they highlighted, the entire oil and gas thesis. They spoke to about 110 or 20 of us, and, they kind of put to rest so many fears, which today, the sector is, actually grappling with. But the reality of the matter is, Sonal, that if you see the underlying fundamentals of the oil and gas space is only getting better and better over the last maybe 5 to 10 years. So I have actually highlighted some of the data which I would like to share with you. So firstly, if you see, energy is the backbone, of the Indian economy. It's powering industries. It's connecting people and fueling aspirations of 1.4 billion people. Now, see, with the Viksit Bharat 2047 plan of the government, energy self-independence is going to be something which is going to be of vital importance. And that is basically going to, clearly, have excellence for the oil and gas sector. Today, I'll just give you some data before I come to the concerns. Today, India is the third largest energy consumer. It's the third largest LPG consumer. It's the fourth largest LNG importer. It's the fourth largest refining hub in the world. I mean, these are sizable, equations in the energy space today, which India commands. And in fact, if you see the refining cycle as well, it's getting extremely strong, because if you see, that there's a delay in commissioning of the Dangote refineries, the closure of the Lindsey refinery in the UK. So, the Russian refineries are getting offline because of the attacks going on from Ukraine. So net, if you see, the refining cycle is actually, very strong. Utilization rates are moving to nearly 84%, which is about the mid-cycle of 82%. So, you are categorically seeing a refining upcycle, which you saw from the 2015 to 17 period. Now I'll come to the critical aspects of why, these companies, are attractive. See, firstly, that the thing is that, the minister, he started off explicitly saying that, they have got the entire backing of the government. I mean, and he highlighted the various measures, which I will basically come to.
Right. Sumit, sorry to cut you out. We're running out of time here, but if you could just tell us what within the PSU basket are you betting on currently, whether the upstream oil majors, the oil marketing companies, or some other theme within the PSUs?
So as of now, it's more, skewed towards the downstream companies, because if you see, oil is clearly, trending downward. I mean, 70 looks a cap for oil for now, and it should be between 60 to 70. Now, I'll just come to the concerns very quickly. Okay, the first concern is that, competition. Now, if you see today, 91% of the, fuel marketing is basically controlled by the oil marketing companies, and about, 70% of refining is basically by these guys. So they are no way losing any, market share, etc. If you come to the earnings aspect, right? I mean, today, if you see, they have delivered 8.8% CAGR revenue growth with a 9.8% CAGR revenue growth for 10 years, and I'll just give you one data point very quickly. The OMCs have made 250,000 crore profit from FY19 to FY25, but the profit accretion in market cap has only been about 35,000 crores. So on one side, you're seeing a great earnings growth, but on the other side, markets, because of the concerns, has, kind of, not rewarded these companies to the level which other PSUs have been rewarded. Then there was the consistent fear about the LPG under recovery, right? So the minister and the petroleum secretary himself explained that, this is a control product. This is basically the account of the government. So even back in October 22, when these guys were facing under recoveries of 30,000 crore, the government paid them 22,000 crore. What happened then? 14 months later, you see the profit pool of the LPGs became positive. That was in March 24. And now you see they have a 42,000 crore under recovery, but 30,000 crore has already been given to them. So the thing is that there is no concern that the OMCs are going to bear any LPG, which has been clearly stated by the minister on many occasions. Then if you see, how do you value these companies? So actually, 58% of the, the parameter is basically production, revenue and capex, and 20% is on profit ratios. But more importantly, 15% is on shareholder value creation. So clearly the government is basically, looking for value creation in this sector as well. There was such a big disbelief, about pricing, right? I mean, state elections are coming, and I mean, you've seen the government has been so prudent, right? I mean, you had the Bihar election, the code of conduct has kicked in, and, prices are absolutely static because the government doesn't want to play around with the financials of these companies,
Right. Sumit, we had to ask you more questions, but we are out of time on this segment. Thank you for sparing time and joining us with your detailed analysis on the PSUs and within that, the oil and gas space in particular. Sumit Rohra there from Smart Sun Capital. Take a short break. On the other side, we get chatting with Office Space Solutions on the road ahead for the company. Stay tuned. Welcome back. Flashes on your screen. Vodafone Idea's AGR case has now been deferred to post-Diwali. Remember, the Supreme Court was supposed to hear the petition today. And in today's hearing, the Solicitor General has sought more time on behalf of the Department of Telecom. And the Supreme Court has said that they need some specific stand that needs to be taken by the government. And as a result of which, the hearing has now been pushed to post-Diwali. Remember, it was supposed to happen last week. It got pushed today. And today, it's now been pushed to post-Diwali. The stock now 3.5% lower, and another date we hear for Vodafone Idea.
Of course, we'll wait for that date as well. Our colleague Ashmit is tracking this. But with that, let's move on. Office Space Solutions, that is the stock on our radar. The management is joining us now. Amit Ramani, the chairman and MD of the company, with us today. And we'll discuss with the management the potential from new innovation hub in Bengaluru, the expansion that they did in Mumbai recently, potential from first gold center in Pune, and seat addition targets for FY26 as well. Amit, good morning. Thank you so much for joining in. There have been a lot of updates actually recently, but let's talk about the most recent one, which is the Mumbai office. You've expanded here. There is Howden that has taken some of that area on lease as well. 50,000 square feet, which is in Supreme Business Park, Powai. Give us a sense of what does it take your total area in Mumbai to, and out of that 50,000, how much is taken by Howden? What is the occupancy scenario for the rest of it? And what is the current occupancy in Mumbai overall?
Really glad to be here and glad to report that with that expansion of the 50,000 square feet, our total portfolio in Mumbai has crossed about 1 million square feet, right? And this is across 34 locations. So we pretty much cover everything from South Bombay till Thane Belapur Road, and literally have a center in almost a 15-minute driving radius in a city as complicated as Mumbai within that driving radius today for us. Also, in terms of your other part of the question, Howden has taken almost about 65% of that space. So out of the 50,000, almost 36,000 has been taken by Howden. And this continues our partnership and expansion with a lot of GCC clients. In the last, I would say, in the last 6 months, we have signed 11 new GCCs in India, of which Howden is one of them. And so this continues our expansion in Mumbai and many other cities as well.
Amit, good morning. Thank you for joining in. What about Bengaluru, the innovation hub that you have launched there? Two-part question actually. Is it completely occupied by eBay first? And two, generally, what is the timeline for such centers to break even if you have one for Bengaluru as well?
Yeah, so in case of, I'll first answer the eBay part of the question. In case of that innovation hub, the eBay has taken all of the 67,000 square feet that we have signed up in Embassy Tech Village. It is in 2 phases. Essentially, phase 1 went live about a month ago, and phase 2 has gone live this month. And from that standpoint, in case of these type of centers, since the occupancy is kind of happening almost 100% day one, the margins start rolling in from day one itself. I would not want to comment on specific margins, but yes, in these kinds of centers where it's a demand-led supply or a managed office kind of a scenario, then obviously from day one itself, we have the break-even happening. In case of centers where 100% is not taken up, usually what we do is we set up portion of the center as a co-working center, and a large portion in case, for example, in case of Howden in Supreme Business Park, 65% is taken up with Howden. Rest of it is we are running as a co-working center, which because obviously we have limited occupancy to fill, only about 35% it'll fill up in the next 2-3 months. So that's both centers. The margin profile looks really good from day one.
Okay, we take that point. Amit, this is about the existing portfolio that you have in terms of the innovation center. I just want to understand how often, because now IT seems to be the one which is seeing some demand pressure, but GCC is what everyone's talking about in terms of the growth vertical for most of these, your companies from your sector as well. How often can you increase rentals here, and generally for the other parts of the portfolio as well?
So in case of the overall, be it GCCs or our overall portfolio, we typically have 5 to 7% escalation built on a year-on-year basis. Typically on our supply side, the increment is typically between 4 to 5% every year, or 15% every 3 years, right? Which translates to about 4.6%. And this is typically on the base rental, wherein our increase is on the complete services that we are offering. So the GCC clients or our regular clients, they all mimic the similar kind of structure in terms of increment in terms of margins.
Amit, you are also increasing presence in tier 2 cities. It's now grown by around 25%. What are the current number of seats here in tier 2 cities, and what are your expansion plans here? Which segments that you are targeting?
So 90% of the portfolio is tier 1 cities. 10% of the portfolio today of the total roughly 160,000 seats that we have clarity on. So almost about 17,000 seats are in tier 2 cities, and rest of it is in tier 1 cities. As far as the expansion goes, the next new city for us is going to be Vijayawada. We are already in 18 cities, so this would be the 19th city. Post that, we are looking at a few other cities as well on a case-by-case basis, but roughly about 20 odd cities by end of this year is what our target would be.
Amit, what is the size of the mobility vertical currently? How do you plan to scale it up? Any monetization plans here?
Yeah, so the mobility vertical, I think, just to give you a perspective, about roughly a year back, we used to sell about 300 day passes, right, a month. Today, that number is touching almost 18,000 day passes a month, right? So I think from that standpoint, mobility, as a business for us has grown tremendously, especially across day passes, meeting rooms, and virtual offices. This is obviously based on the network, right? We have close to about 235 odd locations that are live today. And those provide these opportunities across seats, meeting rooms, as well as virtual office type solutions. We feel that the business, which probably does about roughly 2 odd crores monthly for us, has the potential to go to about 5 to 6 crores in the next few years.
Now, what about allied services, Amit? How much of your revenue is that? You mentioned that the expansion in margins also comes from there. So how much higher are the yields in this segment compared to the others?
So allied services, basically last year we did about 11% of the overall revenue came from allied services. This year the target is to get to about somewhere around 14-15%. And I think that's where we would like it to stabilize. The margin profile obviously is higher because many of the services come with 100% margin, such as a meeting room seat being used. So from that standpoint, I think we feel that, clearly about a 15% is achievable for this year.
Take that point, Amit. Thank you so much for joining in today with your insights and the outlook for the business going forward. That's the word coming in from Office Space Solutions. But time for a short break now. We'll get you more on the markets on the other side.
Welcome back. Still 100 points down on the index. Let's bring you the latest from the FNO desk. Mangalam is here with the latest data. Mangalam.
Well, you know, the index is actually under pressure in today's trading session, and that's reflected in a lot of the other parameters as well. Not only is the Nifty lower, we have the Midcap index as well, which is not faring as well. And the second part that we're looking at is the IT as well as the FMCG index. The Nifty bank is not falling as much, but is relatively resilient, not contributing much on the upside as well. If you look at the IT index and if you look at the FMCG index, both of them are at near the lows of today's trading session. And that's caused a bit of a decline in the frontline index. Importantly, the India VIX, which had been very benign, has taken a sharp spike as well. So that's something we'll be monitoring as we move towards the next couple of trading sessions. In fact, tomorrow is the weekly options expiry too. So the India VIX is up around 10.5%. And the market breadth tells you that all portfolios aren't feeling very good today. 1,900 stocks which are declining, for just about 900 stocks which are in the green. Active Nifty options tell you that the street still believes that we're in a bit of a range. The 25,200 mark, which was a bit of a resistance all of last week, barring Friday, still now becomes an important support. So 25,200 call and 25,200 put. Both of them are equally active. The street hopes for a 150-point range on either side of 25,250. So 25,350 would be an important resistance. At the lower level, 25,050 would be an important support coming in. Below that as well, the 25,100 put writers equally active. So 25,000 is now an important support for the Nifty. A lot of individual stocks are, seeing fresh bids on the long side, and MCX is one of them. But a lot of shots on, Siemens and Keynes Tech have been built in today's trading session. So those are a couple of stocks I'll be watching out for too. And finally, Tata Elxsi. That's a stock that may enter FNO band, very high on the threshold level. So just keep an eye out on this one.
We'll do that. Thank you so much, Mangalam, for bringing us all those FNO trends. With that, it's a wrap on Trading Hour. But stay tuned. Halftime Report is up next with all the market action.
Co-powered by SBI. Best है सबको पता है. In association with Think Equity, Think Motilal Oswal. Co-powered by SBI. Best है सबको पता है.
Stocks trade soft after the US-China trade tensions erupt over the latter's rare earth curves. Though Trump tries to temper concerns, consumer durables, FMCG and IT are the big losers, even as financials manage some green.
Avenue Supermarts slips after its like-for-like growth tempers and margins crimp amid rising competition. DMart Ready also consolidates, pulling back operations to 19 cities from 24 in Q1.
Despite the strong investor interest in the IPO, Tata Capital sees a muted listing with the stock opening at 330 rupees compared to the offer price of 326, implying a listing gain of a little over 1%.
Silver scores a new high on the back of strong physical demand across several countries, including India, where the precious metal trades at a premium. In London, two short covering drives price up amid tight supply. Hello, good afternoon. You're tuned into Halftime Report coming live from the CNBC-TV18 Motilal Oswal studios. I'm Vinny Motiwala. With me is Mangalam Malu as well. Mangalam, good afternoon. And today we're seeing, bit of a red screen coming in today. Not as much as the Nifty implied open was indicating, but we're still down in trade today. 3/10 to 0.4% of decline, what we're seeing coming in for the Nifty 50. So that is what we'll watch out for in today's trading session. Other than that, advance decline ratio also today is in the favor of declines versus advances. So keep an eye out on that, because clearly that is indicating that even the broader end of the market is not doing well. Look at it. We have around 1,900 stocks on the decline side versus 800 stocks on the advances. Mid-cap, small-cap, both down almost 0.4% as well. Banks, that's managing to hold on to some bit of a gain, at least slight green coming in for Nifty Bank today, Mangalam.
Yep, and that's where the optimism is coming from, because, the Nifty had been facing some congestion between this 25,180 to 25,200 mark all the way until Friday. And then Friday, there was a bit of a breakout. We closed above that 25,200 mark. In fact, we also touched that 25,300 mark. So in technical terms, what was earlier a congestion could now become a support. And that's what we've been seeing all through today's trading session as well. So until this 25,180 to 25,200 sort of zone breaks, we will probably see the Nifty consolidating here, and maybe with the Nifty Bank recovering a little more, we could see a bit of an upside from current levels as well. So that's something that the street will be watching out for fairly closely. A couple of these banks from the broader markets doing a lot better as well. The Nifty Bank, mind you, has been pulled lower by a couple of these heavyweights like HDFC Bank. But look at the beneath the surface names. We have Federal Bank, which has moved higher. Axis Bank, which had sentimentally negative news, also has recovered from the lows, and we are seeing some traction on names like ICICI Bank as well, and we are seeing a lot of purchase in the financial space too. So Bajaj Finance, Shriram Finance, all of them higher in today's trading session. Speaking about stocks which are higher and lower, let's bring in the movers and shakers segment, where we track a whole host of stocks which are buzzing in trade. First up, Vivek joins in for all things Waaree Renewable. Vivek.
Well, that's right. So this is the solar EPC arm of the Waaree Group. So Waaree Renewable Technologies is the company that declared its results over the weekend. Solar EPC arm, in line with what most of its peers are expected to do. It's been a very strong quarter for the company. Revenues higher by almost 48% on a year-on-year basis. EBITDA more than doubling, 2.2 times higher, in fact, on a year-on-year basis, close to the 158 crore mark. EBITDA margins expanding over 650 basis points, and profitability more than doubling. This company's order book quite strong. Unexecuted order book stands at over 3.4 gigawatt peak, and the company says the execution will be done over the next 12 to 15 months. The bidding pipeline too very strong. Over 27 gigawatt peak is what the company is anticipating as far as the unbidded projects so far. Now, again, capex plans too quite steady. Company is going to go ahead and set up investments for 28 megawatt power IPP solar power plants of 14 megawatt each, and this will be done at 2 locations in Maharashtra. And the capex over there too has been approved by the board. So overall, strong set of numbers. It will be interesting to see whether the companies can sustain this in the light of upcoming competition.
Okay, Vivek, thank you so much for that. As of now, Waaree Renewables is managing to hold on to gains of 9%. But we have Fintech. That's also in focus today. So Darshan is joining you with us to give us details on this one.
There is a sharp up move that we are seeing in Fintech after Citi has come out with a note upgrading the stock to buy and target. It has given of rupees 1215 per share, implying an upside of almost 10% from current levels. It's saying that company is well positioned to benefit from strong mutual fund flows and also presents increase in the number of international clients. And it's going to be aided by Ascent's global capabilities and near-term strength that we are seeing in the primary markets. Unlike CAMS, KFIN is going to benefit from lower pressure of telescoping pricing. Also, it has a higher share of smaller clients, and it continues to augment its product capabilities, and that will be driving revenue diversification. But despite having a positive stance on the stock, it said the overhang of promoter stake sale persists for KFIN Technologies.
Okay, thank you so much for that, Sudarshan. But let me take you all through BLS International. That's the one that's tanking in trade today. Now it's down 9%. At one point of time, it was down almost 13 to 15% as well. What is the reason behind this? Now, the Ministry of External Affairs of India has actually restricted the company from participating in new India mission tenders for a period of 2 years. The company has come out with a clarification saying that this development will not impact their current financials or ongoing operations. Existing contracts that are there of Indian mission across the globe will remain valid, and no significant impact in terms of the financial outlook. But do not forget that India missions, these tenders actually contributed to 12% of the consolidated revenue, while in terms of the EBITDA, it's almost 8% of the EBITDA as well. So a huge chunk that comes in from here. But what is the validity in terms of renewal of contracts? What is the outlook in terms of growth? That is what is going to be important to understand from the company as well. And we'll be joined by the management also in a few minutes from now. So that'll be interesting to know, Mangalam. As of now, almost a 10% decline is what we're seeing coming in for the stock right now.
All right, a 10% decline on BLS International, what the management says will be extremely crucial. But let's go across to Vivek, who has a bunch of other stocks which are moving around in trade.
Well, thank you so much for that. A whole lot of news flow, whole lot of results. We also saw quite a lot of upgrades coming in. So markets as well as stocks reacting quite positively to that. But a whole host of other stocks on our radar as well. Have a look at Pacma India or C Infosystems, one of the top gainers as far as the broader end of the markets are concerned. Very strong volumes. Along with that, you've gone ahead and actually seen Ashwini Vaishnav go ahead and endorsing this particular name, company's brand Maple, clearly benefiting from that positive sentiment as well. Jubilant Ingreva is the other stock, one of the top gainers as far as the NSE 500 index is concerned, higher by 7%. Important to watch as far as this particular name is concerned would be the export data, especially when it comes to the agrochem and pharma pack. So on the back of that, almost 7% higher. Fortis Healthcare, one of the top gainers on the F&O space. Now, despite the fact that you actually saw the open offer being well below the CMP, this particular stock continues to see higher moves. And MCX, again, this particular stock, especially in the week gone by, has been a significant outperformer. Today continues its up move higher. And GM Brewery's very strong set of results as far as Q2 is concerned. Follow-on buying scene after the strong up move seen immediately post the results. On the other hand, on the list of stocks, seeing some selling pressure. Look at the entire IT pack. Most of the names down anywhere between 1.8 to 2.5%. Persistent info. So all of these names under pressure today. GK Energy, sequential softness seen as far as the Q1 results are concerned, stock lower by 4%. Keyence Technology will be interesting to see what exactly has transpired over here. The stock saw significant underperformance on Friday. Today, again, another 4.5% lower. And Minda Corp, after a while, amongst the top laggards as far as the NSE 500 index is concerned.
All right, we take that point. Vivek, thanks a lot for that. Meanwhile, while we were talking about the bottom, the moving stocks, the bottom of your screen was fairly buoyant, because we have sources telling us that Relicare will list their subsidiary, which is Care Health Insurance, for which the valuation, our colleague, I suppose, Yash has gotten the details. It's close to 16 to 17,000 crores, almost $2 billion, on which Relicare owns about 62% stake. That'll be very interesting, because Relicare's own market cap is currently 8,600 crores. And if it looks to unlock value in a business of which it owns about 2/3 and look at it nearly $2 billion, then that could be an important way forward from a value unlocking standpoint for Relicare. And the stock, understandably, while still in the red, has seen a recovery from the lows, now sitting with a cut of just 1% as against when the story hit the screens, the stock which was lower by over 2%. So 16 to 17,000 crore as a valuation for their subsidiary, of which Relicare owns about 62% stake, are the key data points that we'll have to watch out for. But as promised, let's take a short break, and on the other side we have the management of BLS International. Welcome back. A bunch of stocks now seeing some bit of fresh buying. Federal Bank, which we pointed out earlier, and look at Phoenix Mills. Good update coming in for the second quarter, but more importantly, the third quarter looks extremely strong for them. So that's something we'll watch out for. L&T Finance and Godrej Properties are the others which are moving higher as well. Let's put the spotlight then on the cement sector. Nigel's joining in, standing by the wall to tell us what we should expect in our special Quarter Se Quarter Tak.
Well, that's right. Today, we're breaking down the Q2 FY26 earnings preview for the cement sector. A quarter that's marked by strong EBITDA growth despite soft volume trends. Let's dive into the key drivers then. First up, the cement sector is expected to post a strong 50% year-on-year growth in EBITDA. That's going to be supported by around 5 to 6% year-on-year increase in cement prices and benign input costs as well. This comes on the back of a soft base that we saw in Q2 FY25. However, the volume growth remains muted, which is eating partly into the benefits of improved pricing. Industry-wide volume growth is expected to remain under 5% or around 5% on a year-on-year basis, which is continuing the weak trends that have been observed over the last few quarters. This has been impacted by heavy monsoon season, an early festive calendar, and dispatch disruptions in the lead-up to September 22nd, when the GST rates were revised. That said, M&A activity has supported volume growth for some players among the large names. UltraTech and Ambuja Cements were there expected to lead with volume growth of around 10 to around 15%, thanks to the recent consolidations that we have seen in both those two names. Among mid-caps, JSW Cement as well as JK Cement, they could post as well 15% and around 10% growth respectively. On the weaker side, Shree Cement, Dalmia, Nuvoco, all of them are expected to see sub 5% volume growth, and Ramco, there's a chance that it could possibly report a flattish to a mildly negative number as well for the past quarter. Sequentially, the industry EBITDA per ton is expected to fall by around 200 rupees, could come in closer to around 900 rupees, around 880 rupees per ton. That's because of the modest price correction, seasonal cost uptick, as well as weaker operating leverage. Though on a year-on-year basis, the EBITDA per ton will look much better. The pet coke prices, they have started rising, but the full impact of this will only be seen in the fourth quarter. This could also set the stage for another price increase, which could effectively come in the second half of November itself. On the EBITDA per ton front, going by company-wise, well, UltraTech, the EBITDA per ton could dip to sub 1,000 rupees per ton. Shree Cement, with its focus on North India, it could clock the highest EBITDA per ton at roughly around 1,200 rupees per ton, while JK Lakshmi is expected to show strong improvement of a low base. However, Ramco's EBITDA per ton may improve by only around 120 rupees, but the overall EBITDA growth could be limited to just 15% growth because they'll be hurt by lower volumes. Well, from a valuation standpoint, while earnings momentum is strong on a year-on-year basis, well, investors will need to watch closely for sustainability of price hikes, volume recovery post the monsoon, and margin resilience as well, as fuel costs have hardened a little bit.
Okay, Nigel, thank you so much for that. We'll keep an eye out on those expectations from the cement sector this time. But on that note, we're going to slip into a very short break. On the other side, we'll have the management of BLS International.
Welcome back. You're watching us here on Halftime Report. The casualty of the day on the stock market is BLS International, under pressure after the Ministry of External Affairs has temporarily restricted the company from participating in new Indian mission tenders for a period of 2 years. The stock opened sharply lower. From there has been a bit of a recovery because this business contributes about 12% to their revenues. Just before we go across to Shikhar Agarwal, who's joining in, let's look at some of the footage coming in from Donald Trump, his visit to West Asia. So he's landed out there. Obviously, this morning there were, all right. So we will obviously get you some more footage out there, Trump in Israel. But let's continue our conversation with Shikhar Agarwal, who's the Joint Managing Director, BLS International, who joins in. Shikhar, thank you so much for joining in. Most importantly, what is the reason given by the Ministry of External Affairs for debarring this? And what is your next course of action from here on? While it contributes about 12% to your revenues and your current state of affairs does not get impacted, for the next 2 years, you cannot bid for any orders. Was there any particular reason that they gave it?
See, we have been working, the company was started with the Indian government. We started working in the year 2009. So this was, a procedural issue. There were some consumer complaints or something. Those were the reasons that were given. So, that is why we had declared it to the market on Saturday when we received the letter. So I feel that, in the first quarter, around 12% of our revenue was generated and around 8 to 9% of our EBITDA was generated through the business that we do with the MEA. But none of this business is going to be impacted. All of the revenue and EBITDA are going to retain in the company. All those contracts are valid from 2 to 5 years. This circular restricts us temporarily for bidding for new contracts for the Indian MEA that will come out maybe not right now, whenever they come out, but we are actively working with the authorities to resolve this issue.
Wait, you said that it was on account of some customer complaints because of some of the services. Can you elaborate upon that?
See, we work globally in for 70 plus countries, and we are working with different 40 plus governments. So there were some, maybe there were some complaints in some other countries for procedural issues, etc. But we are working actively with the authorities to resolve this issue.
What was the nature of those complaints? If you could elaborate once again on that, what were those countries that complained? Because while if they were procedural, it would not immediately, cause the Ministry of External Affairs to debar you.
Correct. So that is what we are trying to analyze, and we are working actively to resolve this issue with them. And I don't see any impact on our revenue, etc. We continue to maintain the growth momentum. Whatever discussions we had in the last few quarters, we continue to actively remain focused on that.
Right. Shikhar, you said that, right now there are some contracts which are there, will continue, and they're in a period of 2 to 5 years. Any contracts that are coming for renewal right now, and do they come at risk as well with the MEA? Is there a concern on that front then?
No, actually, as I said, that we are actively working to resolve the issue. And I'm confident that whenever the new set of tenders come in, we will be able to resolve the issue. We are actively trying to solve it. And as I said, in the first quarter, the revenue that is generated is only 12% and 8% of our EBITDAs. And we are working with more than 40 client government in 70 plus countries. We recently won a big contract with UIDI also, the Gaza authority, which will start getting deployed in the next few months, which is a 2,000 crore contract. So we continue to win tenders, and as I said, there's a big pipeline of $1.5 to $2 billion tenders that we are bidding globally. We recently won contracts with Poland, Hungary.
We get all of that, Shikhar. We get all of that. Just keep it very simple for now. For this issue, over the next 2 years, what amount of your existing contracts come up for renewal?
See, as I said, out of this, the merge that we are doing with the MEA, 12% of our total revenue in the first quarter contribution and 9% of our EBITDA came.
That we got. What proportion of this comes up for renewal?
Correct. So I'm saying that the contracts are of different duration. Some contracts are for 2 years, some are more than that. So these contracts have a renewal cycle of 2 to 5 years. They're different tenders. The Indian government comes out with the embassy-centric tender.
Shikhar, what about global clients, right? Because if there's an issue which your own government, your home country government is raising, does this give a concern on the global front as well? Because those global clients or whoever global governments that you are tying up with, is there any concern or worry that one should watch out for now?
See, we are the only Indian company in this business globally, and we have attained a market share of 17% globally, and we work with more than 40 governments now. Even with the government of India, I'm confident that we'll be able to resolve the issue. We are actively working on it. With the global governments also, we have an open conversation with them, and it's a transparent manner. And this is the letter that we have received. We have informed everyone, even to the exchanges, and we are working towards resolving it. And I'm confident that we will be able to resolve it. So I don't see any issue.
We'll come to modalities on that one in just a bit. You're speaking about the global company, etc. There is global peace for now. Right now, we're finding visuals of Trump in Israel shaking hands with Netanyahu, and there is a peace deal that has been signed for now. So that's good. All is well. U.S. President in Israel. But let's go back to our conversation. You said you are hopeful of resolution on this one. Shikhar, can you give us a sense on by when? Do you have a timeline?
I think we are working on it to resolve it ASAP. I don't know exact timeline, maybe in the next few months, ASAP, as it is possible. We are going to rectify if there was any specific issues. And I'm confident that we will be able to, again, work on the future contracts with them. And globally, as I said, we're actively bidding, and we have recently won these contracts with UIDI, etc. So our growth momentum and our trajectory continue to remain strong.
Right. Shikhar, in Q1, you've managed to see 44% growth. Last Q4 FY25 was also 50% growth. Now, if you're saying that, in Q1 FY26, 10 to 12% of your revenue came in from Indian mission tenders, what is the growth outlook over there now? For the rest of the year, what would be the growth story?
See, as I said, whatever numbers we've achieved in the first quarter, our target is to maintain those numbers. We are staying, since we are in a silent period for quarter two, I cannot comment on that, but we continue to see strong growth momentum, in the next few months and in the last few months as well. And the next few years as well, with this new contracts that we have won with UIDI, etc., which are still to be deployed, revenue will start coming into the company. So our growth trajectory and the growth momentum will definitely continue.
Right. Shikhar, just one word. What is the margins that actually come in from these Indian mission tenders? Could you just give us what is the range of the margins from here?
Yes. As I said, 9% of our EBITDA came from the contracts with the Indian government.
So the percent of EBITDA margin would be what, around the 28% range? Is it higher, lower in terms of contracts?
How is it? It would be probably a little lower. I need to exactly check how much it was, but definitely it is lower.
And what does this do to any of your inorganic growth plans? I remember you had visions of, becoming the largest, much beyond what, say, your competitors, peers, VFS and the likes would do as well. What does this do to that? Is it a speed bump?
See, our vision has been steady fast from 2009 when we started the company. We acquired 1,200 crores worth of companies last year. We already have around 1,400 crores of cash again on the books. We are actively looking at inorganic opportunities. As we said, we have an M&A team, but we will not take any brash decisions. We are looking at, our multipliers, what companies we can buy, can add synergies, etc. So those kind of companies we're looking at, and definitely we feel that we are fully on our trajectory of growth, and we are an international company, so we are working towards that.
And, just one more bookkeeping question. You said that this business accounts for 12% of your revenue in the first quarter. As a proportion of your current order book, how much is it?
It's the same. You mean the order book? I didn't understand.
Yeah, so basically you have orders which you execute, right? So I wanted to know if there is any lag in the revenue execution and the order book right now.
Oh, no, it's already coming into account. First quarter we got.
Okay.
Yeah, it is. Probably, definitely as the contracts with UIDI, etc. and other governments start coming in, this revenue contribution will be a little more lesser in the next few years.
Okay, Shikhar, thank you so much for joining us on the show and patiently answering all our questions. Hope we speak to you once the resolution comes as well, or more clarity on that front. We'll watch out for that. Thank you so much, Shikhar, for joining in with us. As of now, the management is highlighting that, this is not going to impact their business in the near term. They're in talks to get in terms of resolution from the MEA side as well, in terms of the complaints that were filed. But let's move on, and we have Religare that's in focus, right? We highlighted there, and that is likely because the company will be looking to demerge the health insurance business into a separate listed subsidiary. Yash is joining in with us now to give us more details on this one. Yash.
Well, what we're given to understand is that there's a major restructuring process which is likely to be undertaken at Religare Enterprises. The biggest part of this restructuring process, according to our sources, is expected to be a move where Religare Enterprises, under a scheme of arrangement through a share swap ratio, lists its health insurance subsidiary, that is Care Health Insurance, directly on the exchanges. What we've been given to understand is that the plan to sort of put Care Health Insurance under this share swap ratio and list them directly on the stock exchanges is likely to be firmed up and announced by the next quarter. Importantly, what makes this move interesting is the valuation of Care Health Insurance itself. Very recently, about a couple of months ago, a rights issue was conducted towards Care Health Insurance, and that valued the company at about 14,500 crore rupees. According to our sources, as far as this direct listing of Care Health Insurance is concerned, through the share swap ratio, that could value Care Health Insurance anywhere between 16,000 to 17,500 crore rupees. That is similar to what its peers listed at about 6.5 times price to book value. And importantly, Religare's own market cap is about 8,500 crore rupees, which is nearly half of what its health insurance subsidiary, Care Health Insurance, could get through this particular listing. Religare, importantly, owns about 62.8% stake when it comes to Care Health Insurance. This is the biggest piece as far as the restructuring process is concerned. Apart from that, we've been given to understand that Religare Enterprises will, after the listing of Care Health, will focus on broking and lending business. And there are certain important appointments which are expected to be made over the next 2 to 3 months. These would include the Chief Compliance Officer, the Chief Company Secretary. All those appointments as a part of the cleanup exercise and the restructuring process expected to be made over the next 2 to 3 weeks, and the important piece thereafter of putting Care Health Insurance under the share swap ratio and listing it.
Take that point, Yash. Thank you so much for that. With that, we'll take a short break. On the other side, Manisha Gupta joins in with Chirag Thakkar of Amrapali, Gujarat.
Welcome back, and Chirag Thakur of Amrapali, Gujarat now joins in to have a conversation on silver rather. Chirag, hi. First of all, your sense on prices. We're trading at an all-time highs yet again today with the kind of run-up that we've seen, 78% of gains in this year till time. How are you looking at the price movement from here on?
So we have already reached our targets, what we were anticipating that it can come at these levels. But at these levels, liquidity crunch in London markets are actually driving the prices crazy. And if we sustain at these levels above $50, we could see some crazy moves where we can see $55 and down the line maybe $60 before this year end as well.
So the volatility clearly continues. I just want to go back to your point of liquidity crunch, Chirag, and that really seems to be a bit of a concern because there are short sellers and they can't roll over. If they have to get silver out of New York, there's a premium to that as well. How are the international markets working right now?
So we are almost the New York markets are trading at discount, London markets at a premium of more than $2, and it's crazy because there is a short squeeze between the trades happening globally, and every ETF, global ETFs, Indian ETFs are actually buying, and that there's a big retail buying happening. So I think that is actually making things more worse in the current scenario.
Chirag, how's the situation with the Indian market? The Indian ETF situation we do understand because silver is available at a premium, so the prices are at a premium as well. But you deal very, very strongly with the physical part of it as well, digital silver as well. How is physical and then digital doing?
So we have seen a crazy jump in physical demand, and over and above, when I'm speaking to my clients, what feedback I'm getting is, come what may, we are looking at 200,000 INR for the prices, and we just want the metal. So it is more of an investment demand coming from the market. At the same time, digital silver has actually crossed our markets, and I'm usually the kind of a ratio what we have on our digital platforms on gold and silver. There is a big gap over to it, but now we don't see any gap. Silver is winning over the digital, and we have lots of deliveries of small bars happening. A 1 kg bar is most famous bar, which is actually going on the deliveries on the retail side. So that is actually giving us a data wherein a retail buying, a retail investment is actually coming onto the platforms.
Chirag, what is your sense on how much silver could India be importing this year? Because the average is 4.5 to 6.5, 7,000 tons really. What number are we looking at for this year?
Will be near to the same average, which I've been telling since the start of the year. But I didn't know that there's going to be a situation. But at this prices also, we'll be averaging it out around 5,500 tons at least.
You say retail buying, investment buying has been quite strong. Digital buying has been on the higher side as well. Is there what is the kind of premium that is running right now today for the silver markets?
We are trading at more than $1.5, $2 over the spot market.
And what would that convert to in Indian rupees?
That is around 14,000 to 15,000 rupees over the MCX price.
Chirag, do you see this lasting long enough? I mean, we understand this is a disrupted market, even a bit of a damaged market right now on where it stands in global and Indian sphere in that sense. How long can this condition continue?
I think we will get a normal situation. Normal premiums will be back by next couple of weeks or maybe 3-4 weeks down the line from here. But the climax would be, let's say, if the situations get back to normal and we are back to, let's say, $55 of making a high. Again, the premium and the actual relative price which comes to the buyer's hand is going to be the same, I believe. If we have the same surge happening, the premiums go down. At the same time, the price is at the same level. So I think as a buyer, Indian market has actually shown that come what may, let's say even if the premiums are high, if the premiums goes down, the spot price is going to go up again. So we're going to be at the same levels of the prices in terms of INR what we see.
A quick one, Chirag, you said $55, $60 an ounce on the higher side is where silver can be. If it does see a correction, where do you see support come in?
last week we saw support at $46. During the before London Open and Hong Kong market actually gave a small correction, and there was a very small correction which just came in, and there was a deep, and again there was a buying, and we were back to $50 by the time New York came in. So I believe $46 would be a base correction. If it might come at those levels, we think there are a lot of buying coming on those levels.
Oh, absolutely. People are just waiting on the sidelines to do a buying. And today as well, silver is trading 3% higher. It's a record high. And when you look at those silver ETF, they are up anywhere between 3 to 5% as well on your screen. So a bit of a premium continuing even in the markets today. Chirag, as always, thank you so much for joining in and making perspective on what really can be anticipated in silver and what really seems to be playing out in the Indian and the international markets. With that, it's time for a short break. We come back and talk about stocks and market specifics.
Welcome back to Halftime Report on CNBC-TV18. In the last hour, we have seen more of these AMC names seeing a bit of a further uptick coming in, whether you look at ABSL, AMC, Motilal Oswal, all these are buzzing in trade. Other than that, Minda Corp, that's also picked up some bit of a pace. But what are we watching out for in the world of F&O now? What are the levels we should be keeping an eye out on? Let's go across to Mangalam, who's at the F&O desk, to give us those details.
Well, the Nifty is down about 100 points. It's around the 25,180 mark. And the reason for that is because the key components aren't participating as much. In fact, the Nifty IT is dragging it, and the Nifty Bank isn't going as high to be able to support that decline. So, which is why we have the Nifty, which is lower by about 102 points. Though nothing really to worry out here. But under pressure are also the Midcap index and the FMCG index. So that's something that we will monitor as we move further into the festive and the result season as well. But importantly, the India VIX as well, which was closer to levels of 10, benign levels, has now climbed 10% higher and now has moved to 11. So we'll monitor how the impact of this plays out on tomorrow's expiry, for which people are still riding straddles. What is a straddle? A call and a put together. So those who are writing the 25,200 call are also writing the 25,200 put. Both of them have an equal amount of jump in the open interest. 2.23 crore is what we've seen in the open interest of 25,200 put, and around 2.5 crore is the open interest in the 25,200 call as well. All of this tells you that the street is playing for a 100-120 point range around 25,200. So which basically means support would be around 25,100 and resistance around the previous day's high, Friday's high of around 25,300. So the range of the Nifty, which was earlier 25,000 to 25,200, has moved higher to 25,100 to 25,300. That's what's taking place over the last couple of trading sessions. But in the last hour or so, we've seen some fresh shorts built up on Syngene as well as Havells. The other one, which is in focus, is Fortis Health as well as Federal Bank. So the financials are doing fairly well, and the Nifty Bank, which is falling, is because of a few heavyweights. Federal Bank is fairly well bid, and Fortis Healthcare continues to do well, has seen a lot of long build up in today's trading session. So watch out for that one.
Okay, Mangalam, thank you so much for that. We'll keep an eye out on those names as well. Other than that, we'll keep an eye out on CE systems as well. That's MapMy India. A lot of exchange that's happening in terms of expos, where, we had Ashwini Vaishnav, who actually said that, Maples by MapMy India is a good feature and they must try it. So keep an eye out on that one. The stock is buzzing in trade today, as of now, also managing to hold on to 6% gains. But on that note, we're going to step into a very short break. Don't go anywhere. More stock-specific action on the other side. Welcome back to Halftime Report on CNBC-TV18. A quick check in terms of what the market is doing. Nifty 50 as of now is down 94 points, almost a 0.4% of decline. That's where it's been since the get-go. After that sharper fall, it's recovered. But yes, 0.4% of decline is what the Nifty is continuing to see. The bank, Nifty Bank, that's flip-flopping between the red and the green, but still better than the benchmark indices or the broader end of the market as well, because Nifty Midcap, that also continues to be under pressure, down 0.2% in today's trading session. Keep an eye out on that. But with that, we're absolutely out of time on this edition of Halftime Report. Thank you so much for tuning in. Up next to Business Lunch.
Co-powered by SBI. बेस्ट है सबको पता है. Co-powered by SBI. बेस्ट है सबको पता है. In association with Prakash Surya Steel Tubes and Pipes and Hindware Italian Collection, designed for Sukoon.
Stocks are trading soft after the US-China trade tensions erupt over the latter's rare earth curbs, although Donald Trump tries to temper the concerns. Consumer durables, FMCG and IT are the big losers, even as financials manage some green. The stock of DMart owner Avenue Supermarts slips after its like-for-like growth tempers and margins crimp amidst rising competition. DMart Ready also consolidates, pulling back operations to 19 cities from 24 in the first quarter. Despite the strong investor interest in the IPO, Tata Capital sees a muted listing, with the stock opening at 330 rupees compared to the offer price of 326, implying a listing gain of a little over 1%. Silver scores a new high on the back of strong physical demand across several countries, including India, where the precious metal trades at a premium. In London too, short covering drives prices higher amidst tight supply. Gold is shining like gold. Silver is shining like gold as well. It's a rally of the precious metals. Good afternoon. You're watching Business Lunch. We are coming to you live from the CNBC-TV18 Motilal Oswal studios. I am Hormus Fatakia. Markets are taking a bit of a breather after two very good weeks that the indices had, and that propelled the Nifty past the mark of 25,000 as well. So some bit of consolidation coming in, and since opening, the index has traded in this very narrow band of an 80-point fall to 100 to 120 point fall. It has not gone beyond those levels, still managing to consolidate around or below that 25,200 mark, finding support at that 25,150 level on the downside. The Nifty Bank, though, has been the one that has ensured that the Nifty does not break below that range. Had a dip at the start, but since then it has recovered almost or well over 200 points from the lows of the day, and it's holding about the flat line, still holding on to levels of 56,500, which is another positive. So it will be interesting to see where the Nifty Bank goes in the second half of the trading session, and it will be that will determine where the Nifty moves towards the close of today's trading session. The broader markets, they were fairly in similar lines along with the benchmark indices at the start of the trading session. Same trajectory for the mid-cap index as well, 0.3% lower. The small-cap index also down 0.5%. The activity lies in specific stocks. Before we get to that, I just pull up Tata Capital, the listing of the day, India's biggest IPO of 2025 so far. And after a subdued response to the IPO, it's currently trading around about the listing price itself, listed at 330, still at 331, 1.5% higher on Tata Capital. But a stock that was in focus earlier in the day, reported results over the weekend, is Avenue Supermarts, the parent company of DMart, after its results. And now the stock is down to the lowest point of the day. Mangalam is here to tell us more on that. Mangalam.
Well, the street did not like the EBITDA performance of DMart because the revenue was largely in line with the subdued second quarter update that the company had given already. 15.5% on a consolidated basis. The company's same-store sales growth are rough around 1% mark in terms of expectations. It was below par, but the stock price had adjusted for that. So now there are only two things we have to look at: EBITDA margins as well as the net profit. Net profit too grew at just about 2.3% for DMart, and this was largely on account of higher depreciation and higher finance costs, where the company, has been expanding their store network. Employee costs also were higher this time around, as they've increased the number of stores and increase the number of employees per store to improve service levels as well. So the street is divided on DMart's numbers this time around. Even as the stock is at the low point of trade, some believe that the company is in a transition phase as it battles competition from quick commerce, expands its own network, and battles high valuations as well. While some say that competition and the high valuations stand as headwinds in front of DMart. Today and the day the second quarter update came, the stock saw a bit of a decline, and that's largely on account of the reported performance as against what the street's expectations for the next couple of quarters are for DMart.
At the lowest point of the day now is DMart, 2.5% lower. Mangalam, thank you for that update. Now, BLS International fell and then recovered slightly from the lows after the Ministry of External Affairs debarred the company from participating in any future tenders for the next 2 years. The management told CNBC-TV18 that they are confident of resolving the issue soon, and there will be no notable impact on the business. Now, moving on to the big listing of the day, of course, as I mentioned, Tata Capital, it was a flat listing. Let's also listen in to what the management of BLS International had to say.
There were some complaints in some other countries for procedural issues, etc. But we are working actively with the authorities to resolve this issue. I don't see any impact on our revenue, etc. We continue to maintain the growth momentum. Whatever discussions we had in the last few quarters, we continue to actively remain focused on that.
And now moving on to the listing of the day, Tata Capital. It was a flat listing, 330 rupees a share. The stock continues to trade around those levels itself. And post the listing, the management did speak to the media. CNBC-TV18 asked them about the company's growth plans. Listen into what the management had to say.
If you look at our portfolio, we are present in all segments. We have multiple engines for growth, whether it is the consumer business, whether it's housing, whether it's SME, or it is corporate. So we have believed in a strategy of using multiple engines for growth, and we will continue to do so in the future too. It gives us a big advantage. Even if one segment is not doing well, we have an ability to go conservative in that area and accelerate the other areas so that our overall growth rate does not get impacted. That we do believe helps us in creating a model which is resilient both on growth and quality. We do believe that we know our business well, which we have demonstrated by ensuring a strong growth rate as well as a strong portfolio quality. And that is the reason 99% of our book is organic in nature, and we would like to continue that strategy in the future. Fintechs are playing a big role in the Indian economy. We do partner them for better operating efficiency, but as far as origination is concerned, we want to remain largely organic in nature.
We'll take a short break here on Business Lunch, but before we do that, a quick programming note. If you're looking for the big bets and market themes for this festive season, CNBC-TV18 Access gives you a direct access to Helios Capital's Samir Arora as he shares his winning market themes and actionable investment strategies. Ask your questions live on the 16th of October at 2 p.m. Become a member today on the CNBC-TV18 app or log on to cnbctv18.com/access/plans. Welcome back. It is a historic day for West Asia as the US brokered ceasefire comes into effect with the release of all remaining Israeli hostages and about 2,000 Palestinian prisoners. Palestinian prisoners are being taken from a high security prison in southern Israel towards the Gaza border. Now, on the other side of the border, a convoy of Red Cross left with Israeli hostages towards the hostage release site. Now, armed Hamas members are preparing to welcome nearly 2,000 Gazans held in prison across Israel since the 7th of October 2023 attacks. Meanwhile, US President Donald Trump has just arrived in Israel ahead of the peace summit scheduled in Egypt's Sharm el-Sheikh later today, where 20 world leaders will decide the fate of Gaza. Now, relations between the United States and China continue to seesaw after announcing a 100% tariff on China on Friday. Donald Trump late on Sunday took to Truth Social and wrote, "Don't worry about China, it'll all be fine. Highly respected President Xi just had a bad moment. He doesn't want depression for his country, and neither do I. The US wants to help China and not hurt it," end of quote. In fact, while speaking to reporters on board the Air Force One, he reiterated that the US has a great relationship with China and expects the issues to be resolved. Listen in.
I think we're going to be fine with China. Look, I have a great relationship with President Xi. He's a very tough man. He's a very smart man. He's a great leader for their country. He's a great leader. And I have a great relationship with him. I think we'll get it set. I know what happened. I really understand what happened, and I'm not even saying he's wrong. But then we met him with something much tougher than what he did to us. Again, because of the tariffs, it's much tougher.
Meanwhile, China has retaliated, calling US President Trump's latest tariffs on Chinese goods hypocritical and defended its curbs on the exports of rare earth elements and equipment, but stopped short of imposing new levies on US products. We'll take a short break. More news and updates on the other side. Stay tuned. Welcome back. Now, India's September CPI inflation data is due to be announced later this evening. A CNBC-TV18 poll sees the figure coming in at 1.5%, but core CPI is likely to stay above 4%. Lata is here with more on this. Lata.
Well, if it is 1.5, it's a very important number because remember the MPC's mandate is to keep inflation between 2 and 6%. So actually falling below your own mandated number. I'll just, for the details, give you the food and core number. Food is the big culprit, which is bringing down inflation. The pleasant culprit, if you please. Minus 1.2% is the average we got. There are some people who are expecting even minus 2%. This is the average of about 10 economists. That works with another minus 0.7 in the previous month and 9.2% year ago. Very high base, and that's why you're getting such low food inflation numbers. Core CPI at 4.23 is largely, again, because of the base effect. Year ago, it was 3.5%. That's why core still looks respectable and above 4. But what I want to point out is to get back to that 1.5% September inflation. Now, October inflation is expected to come below 1%. Our poll says 0.6 to 0.7%, as you can see. If this is the number coming, just imagine the mindset of the Reserve Bank and the MPC when it meets on December 6th for the policy. The two readings they will have, one will be 1.5 below 2%, and the other will be 0.7 way below 2%. So if this is the kind of reading, chances of not getting a rate cut in December look very slim.
Lata, thank you for that update. Now, let us now bring you an update from the Supreme Court. It has once again deferred the hearing in the Vodafone Idea AGR dues case, this time to the 27th of October, which is after Diwali. Now, the Solicitor General of India has asked for more time on behalf of the Department of Telecom. The Supreme Court, while deferring the case, said that it wants the government to take a specific stand on this issue. Now, former Indian cricketer Sachin Tendulkar recently launched his sportswear and athleisure brand 10XU. The CNBC's Mangalam Malu caught up with the Master Blaster on his new venture. Take a look.
I remember my grandmother telling me that, you know, your health is your real wealth. So you look after your health. And post-COVID, which kind of reiterated that, we met like-minded people. We found ourselves to be on the same page. We discussed today, why don't we introduce something like this? And that really accelerated the thought process. And then we started chasing our dream. Our dream was to launch something like this.
So if you were to wear this shoe through your career, would you have made 10, 20 more centuries?
There possibly would have been less run-outs.
From the time you started playing to the time you ended, there was a big change in the quality of the equipment and all of that and stuff. Were there ever times where you felt that this equipment could have been a lot better and that you've incorporated in the current one?
I remember playing a match in Kolkata. This was way back in, I think, 1998. And the month of, end of May, June.
Oh.
And I scored 100 there. Spent some time at the crease. It was a day-night match. My clothes were completely wet. Even the shoes were wet. So every time I was running, it was as if, you know, I'm running in the rain. I could hear that splashing sound.
I can hear it as you describe it.
Yes. And the worrying part was my trousers were slipping down because it had so much weight that I tied them with a lace, but there was so much weight because the sweat was all being absorbed by clothing. And now the technology is different. It just throws off everything. So the material that you wear today is completely different. I mean, all those things are taken into factor, and then, you know, they made sure that the sweat is not absorbed by the fabric. It just throws off everything. So I clearly remember that.
What's the revenue run rate that you're targeting on this?
See, we believe that over the next 1 year, we actually want to be at somewhere closer to 50 to 60 crores annual run rate to start with. Over the period of next 3 years or so, we want to actually target somewhere closer to 400 crore run rate.
Sachin, you in the cricket world always say double it. Do you want to pressurize him by saying it double it? Because he's saying 50 to 60, come on, you can go for 100.
we are one team. We are not pointing fingers. So
No.
work together as one team.
In the same team, you say double, right?
My motto in life is be happy, never be satisfied.
And I was 2 weeks ago speaking to Saurav Ganguly, who's obviously come up with an ethnic wear line, surprisingly. And I asked him, if you were from your line, sending pieces, I hope he sent you some pieces. What would you send to Saurav Ganguly from your range, 10X you?
A nice jogging shoe.
Because?
Well, that is for you to guess.
Sachin Tendulkar, candid as ever. You take a leave on this edition of Business Lunch. We leave you with the Nifty still around about 100 points lower. Midcap radar on the other side.
Co-powered by SBI. Best है सबको पता है. In association with Prakash Surya Steel Tubes and Pipes and Hindware Italian Collection, designed for Sukoon. Co-powered by SBI. Best है सबको पता है. In association with Aditya Birla Capital.
Good afternoon. Welcome to Midcap Radar live from the CNBC-TV18 Motilal Oswal studio. I'm Sonal Bhutra. With me as always is Vivek Iyer. A fresh week, a fresh Monday morning. Nifty on the back foot, but that's after seeing 1 month highs on Friday. A lot of mid-caps in focus. That is what we'll discuss on the show today. Hey, Vivek.
Good afternoon. Slightly muted start to this particular week. A lot of action, especially as far as US and China is concerned, and that's kept sentiment quietly subdued as far as this particular week start is concerned. We have a lot lined up on the show, so let's start off with the top headlines. Stocks trade soft after US-China trade tensions erupt over the latter's rare earth curbs, though Trump tries to temper concerns. Consumer durables, FMCG and IT are the big losers, even as financials manage some green.
BLS International is under pressure as the External Affairs Ministry bars it from new Indian mission tenders for 2 years. The company tells us none of their business is going to be impacted by the order.
Waaree Renewable Technologies gains more than 9% on the back of strong Q2 earnings. Profit more than doubles, margins expand as well.
KFin Technologies gains more than 5% after brokerage firm Citi double upgrades the stock to buy, also increases its share price target by 13% to 1,215 rupees a share. All right, those are the top headlines for the markets. It's a 90-point cut on the Nifty. It has been there largely through the course of the day at the 25,190 mark. We did see those 25,300 levels on Friday. For now, we have not been able to scale 25,200 comfortably as well. Mid-caps, they are in line with the they are outperforming the benchmarks by a slight margin. If we talk about the Bank Nifty, that is seeing some recovery. It recovered sharply from the lows of the day. It has been trying to reach those levels back again, but it's been very volatile at those levels. Mid-caps, they continue to be on our radar. A lot of moving parts.
That's right. Quite a lot of mid-caps in focus. A couple of stocks, that hit the screen. Look at L&T Financial, that particular stock near the day's highest point. Even an SRF that's added a new line, that particular stock too higher by close to 0.5%. But Ria is standing by the wall. This is our special segment, Mid-Cap Movers. Ria will take us through all of the mid-caps that are moving around in the session.
Well, yes, starting off with the gainers with Waaree Renewable up almost 10% after strong Q2 result. Net profit almost doubles and revenue also goes up by around 48%. MapMy India has also popped up by around 6% on hopes of a potential integration with a locally built chat and calling app along with social media posts by Railway and IT Minister Ashwini Vaishnav. Fintech has also gone up over 5% after Citi has upgraded the stock to a buy rating with a target price of 1,215. Motilal Oswal also seeing a gain of 4% after a rating upgrade by ICRA. Other gainers today include Jubilant Ingravia up over 7% and others like Saregama, Aether Energy as well as Fortis Health up anywhere between 3 to 5%. On the losing side, we have BLS International down around 11%, recovering from its day's lows after an 18% fall after the MEA has temporarily restricted the company from participating in new Indian mission tenders for a period of 2 years. We also have Reliance Power going down by around 6%, recovering from its day's lows after an 11% fall after the CFO of the company has resigned amid reports of an arrest by the ED in a fake bank guarantee case. Other losers today include Keynes Technology, Minda Corp as well as Reddington.
All right. Thank you so much for joining us with those details, Ria. With that, let's move on and welcome Ruchi Jain from Motilal Oswal Financial Services for a technical check on the markets. Ruchi, what next? We have been around this level since the start of the trading session. What are the charts suggesting now?
Yeah, hi, very good afternoon. So we did see a negative opening based on these news flows which were there in the weekend, but no, there's no follow-up selling post there, so which is a good sign. And if you look at the recent markets momentum, then on the Nifty front, we have seen more of a consolidation phase, which seems to be a time-wise correction. But overall trend for the banking and the financial space looks much positive, as there is a good high top, high bottom structure happening over there. Even in today's trading session, you can clearly see a relative outperformance in the bank Nifty, compared to Nifty. So I think downside seems to be limited from here on. There could be some time-wise correction as far as indices are concerned. But if you are a short term, you need to find those pockets of relative outperformance and look for stocks within that space where you can even get good short-term returns.
Right, and Ruchit, any of those stocks you want to name for us? What are our topics for the day?
Yeah, so a couple of space where we are witnessing such relative outperformance. One is the PSU banking space, where overall the trend has been strong since last couple of weeks, and PNB within the space is looking quite positive. On Friday, we saw a weekly closing where a cap and handle pattern breakout was seen on the weekly chart. So this is one stock within the mid-size PSU banks where we are expecting an up move with a stop loss below 112. Short-term traders can go long over here for potential targets around 125 to 126. And within the entire financial services space, AMCs is one segment where we are witnessing a good price volume action. So Nippon Life, NAM India, within that, the overall structure seems quite positive. Stock has given a breakout from consolidation around its life highs. So NAM India can be bought with stop loss below 860 for potential targets around 930 in the short term.
Take that point. Thank you so much, Ruchit, for joining in and telling us some of these stocks which are on your radar. With that, we'll slip into a break. When we come back, we'll get you more on the markets and we'll focus on CE Infosystems in our Midcap Spotlight segment. Stay tuned for that. Welcome back. You're still tuned into Midcap Radar. Well, one stock which is on our radar today is MapMy India or CE Infosystems. It's buzzing in trade higher as we speak. So this is our Midcap Spotlight segment. Winnie is joining us to tell us why it's under our spotlight today. Winnie.
Hi, afternoon. So it merits the spotlight coming in as well because we had seen tweets coming in yesterday from a lot of, individuals and ministers, especially for the app. Now, firstly, we had a tweet that came in from Ministry of Railway Information Broadcasting, Ashwini Vaishnav, who spoke about Swadeshi Maples by MapMy India, which is a good feature, must try. He's showing himself using the video. There's a video of him showing himself using the maps as well. Now, obviously, apart from that, we had a notification that came in from the company where they said the Ministry of Railway will collaborate with MapMy India through MOU. They'll be doing this to bring MapMy India maps as well as Maples technology into railway applications, helping them make travel, planning, navigation and consumer information is something they want to provide on the railway side of the apps as well. Now, obviously, the company is already working with a lot of government projects as well. So this will be interesting to see in terms of growth as well. The government side of the business, CE, that's a technology side of the business, had seen a very good growth of more than a double-digit growth this time. We could say around a 15% growth is what they saw in Q1 FY26. And this further proves that the government's focus is coming in on the domestic side of the business as well. Now, other than that, we had the founder of Zoho, who is Sridhar Vembu, who also spoke about Maples and said it's a very good app and must try, reflecting a lot in terms of the India's research and development coming in this side. And a separate post by the director, Rohan Verma, responding to a user on X, where he said that they would be very happy to tie up maybe with Aratia app for location side of the business as well, and maybe providing location on that app. So that is interesting to see in terms of the growth and focusing more in terms of Make My India, Atmanirbhar Bharat. That's where the focus of the government is as well.
Thank you so much, Vinny. So you may soon see Maples on the Arete app as far as social media itself is concerned. Well, I'm actually focusing on GK Energy. The company is a recently listed name. The company gave its Q1 FY26 results over the weekend. Now, on a year-on-year basis, very strong, but let's have a look at the numbers on a sequential basis as well. So revenue sequentially down 8%. When you're looking at the EBITDA, it was down 13%. EBITDA margins contracted close to 70 basis points. Profitability went or fell close to 14%. On a year-on-year basis, the numbers that you can see on your screen, quite strong, almost doubling revenues. When you're looking at the margins, margins expanding over 250 basis points and profitability more than doubling. So most of the companies, especially companies in the solar EPC, solar module space, doing very well. And this is in line with the trend that we've seen over the past few years. It'll be interesting to see whether most of these companies can sustain the performance once we see a lot more competition come by. But moving on, KFin Technologies, that particular stock has been a top outperformer today. Sudarshan joins in with more details.
So it's amongst top mid-cap gainers today after Citi has come out with a note upgrading the stock to buy an increasing target price to rupees 1215 per share. That implies an upside of almost 10% even from current levels. And the reasoning as per Citi is company is well positioned to benefit from strength in the mutual fund inflows, and also company is seeing an increase in the number of international clients, and it will be aided by Ascent's global capabilities and near-term buoyancy that we are seeing in the primary markets. That's an IPO. Unlike CAMS, KFin is going to benefit from first, lower pressure of telescoping pricing, and second, it has a higher share in the smaller clientele base. It will continue to augment its product capabilities that will drive the revenue diversification. But if you leave aside the positive part, the one negative part, or say risk that Citi has mentioned is the overhang of promoter stake sale that might come after the results of Q2 FY26.
Okay, all right. 6% higher on KFin. That's the City View coming in. Thank you so much, Sudarshan, for joining us with all those details. By the way, some stocks from the chemical space are doing really well. For instance, Jubilant Ingrevia, that is one stock which is up around 7% as we speak. Tatwich Indan Pharma, which generally has been seeing weak numbers in last couple of earnings, is also higher, 3% higher on that one. Acutaas Limited is the erstwhile Ami Organics was also doing well. So that stock should also be on your radar. That one is up 3% as we speak. We'll slip into a short break now. When we come back, we'll get you more on the markets and a lot of stock-specific action on the other side. Stay tuned for that.
Welcome back to Midcap Radar. Well, BLS International Services fell after the Ministry of External Affairs debarred the company from participating in any future tenders with the ministry for the next 2 years. The management joined CNBC-TV18 earlier today and told that they are confident of resolving the issue soon and that they will not have any impact on the business.
There were some complaints in some other countries for procedural issues, etc. But we are working actively with the authorities to resolve this issue. I don't see any impact on our revenue, etc. We continue to maintain the growth momentum. Whatever discussions we had in the last few quarters, we continue to actively remain focused on that.
All right, that's the word coming in from BLS International. But Religare, that is likely to list health insurance business, Care Health Insurance. Yash Jain is joining us with all the details. Yash?
Well, this could be a very important value unlocking move coming in from Religare. What we've been given to understand is that as a part of its larger corporate restructuring, Religare is considering a scheme of arrangement under which its health insurance arm, that is Care Health Insurance, is likely to have a share swap arrangement through which it will get listed directly on the stock exchanges. Also, what we've been given to understand is that the plan to sort of introduce this scheme of arrangement under which Religare would be directly listed on exchanges could be firmed up and announced by as early as next quarter. What makes this transaction very interesting is the valuation which these companies carry, right? Religare, on one hand, the listed entity, has a market cap of about 8,500 crore rupees, whereas Care, the last rights issue which happened in the company, that valued Care Health Insurance at about 15,000 crore rupees, about nearly 14,500 crore rupees. And the IPO, according to our sources, not the IPO, the listing, could value Care Health Insurance at about 16 to 17,500 crore rupees. Religare importantly owns about 62.8% stake when it comes to Care Health Insurance. So this could be a major value unlocking opportunity for Religare itself. Apart from that, there are a few high-ticket, appointments which are expected to be made at Religare. This is a part of the larger restructuring and cleanup exercise. And as I said, the important piece of, directly listing Care Health Insurance could be firmed up by next quarter itself.
Thank you so much, Yash, for joining us with those exclusive details as far as Religare Enterprises is concerned and the likely listing of the company's subsidiary, which is Care Health Insurance. Well, I'm actually tracking Vari Renewable Technologies. It's part of the Vari Group. This particular company does EPC work for the larger listed entity, which is Vari Energies. Now, looking at this particular company's results, again, in line with the trend that you're seeing for the solar module, solar EPC space, very strong set of results. Revenues are almost 48% higher on a year-on-year basis. The EBITDA has jumped up 2.2 times, EBITDA margins expanding over 650 basis points, and profitability more than doubling. Unexecuted order book that the company says that can be done over the next 12 to 15 months stands at close to 3.5 gigawatt peak, which again indicates very healthy pipeline of projects. The company also says that the bidding pipeline is quite robust at over 27 gigawatt peak. So again, very strong set of results as far as Vari Renewable Energy is concerned. No wonder that Sonal, you're seeing this particular stock perk up almost 10% higher today.
Yes, doing well, and earnings coming in thick and fast. We are tracking that for you as well. But before we wrap, let's take a look at some of the stocks which are moving around. I spoke about Jubilant and Grevia earlier, so some of these chemical names are doing well. Atlanta Electricals, that has been a good listing, and it continues to soar higher. That stock is up 10% as we speak right now as well. GM Breweries reported numbers last week. It was a good set, and since then the stock has been surging. Today as well, it is a gain of 6% on GM Breweries. The other name that I'm tracking is Aether Energy. The stock is up 3.5% as we speak. What is not doing so well in the broader markets? Well, some of these defense names, they continued and they started on the back foot. We have Green Panel Industries, which is down around 5%. Vodafone Idea is down around 4%. The hearing has been moved to after Diwali, so that stock remains in focus, down 4% right now. Hikal is the other one, 3% lower there. The Dhanuka Agritech is the one which is down around 3% odd. Voltas is down 3%. So some of these stocks which are on our radar, Minda Corp also, for instance, is down 4% as we speak. So yes, the advance decline ratio is in favor of the declines currently. 877 stocks advancing on the NSE versus around 2,000 stocks which are declining. So the advance decline ratio absolutely in favor of declines as we speak.
Well, very good, especially when you look at the advance decline ratio, clearly indicating that it's a very weak start to the week. A couple of stocks on the radar, we pointed out L&T Finance Holding, that particular stock now perked up to the day's highest point. Some important flashes on your screen. The Supreme Court has rejected Asian Paints plea against CCI probe over Grasim Industries complaint. So this now paves the way for the CCI to go ahead and probe any market manipulation or complaints that Grasim has made against Asian Paints. Asian Paints, on the back of that, has cooled off a little bit from the day's highest point, but continues to trade with marginal gains. So Asian Paints, again, what we're actually seeing is that as far as the paint industry is concerned, number one is competition. Number two, you're actually seeing the incumbent being challenged, even the courts as well as CCI, over the market share worries. Well, with that, it's all the time we have on this edition of Midcap Radar. Finding Alpha when we return.
Co-powered by SBI. Best है सबको पता है. In association with Aditya Birla Capital. Co-powered by SBI. Best है सबको पता है.
Well, hello and welcome to Finding Alpha. I'm Nigel D'Souza in the Mumbai News Center. It's been a challenging year for Indian equities. We have seen sustained FII selling, renewed tariff tensions under President Trump, geopolitical concerns, and muted earnings. All of this has put pressure on the Indian markets. But there's a growing sense of optimism that things could actually be turning around. Well, on this special edition of Finding Alpha, we're joined by Amit Jaswani, founder and chief investment officer at Stalin Asset Company. Well, Amit, thanks a lot for joining in. And before I start off the show, it's going to be a very, very special Diwali for you, because in the last 45 days or so, you've welcomed a baby girl. So all the best to you, your family, and congratulations on the little angel.
Thank you so much, Nigel. It really means a lot.
Okay. All right, Amit, let's get to discussing some themes then. Walk us through the key playbook as well as strategies investors should keep in mind when they navigate the Indian markets from here on. You know, if you could help us out with a few of them. So my first question to you basically is, since we're going to be talking about playbooks, strategies as well, earlier, if I recall, a couple of years or so ago, you all were, more towards small cap companies. But if I look at your portfolio right now, it appears you're tilting more in terms of the large cap. Tell us how you're constructing it.
So we've been 50% large cap for the last 7 years, broadly 48, 49% large cap for the last 7 years since the inception of Stallion. We've been about 22 mid cap and 18 small cap, 10% cash. If you take 7 years of average of Stallion Asset as a fund, we've always had near 50% exposure to large cap. It's just that when there is risk on, we go towards high growth small caps as well. And when we go to small caps, our expectation is, so we don't go for small caps, which typically grow at 20%.
Okay.
We want small caps, which can grow at 40, 50, 60%. See, the idea is to make, in a bull market, the idea is to make as much money as possible. In the bear market, you want to retain whatever you made in the bull market. So in bear markets, typically, so in 2018, 2019, the markets were all about quality. We were with quality.
Right.
In 2021, when we keep moving where the markets are moving.
Right.
But over time, we've understood that there are those super cycles that come about where you can create outlier returns. See, our goal of a portfolio management company like ours is to create alphas for our clients. And alphas need superior returns than benchmarks. So you want to be in companies which are growing way faster, but you also need tailwinds. You cannot have companies that can grow super fast without tailwinds.
Got it. So, so I think we get that point then on that front, because I think in cricketing parlance, what you're telling me is that when the wicket is a little tricky, you want to hang in there, and face a large number of deliveries, while when you're seeing the ball big, you want to smash it out of the park. So we'll get to a couple of playbooks on that front. But let's talk about a couple of themes first of all. With the various fiscal, monetary policy as well changes that we have seen, discretionary consumption is something that you're a little bit bullish on. So explain that to us.
So we are actually bullish on consumer-facing companies broadly for last 7 years. For us, has been 74, 75% of our portfolio.
Yeah.
We do not invest so much in government stocks. We've never been able to create alphas. It's just that our playbook's not strong enough.
Right.
We invest in processes, and our process is very simple. Right now, about 70% of Nifty companies will grow at less than single digit. Your GST growth is around 8-9% for the first few months of this financial year. If your GST growth itself is 7, 8, 9%, companies which can grow at 25, 30, 40, some food delivery companies would grow way faster than that. So wherever there is growth, and that has always been our style, we chase growth. And wherever there is sustainable, predictable growth, and there is the largest player is gaining market share, that is where you'll find us. And that's the whole playbook, that there is a super trend right now in internet stocks. Internet is the leader of this bull market. And just find good players out there. And if you get a few themes right, this in bear cycles also you can make money. 1996 to 2000, the markets went nowhere, but your tech stocks went up 100x, 200x, 300x.
Got it.
Even post that, between 2000 to 2003, your Hero Hondas, etc., the companies who keep growing consistently. Bull market, bear market is for the entire market. There will always be a set of 25, 30, 40 companies, which will lead the bull market.
Right. Amit, let's take that super cycle first, that first playbook that you're putting out there. And you're telling us that the internet stocks could potentially be in that super cycle, which means, you have the sector tailwind and you have growth as well, which could be sustainable in the near term. Now, I want to ask you about a couple of examples in the past, because the EMS theme, out there, we saw those stocks. I mean, the profitability went up by 5x, 6x in a matter of a few years. Or even when we look at the cash market, the volumes, F&O volumes, cash market volumes, when they went through the roof, that time you saw this entire, some of the exchanges did well, some of the wealth companies did well. So explain a couple of those super cycles in the past.
So typically what happens is, like right now, the global super cycle is internet, and where you have NVIDIA, AI, etc. NVIDIA is now $4.5 trillion market cap. That is as much as India's market cap. Typically what happens, like EMS, such a good example you gave, the largest EMS company in India. Stocks are not recommendations. Me, my family have vested interest, and we keep adjusting our portfolio, buying, selling stocks.
We'll get the disclaimer up on the screen. No worry.
But stocks like Dixon used to make 120 crores in 2020.
Yeah.
India was a net importer of electronics. Today, we're a net exporter of electronics. The profits of Dixon scaled from 120 crores to probably around 1,300 crores this year, and analysts are expecting around 2,000 crores next year. Option trading, it was happening in front of us. Big brokers like Zerodha went from probably 100, 200 crores PAT to now 5,000 crores PAT. Your BSE used to make 100 crores a quarter. Started making 100 crores a year in 2020. That's 25 crores a quarter. Now makes 530, and it was happening in front of us. You could see quarterly numbers. You could keep riding the trend. MCX as well, as an example that you gave. Option trading market, MCX started option trading in 2022. They got permission from SEBI, and from there, it's been a one-way journey. So you keep looking at changes. What is that large theme? And in that large theme, you keep finding names. If you want super performance, it may come by value stocks. There are hundreds of ways to make money, but we find our super performance comes from buying these super cycles and just holding. And capital market is a super cycle. It can keep changing names. We can change from, right now the game may be AMCs as well. You have new two AMCs which are getting listed this month.
So if you have to identify a couple of super cycles, internet could be one theme, right?
Absolutely.
Internet could be one theme. Since we're talking about internet, as you said, NVIDIA's market capitalization is a few $1 trillion, right? And, if I look at a company like, say, Zomato over here, with all your disclosures, etc., some people say it's already 3 lakh crore market cap. But if it's got a tailwind, then do you think themes like these have a lot more to go? Because you add all of them together. Zomato, that's Eternal, Swiggy, the other internet plays as well. Still, the market capitalization is not that much.
It's 8 lakh crores. So if, example, Swiggy is at 1.08 lakh crores, Zomato is at 3 lakh crores, 3.2 lakh crores. You have Paytm at 70, 80,000 crores. You have Delivery at 30, 40,000 crores. You have First Cry at 20,000 crores. So basically, when you look up US market cap, $60 trillion is the total US SPX market cap. Out of that, semicon plus technology is about 60%. You're looking at 35, 36 lakh crores. If you take Tesla also being tech and all, then it keeps going higher. Tech is very hyper scaling, because in most companies, what will happen, Nigel, is your cost in tech do not grow with your revenues. So be it exchange, your cost is not directly correlated to your revenue. So every incremental revenues is profit. So when your revenue goes up 100%, your PAT actually goes up 200-300%.
Correct.
And that kind of J curve will keep happening in India. Our total tech market cap right now in India is 8 lakh crores. Out of 500 lakh crores total market cap, we are at 1.6% tech market cap. When we end 2030, there'll be, of course, new IPOs that will come. But when we end 2030, and these private equity, there is no thing. Why did tech not become so big in India? Because these private equity guys would come and keep burning money and make sure the incumbent player doesn't make money. If incumbents' valuation go higher, what do these private equity guys go? They fund the second best guy and just keep putting money in and trying to see if they can make money. But that game is over. The loss-making game, burning game, beyond a point, it doesn't work. Everyone, capital is a shortage. Both competition to what the big name that you said, like let's say competition to the leader of food delivery, Swiggy and Zepto.
Yeah.
Both have said that they will not open new stores. They will go towards profitability. And Zomato was the guy who didn't lose money. No recommendations, of course. We keep buying, selling stocks. So
from 1.6%, internet companies as a percentage of
it can become 20, 30, 40%. Every company will have to become an internet stock. There is no question that internet as a theme, as next, everyone will have to, every company has to move towards AI. So it's not possible that you will not. So a lot of value will get created.
So internet, that could be one theme that's in a super cycle.
But you still need great entrepreneurs. So a theme doesn't mean that you'll make money. You need to back the right entrepreneurs even after you've got the right thing.
Correct. And if I also look at, household money, equities in comparison to any asset, it's still very, very small, right? And the flows domestically are quite good. So do you think even some of these market-related players like an AMC, like maybe exchanges, they could still have a longer runway? Maybe they pause in a little bit, but on the whole, they're in a super cycle?
See, weekly options don't stop. I think capital market have already bottomed out.
Okay.
That, I don't know, CNBC keeps playing that it will stop, it will not stop. I don't know. But if this weekly option doesn't stop, then I think capital markets have already bottomed. This is my view on all your exchanges stocks. AMCs will do well regardless because they are not affected by the capital market, but other brokers, etc. The value chain has bottomed. The worst was priced in the day, where rumors were extreme high. That I think the worst probably may be behind, but it all depends on weekly options being there or not. If weekly options are there, then there is way more downside left in these stocks.
So two themes, internet themes and some of these market-related plays.
Capital market.
Capital market plays. Let's go to your next playbook then. So one playbook out of the way, super cycle is what you've told us about. Your next playbook is focusing on identifying the market leaders and also the emerging challengers. How should an investor approach this sort of distinction, in an industry?
So we divide India in 71 industries. In every industry, every quarter we track who's the guy who's gaining market share, who's the guy who's losing market share. From cigarettes, I'm just giving you an example. Cigarettes, this is happening very clearly. That the incumbent player is taking market share from the market leader. It happens in your two-wheeler vehicles. Two-wheeler vehicle is a 2 crore market. And right now, 2 crore two-wheelers get sold in India, and about 16, 17 lakhs is your EV two-wheelers. You need to see who will make it large in this EV market. So there are market shares that keep changing, and market values consistent gain in market share. If you see what TVS has done, TVS market share used to be single digit. It's moved to 32, 33% of the entire two-wheeler market. The stock has gone up 100x, whereas Hero Honda, which used to be at 45%, has gone to probably 31, 32%, and the stock has not done anything in 10 years. Basically, you keep focusing on in every market. This is like a playbook, right? You want a GDP growth is 10%. Nominal GDP growth right now is 10%. And now you need to find players who can grow at 25, 30%. Either they keep finding newer geographies, do acquisitions, etc., or they gain market shares. And market share gains is very persistent. So the stocks which keep gaining market share is very persistent. Every quarter they'll gain. This happened with, we don't own it, so I can say it, like Safari. First 40 quarters, Safari was gaining market share against
VIP.
Against VIP, where the world number one was Samsonite was losing market share. India's number one VIP was losing market share, and you had Suresh Jatia that was gaining market share very consistently. You keep track of every industry, shoes, right, beauty platforms, what is happening in which industry, which guy is doing well, and that is what we keep doing. And it is the best trend to have, is to have companies who are gaining market share. There is no risk in those. Typically, like there is a lot of outperformance you can find in those kind of names. See, the whole goal, Nigel, that we are doing this is to find outperformance.
Right.
What is the playbook for outperformance? First is super cycles. Second is market leaders or competition to market leaders.
Correct.
Competition to market leaders which can keep growing. Let's say
give us an example with regard to the cigarette theme that you spoke about. There is a smaller player who we all know is eating into some market share.
So we might have vested interest here also. We've got, and we can keep buying, selling based on quarterly numbers and a lot of things. But ITC is 20,000 crores PAT, and you have the second player who's at 1,100 crores PAT.
Correct.
45% of incremental market share is being taken by
Godfrey Phillips. Yeah.
By the second player, 45%. And so there's a long way to go. So those are kind of themes. I'm not saying buy this stock, it's already rallied. But those are the kind of themes that you need to focus on.
Right.
That market share, like BSE was taking on market share of NSE.
Right.
In the option trading market, and 60-70% of NSE revenues were option trading. So you need to keep an eye on a total industry size. Industry should grow at 10-15%, and your player in that industry should grow at 25-30%. And that is where you get super performance. Because Nifty will do right now, if your nominal GST growth is 10-11%, Nifty is not going to give us outlier returns.
Right.
If your 70% of Nifty stocks are growing single digit, how will you get outperformance? You will get outperformance only if you get super companies, but at right prices also.
Correct. Got it. All right. So we have identified that then super cycles, either the leaders or the guys who are taking share from the leader, making inroads. So we have got those examples as well out of the way. Let's talk about another, playbook that you look at, special situation plays. Could you tell us about identifying such opportunities? What are the key signals you're looking at out there? What is the trigger? What is that trigger point that tells you this is a special situation, need to get in?
So we look at everything, every news that comes, be it demergers, promoter buying stake, right issues. First, learn corporate actions very well. Biggest alpha creation is change in margin. That is the biggest alpha creation source. But second biggest alpha creation source is change in management. So we are fundamentally just using frameworks and processes to make decisions. We are only making 4 decisions in market: what to buy, when to buy, how much to buy, and when to sell. Coming to special situations, be it demergers from Adani. No vested interest, of course, but Adani also was a great story of demergers. Look at every demerger which is happening. Nuama that we still might have this thing, but Nuama also we bought because of the demerger and this thing. We had in history, we've had stocks like Red Tape where we've done very well. So many demergers are happening and they all list tips. So many demergers, and you have to also look at acquisitions. We got in like the top electronics player again, electronic EMS space again, only because it acquired Vivo's India's business. So basically, keep looking at acquisitions, especially if a company is acquiring companies 1x its size, 2x its size. That is where a large change can happen. See, we want asymmetry. Right. We want that if we lose 20-30%. But if things go right, you end up making 200, 300, 400%. And your entire portfolio cannot be asymmetry, but half of your portfolio can be asymmetry. Then you have market leaders.
Correct.
Then you have super cycles. You divide your portfolio in 2, 3, 5, 7 themes. And that is how you build a great portfolio.
Got it. All right. Just a quick question, since you're talking about this inorganic growth as well. Off late, we have seen RateGain. They went and they bit large. We had Tega. They went ahead and they did a larger size acquisition as well, or even a Tilaknagar Industries. Those as well could qualify as a special situation?
We might have vested interest in some of them, but you have to look in them. Tilaknagar has bought one of the largest Imperial as is this thing. We don't have any positions, no recommendations, but you keep tracker of them. Like this is a point where the J-curve can start at any point of time.
Yeah.
From a brandy only player, the valuations are cheap. And typically if you look at what valuations your Radico is trading at, trades at 100x.
Yeah.
So alcohol as a space, even United Spirits, which doesn't grow at all, gets 60-70p. So in your mind, a national player, whiskey player, gets what kind of valuation. And then if they get the execution right, which is not so easy, if they get the execution right, you can just hit sixers. Now it becomes your tracking position.
Correct.
First you track, right? You don't just, the day announcement happens, you may buy if it's a full toss, or you may wait. But in Tilaknagar case, we are not.
You're not invested?
Not yet, but we are looking into it. The other names we might be invested.
Okay.
So, but we also have tracking quantity. So it's not like when we go, we buy only straight 3% of our portfolio.
Short point is identify that special situation and see whether or not it fits into your scheme of things.
Change in management is the biggest alpha creation driver. Be it CG power, bigger than demerger, the criteria that works. So I'm just telling you back-tested numbers of everything. Change in management. If a large company, if a small company is being bought by a large corporate,
got it.
That theme is the best theme ever. Even your...
Got it. So Amit, I'm just going to, I'll tell you what. You have told us about super cycles, identifying the leader, also playing those special situations. But we'll take a short break, come back. We'll focus more on risk management. And how do you know when it's the right time to get off the bus? Slip into that break, come back. We've got lots more lined up. Welcome back. You're tuned in to Finding Alpha. It's a Diwali special, and we have Amit Jaswani, who's with us in the studio. Amit, before we talk about stocks and equities, I want to ask you your view on gold. How do you see the current rally shaping up? Do you think we're at the later end of the rally? I mean, your quick view on gold?
My wife is very happy. My mother's even happier with this
And now
rally.
you've got a little girl, so you need to buy some more gold.
But this is a trend. This is a super trend right now. It's a de-dollarization trend. I don't know where this will end. But right now, the trend is there. Any dip looks like a buying opportunity for now. And silver's just broken out the 40-year level. Now, how can you stop a breakout after 40 years? We've not seen this kind of breakout in many, many, many years.
Yes.
So I don't know. This will eventually become a bubble. And people say that, you know what, I told you not to buy at this level. But it may happen at $6,000, $8,000. Silver can go to $100 and then the bubble can blast. So the whole part is that I have a saying. Be greedy when others are greedy. Be fearful when others are fearful. You make the most money by riding a bubble, not by being out of it, as long as you can sell it at right points. But in the stock market portfolio, we are playing gold via a gold finance company and the exchange, the commodity exchange, which should do decent, hopefully. So,
a larger gold finance company?
The largest gold. See, we don't buy the 10th best company.
Yeah.
In any sector, we want the best company because that's how you can manage your risk. They fall the least and they need to grow also the fastest. The gold finance, the largest gold finance company is growing at 40%. And the smaller ones are growing at 15%. Why should I buy the small ones?
No, I was asking you because you spoke about management change as well. So I want to know whether you're going for the one that is...
We had the management change, which one you're referring to.
Right, Manappuram. So it's not Manappuram.
But we don't have it in my portfolio. We sold out because we thought that jo chal raha hai, uske saath hi zyada
Muthoot is the leader. So we get that on board. You're going with the leader out there. And in terms of commodity exchange, it'll be MCX. But, before we wind down, you often talk about, everyone talks about riding the winners. But don't marry the stocks. That is important as well. When do you decide it's time to jump off?
So I had this old saying, I'll say it again, stocks are girlfriends, stock market is wife. You don't get out of the stock market ever, and you have to stay invested whatever it happens. But every cycle is different, every 2-3 years. And people who buy and hold is not working. See, our goal is to make money. That's our only goal. Buy and hold, every 2-3 years there'll be new winners. And you have to see where the new incremental growth is coming. If a company is growing at 30%, and market thinks that the company will keep growing for 5 years for 30%, markets in first 1 year or 1.5 years will discount the entire 5-year growth. And after that, if you have that stock, you're not going to make any money. It will just, only the results will make you happy. The stock prices will not go up. Markets are hyper discounting.
Yeah.
You have to keep finding newer cycles. Every cycle is different. Don't have 10-year horizons. Have 2-3 year horizons. Max 2-3 year. And think about it. If I have 25 companies in my portfolio, you always have 25 companies which are looking good to you, right?
Yeah.
And you have to keep adjusting your portfolio. Where is the next incremental growth? Where is the next discovery? See, if you want outperformance, if you want beta returns, that's different. But if you want to be the best, then you have to keep finding newer cycles, and there will be newer cycles. Tell me 1 3-year period, and the next 3-year period, the same stocks go up. It doesn't work that way.
Yeah.
Now, markets are very different. 18 to 24 months are the size of one cycle. You keep finding those cycles and keep playing in cycles.
Very quickly, GLP-1 is a big opportunity.
GLP-1 is a large opportunity, and you need to buy, it's a super cycle. It's again a super cycle. I'm not fit, but hopefully I will get fit the next time I come to CNBC. Without GLP-1s, but it's a large trend. There are already 1 lakh users in GLP-1. It's a large opportunity, and you need to find a pick and shovel method. When gold rush was there, it was the jeans guys that made the money. So you need to find, according to you, who are the pen guys, who are the other guys, and hope to make money. I don't know. You can lose money also.
No, and GLP-1, I mean, one of the disclosed investments that made a small investment is Shelly Engineering of late.
Very small part of our portfolio.
Very small part.
But risk management, you have to cut your losers.
Right.
If we cut our losers, and even if I like a story, but if the stock is not doing what we thought initially it would do, my team is beyond me. So whatever happens, have that discipline. If you are finding super performance, be ready to make mistakes. In markets, you will keep making mistakes, and mistakes are part of the game. Do not marry your stocks.
Well said, Amit. Well, we thank you for coming down to the studio for this Diwali special. Thank you for taking us through your investment playbook as well and warning us with regard to the risk. It's a pleasure having you on the show. Well, hope you guys had as much fun as me on the show. That's Amit for you, telling you about identifying cycles, riding the themes, and also booking your losses when the time comes. Well, we'll wrap up on this edition of Finding Alpha, our Diwali special.
Co-powered by SBI. Best है सबको पता है. Powered by LIC, हर पल आपके साथ. Co-powered by SBI, best है सबको पता है.
Headlines. To understand the reasons for the day's movers and shakers. And get your portfolio ready for tomorrow. Beaming live from the CNBC-TV18 Motilal Oswal studio.
A red start is what Hang Seng is seeing. Taiwan index is down 2% as well.
The US has signaled a willingness to renew cooperation with China.
Expect growth from HCL Tech this time. Dollar revenue growth seen up 1.8%.
GIFT Nifty is, I think, indicating about a 100-odd point lower start. 25,190 is where the Nifty is at. 25,200.
Between gold and silver, I think our relative preference for silver has
has been higher in recent times.
51.5 is an all-time high that silver prices are at.
100-point downtick there, and we have all the sectoral indices in the red.
This was, a procedural issue. There were some consumer complaints or something.
Supreme Court, while deferring the case, said that it wants the government to take a specific stand on this issue.
Slightly muted start to this particular week.
Well, that is the day so far, and I have to say that as we start this last hour on closing bell, markets looking much better. We are down about 34 points, 25,250 is where we are at, and there's a sharp sort of bounce which is playing out off the low point of the day. Actually, the bounce started about 220 or so is when the bounce started. We were at about 25,200. And we've added 50 points, basically, in the last 10 minutes or so flat. There you go. That's what I'm talking about. So, not a bad screen at all. The Nifty Bank, of course, is off the lows significantly. It's up in the green, about 0.25%. And many sectors, many pockets in the market showing that as well. Market breadth may give us a clean indication of where things are at. So not very much by way of improvement, maybe a little bit. It's still about 2:1, declines to advances. So more down than up is the screen as far as the broader market and everything on the NSE is concerned. This is Closing Bell. We're coming to you live from the CNBC-TV18 Moti Rosewal studios. I'm Prashant. With me, my colleague Reema. Reema, hi. Afternoon.
Hi, afternoon. And Europe has opened higher, so up close to about 0.5% on the benchmark European indices, the CAC, DAX and the FTSE. And the Dow futures too is signaling a rebound. So after losing about 880 points in Friday's trading session, the last I checked, the Dow futures is up 450 points. So it looks to reclaim at least half of the previous session losses. It's a broad-based recovery, fairly, but it's banks leading on the way up. Capital market plays are higher. And in individual stocks, even HCL Tech deserves mention. The stock is spiking and now back in the green and recovered close to about 1.5% from the day's low ahead of numbers which come out later today. But all in all, this is actually not looking so bad. After a weak start, markets have staged a recovery. We were down nearly 0.5%. Around the 25,150 was the intraday low on the Nifty. So now 100 points up from that low. The Sensex 2 has trimmed most of its losses and just down close to about 0.1%.
Okay, well, let me just quickly run you through what's lined up here, right, in terms of the programming. So markets, of course, in a tight range off the lows, as we pointed out. And I mean, the major indices are all there, about 0.25% in the Nifty Bank. The Midcap index is flat, but 58,722. And the small cap index is also going to come up in a bit from now. Now, looks like with regards to the uncertainty over US-China, maybe it's been taken down a peg or two, because over the weekend, of course, it was looking full-blown. But this morning, with that President Trump's social media post, I think people are essentially hoping that it won't come to that additional 100% tariffs by the 1st of November. Silver ETFs continue to run hard. I mean, and we'll have more on this one, but 4%, 5%, 6% actually in many of these. So absolutely unstoppable move here. Dreamfolks is another one. Stocks bounced from 100 rupees, which was the recent low, to about 140 very, very quickly. And we'll tell you what's happening. Is anything changing in the margin? Completely bombed out, beaten down name. There is the other one, which is, of course, BLS International, which is seeing a sharp slump. There's news there. That's another one which we will focus on in just a bit. It's down 11% off the lows there as well. How should you position yourself in the last hour? That's the question. Mitesh is here from Bonanza Portfolio to run us through exactly that. Mitesh, good afternoon. So not looking as bad as it was in the morning. In the morning also, it was not looking all that bad with a 100-point cut. But what's the trade here, Mitesh?
Prashant, so, in the morning also when we had this indication of a gap down of about 60, 70, 80 points, my idea was that this should be only a pullback and not any kind of a corrective move. We didn't even break the 10-period average on the 2-hour, 3-hour chart. So we just kind of touched them and bounced back from there. The sense is that the structure is very positive. The indicators on daily, weekly charts are slightly rising. The averages are doing that as well. The only issue is that if you join the high of around 25,630, the closing which we got on 27th of June, to the recent high of 25,420, that was the closing we got on 18th of September. The trend line comes around 25,350, 400 zones, depending upon what slope we are drawing it at. So it'll be clear that I think you will get this bouts of some profit booking selling at higher levels. But looking at the way the indicators are shaping up, good chance, and there's a stronger chance of us having a breakout on the upside. So my sense is that use declines to buy, and on the stock side as well, trade with long bias. I have 2 buy calls right now. The first one is a buy on Lodha Developers. It's a conditional buy. So I want to see the stock price getting past levels of around 1160. By then with a stop at 1145 for targets of 1190. And the other one is PGEL, PG Electrocast. I think that's the stock. That's a buy with a stop at about 575 for targets of 6.8, 6.10.
Okay, thank you very much for that, Mitesh. We'll touch base soon enough. Let's talk about stocks then. CE Infosystems is on the rise. The stock has gained close to about 6-7%. Vinny is now joining in. Vinny, the Ashwini Vaishnav's comments have literally lit a fire under CE Info. I mean, what exactly did he say? How is the street reading it? What does it mean for a company like MapMy India?
Absolutely. So, what is in terms of commentary? This came in yesterday, and what they spoke about and what he tweeted, put on X as well, was that he said that Swadeshi Maples by MapMy India is a good feature and it's a must-try feature. And in this, there's a video of him also using the app. Now, post this today, there's a notification that came in from the company that the Ministry of Railway will collaborate with MapMy India through an MOU. This will be mainly to bring MapMy India maps as well as Maples technology into the railway application side as well, helping them, travelers in terms of planning, navigating, as well as commuting in terms of information as well. Apart from that, we had Zoho's founder, Sridhar Vembu, who also posted on X, and he said that the Maples app is very nice. It reflects a decade of research and development, focusing on the Swadeshi movement, focusing on Atmanirbhar Bharat. And in a response to a user on X, we had the director, Rohan Verma, who actually responded to them saying that, they would be more than happy to actually integrate their service with Aratai app as well. So that is also something that is leading to the run-up, given that the app, Aratai app itself, has seen such a good run-up in the last couple of days. So that is going to be interesting to watch out for. But today, a lot happening on the railway side as well, and that is what is keeping the stock in focus.
Thank you very much for that. In fact, in an exclusive conversation with Zoho Corp's Sridhar Vembu, Shireen, my colleague, spoke to him about the breakout moment in India, the self-reliance on and being Atmanirbhar in Indian technology. Listen in to those comments.
You talked about wanting to make in India because you believe that technology is often weaponized, can be weaponized, is being weaponized. But, 2025, you're having if I can call it that, a breakout moment in India. You've got government ministers tweeting, saying that they're moving to Zoho, urging and nudging other citizens to move to Zoho as well. But does it surprise you that Zoho Mail, for instance, turned 15 in 2023. Zoho Office Suite, the upgraded version, was launched in 2018. Zoho Workplace was launched in 2017. And yet, we're now in 2025 when you're finally having this breakout moment in India. How do you explain that?
Yeah. So, first of all, the technology had to have been built in order for it to be adopted. And if you look at Zoho Mail, nearly 2 years ago, the government, the NIC, selected Zoho after a very long, arduous process of evaluation, a lot of audits, over 18 audits performed, and it was selected, and it is now already serving a fairly large number of users within the government, I believe about 1.5 million now, and growing. So this happened well before this current episode. Now, how did we arrive at this moment? It's basically, I call it the Swadeshi awakening we are going through. And I've been part of the whole Swadeshi movement, Swadeshi technology movement for a while now. In fact, I am very proud to be associated with the Swadeshi Jagran Manch and Sri Sundaramji from Madurai. And I've actually had long conversations about the need for technology self-reliance in India. And that now message, I'm very happy to see this awakening happening. This is not only government. I want to emphasize this Swadeshi movement is happening across our private businesses, our educational institutions, our common citizens, right? Everywhere I see this. And the reason for that is, of course, the global landscape, which has changed fairly dramatically. And to be honest, some of us expected this global landscape shift because, I always felt the global trading system itself was built on a very, unsound foundation. And that was prone to collapse, and it's creating these conflicts. And those conflicts, once they emerged, we can see that on why we need the Swadeshi movement now. So I'm very happy to see the awakening happening right now.
Okay, this Swadeshi awakening, it's time for that. Dipan Mehta, Director, Elixir Equities, is now joining in. Dipan, globally, tech companies are in a super cycle. But back home, here in India, on the Lal Street, other than the consumer companies, the consumer platform companies, the so-called tech or ally plays haven't done too well, or not done much. Whether it's even MapMyIndia, which saw its growth slow down last year. I mean, I think I can think of NetWeb, which has done pretty well. But outside of that, we haven't seen too many, big flourishing stocks. Anything that you like, which can come in this Swadeshi, tech play?
Yeah, Rima, good afternoon, and thank you for having me on your show. I think that has been one of the criticism against the software industry, and to an extent, even the pharma industry, that, we are basically, in the pharma, we are providing copycat drugs, and in the software industry, we are just focusing on providing services. And in the large US software companies, the product companies, they take our services and they are building world-class products and creating kind of monopolies which are very, very difficult to break. I mean, a lot of the development work, be it in Google Maps or even in Microsoft, in terms of their Office suite, all of that coding has been done by Indians or software companies providing services to Microsoft. So that's one of the issues. It's changing slowly, but still a long way off because it's a mindset issue. Coming specifically, I think within the tech sector, yes, you said that NatWeb certainly is a company, a homegrown company which has done well. There are few and far in between. Even the product companies in India have not really, put the markets on fire. Like Nucleus Software was a financial product company, but its performance has been pretty disappointing. I didn't think it is, operating at its full potential. And there are a few companies like that, but by and large, I think Indian software industry is going through a very, very difficult period, according to me. And the slowdown is real and structural. So we are finding it very challenging to find stocks. There could be a few outliers like, Persistent Systems or Coforge, which have got some specific vertical or very aggressive marketing. But by and large, I think one needs to exit the software sector.
So, Dipan, to that criticism, TCS has, announced a data center play. They're looking at adjacencies in the AI ecosystem. Is that good enough, at least as a start?
Rima, has going to be a drop in the ocean for TCS. TCS is so big; it's among the top 5 software services companies, and such ventures are a bit late in the day, but nonetheless welcome. And also another issue with the larger software companies is that they are not focused on consulting business, like the likes of Accenture, and not done enough acquisitions and, not worked on a lot of the other aspects. So by and large, we are out of all these software companies, be it TCS, HCL Tech, Tech Mahindra, all of these companies, and trying to find niche plays within the software industry, which are very difficult. But I'll tell you one thing, Rima, if you just give me a minute to extend, that this rupee depreciation, especially against the euro and the pound, that may benefit a few select companies. And one company which comes to mind is Mastech, which performance last few quarters have been exceptionally good. And they are focused on the UK market. And if you see the currency which fluctuation has taken place, the depreciation of the rupee versus the pound has been phenomenal in the last 3-4 months or so. So I expect this company to report very good numbers this quarter, next quarter as well. So like that, you will get trading plays. But on the whole, I think there are very big structural problems within the industry.
Yeah, no, absolutely. Markets are, of course, at about 22 to 40 or so. Dipan, another area, right? If another stock actually, or maybe a sector is textiles, right? Heavily sold into because this US-India, the trade tariffs rates, etc., went south. It appears to be in an advantageous situation. There is one view emerging amongst many investors that maybe things are on the mend, on the repair. So perhaps maybe it's tactical. Maybe, I mean, there are believers in the long run story here in textiles as well. But one way or the other, perhaps, if this gets resolved, this is one area where you perhaps have some upside. Would you agree with that assessment?
Yeah, I'm sure, Prashant, that if the tariff levels are at reasonable levels, at comparative levels as compared to some of the other exporters like from Vietnam or Bangladesh, then I think companies like Kitex Garment is there, Gokuldas Exports is there, PDS is there. Certainly they can benefit. Although PDS is a global manufacturing, they are more like design house. So to an extent they are hedged that way. And then there are the home furnishing companies, Welspun and Indocount. I think they also will benefit, but let's just wait and see what the tariffs come out. Few months ago, we thought that, we were going to get the most favored nation tariffs, and look what happened, So I wouldn't want to trade these companies in advance. Let us understand what the tariffs are actually at what levels and how they compare with some other competing countries, and then perhaps take a call. Right now, there's so much of action happening in the domestic oriented companies that you can easily ignore the export oriented companies and still build a very decent portfolio which can outperform the markets.
Okay, all right. Deepan, stay with us. Well, let's get in Manisha Gupta. She's here to tell us about the big moves you're seeing on silver and silver ETFs. Manisha?
Well, thank you for that, Nigel. Well, yes, even today, as we are talking right now, silver in the international markets is trading at an all-time high. So is the case in the Indian markets as well. And just before I backed up for the link, I was talking to a lot of bullion guys, silver wholesalers, manufacturers, etc. And they tell me that even now, today, with these all-time high prices and prices having gained 60% in 6 months and 78% in this year until now, there is very strong physical demand into the markets right now. There's a premium that's ranging anywhere between 8 to 10%. People are ready to pay 20 to 25,000 rupees over and above the actual silver price as a premium to get it. So that's exactly what we are looking at. When we talk about silver ETFs, then, well, yes, they seem to be surging even higher. So if we are looking at 4 to 5% of an increase in the silver prices, you have seen 6 to 7% of a gain come in for the silver ETFs. But then remember, when you look at the overall silver investment market for India, almost 95% of that is still physical. And when you look at silver ETFs and digital silver buying as well, and that seems to be doing quite well as well, is anywhere between 4 to 5%. And when there is such a huge premium happening in the physical markets, you will see that converting into silver ETFs as well. And that's exactly what we have seen. I also spoke to some silver ETF funds managers as well, and they say that the volume in last couple of years is actually, couple of days actually, has gone slightly down because of, one, the silver prices running up, and two, because of the silver premiums as well. But from where we are standing right now, if you look at the international markets, that's exactly what is happening. If you look at London, well, the liquidity there is quite short. Banks wanting to buy silver, for them, the borrowing costs have gone much higher. And because of the US government shutdown yet again, the custom clearance is not happening there as well. So there is those arbitrage opportunities that you are looking at in New York versus London. And all of that seems to be spilling over into India as well. Most people thought that perhaps Indians won't buy silver because it's trading at an all-time highs. What with this 60, 70% of gain in prices? But that clearly is not the case. There are buyers, there are physical investors as well. And silver imports have been slightly lower. For this year, perhaps you could be looking at 5,500, 6,000 tons of silver yet again coming into the Indian markets, even at these current prices.
Okay, all right. Thanks a lot for that, Manisha. Well, Deepan, coming across to you. If you want to play silver via stocks, there are only two, right? One is Hindustan Zinc. The other one is Vedanta. What do you think?
I think, good afternoon. Now, if you have to go with Hindustan Zinc only, I think they're increasing their capacity also. And buy the holding company when you can get the subsidiary and have a perfect play on silver over there. But, these things are well discovered and to an extent even priced in. And investors do not feel that such rallies in silver are really sustainable. So, of course, it'll have a bump up one time in its profits because of silver. But whether it's sustainable, that's a big question mark. So we can't really pay a higher P multiple just because there is a cyclical upswing in silver prices.
Okay, all right. Deepan, I wanted to ask you about Orient Pro. We had Dharmesh Kant who joined us earlier this morning from Chola, and he was talking about the profitability going up from 180, 190 crores to around 300 crores by FY27. You had briefly spoken about the stock in the past as well. It's up close to around 10% as we speak, but it's been a rank underperformer in the last 1 year. You had earlier mentioned that you would look to buy it on the dip. Have you done any more work on it?
No, actually, Nigel, the last quarter numbers were a bit disappointing, and client wins didn't work out the way we expected. But it's under watch, and as I said, that we're looking for good ideas within the software space. So there is, of course, Orion Pro, which comes to mind, and then there's NetWeb also, which Rima spoke about. There is new gen technologies, which is looking quite interesting. Then there are certain homegrown platform companies like Blackbuck, which is doing that as Inca Logistics. That's an interesting company to track. And then there is another company called Black Box, which provides network services to global Fortune 500 companies. It's a Ruya Group company. They're doing something interesting and quite different in the US market itself, and a big beneficiary, I think, from the data center business also. So like that, you have to look for businesses which are different concept stocks, differentiated business models. They're difficult to find and they're expensive also. But I think you may get a better return over there than some of the traditional software services companies.
No, absolutely. Blackbuck has done very well. I mean, actually, the 3 days back price was $600, $710 now. So bulk of course, its business is now Fastag. But of course, they've got a platform that's supposed to be the big one where they're trying to organize trucking as a business. But for now, it's of course Fastag and Blackbuck, which Deepan pointed out, of course. Ruya Group company providing data center services in the US. It's not focused here in India, but in the US. So, yeah, I mean, lots happening, lots of interesting names out there as well. What we're going to do is take a quick commercial break. Deepan, thank you very much for coming on. Appreciate your time here as always. And we'll come back with Ronak Onkar of Parag Parikh Mutual Fund on the other side, and we'll take some of this conversation forward with him. Stay with us.
Welcome back. You're seeing quite the recovery in some individual mid-cap names. So Utkarsh Small Finance Bank, let's get that up for you on your screen. Ola Electric back in the green. BSE is spiking up. Jubilant in Griva, 8% higher on that. So, the mid-cap index is in the green, flat, but individual stocks are up. Let's go across now to Hormus as he puts the spotlight on some of the top movers.
Jubilant Ingrevia was trying to put that in the spotlight today, but then the volumes were not as significant as some of the other names on the list today. Look at Dreamforce Services and a stock that has been battered, bruised and whatnot. The stock is up 40% or more in the last 7 sessions. It's the biggest single-day gain that the stock has seen since listing. And this 17% move is preceding 4 straight upper circuits of 5% in the last 4 trading sessions. Now the stock has gained in 6 out of the last 7 sessions. Of course, we have had close to 30 lakh shares that have been traded today on Dreamforce compared to a 20-day average of 1.5 lakh. And this is, of course, a change in price band as well for the company. And despite this 45% move that the stock has seen in the last 7 sessions, it is still down more than 70% from its recent 52-week high. And you keep that in mind as well. Now, had Jubilant Ingrevia on the list after all. The second straight day of gains for the stock, the biggest single day gain in 4 months now, 8.5% higher. Here we have had 62 lakh shares that have changed hands compared to a 20-day average of 1.5 lakh. And the stock has now moved above its 50-day moving average of 700 and the 100-day moving average at 703. The next important level, the 200-day moving average, which is at 711. But still been an underperformer has Jubilant Ingrevia, still down to 15% this year. News flow driven name BLS International stock at one point in pre-open was down 17%. So there is some marginal recovery from the lows. The intraday fall is the biggest since 2020 and the volumes today are already the highest since the start of the year. We have had close to 2.5 crore shares that have been traded compared to a 20-day average of just around 11 lakh shares. The stock was already below its key moving averages and this fall has taken it further below all of those important levels for BLS International. It's been an underperformer this year, down over 40% before today's fall. And lastly, a news flow driven name again, KFin Technologies, a third straight day of gains for the stock, 6.5% higher and a positive reaction to a brokerage upgrade coming in. The stock in those last 3 sessions is up 10.5% and we have had close to 51 lakh shares that have been traded today, 20-day average of just around 7 lakh shares, and the stock has moved above another important level, which is the 200-day moving average of 1134.
All right, thanks very much for that, Hormuz. Appreciate it. We have Ronak Onkar of PPFA's mutual fund now with us. Ronak, good to have you with us here. You're one of the few, I guess, who has a view on, actually, maybe other people also have a view, but you've got positions in a lot of the FANG stocks, AI-related stocks, right, which have all done so well in the US. This unending debate about whether, too much money is being spent and whether this is all going to sort of, amount to what? Is there mistakes in capital allocation which are going to be made? And, especially now after everybody sort of, committing investments in each other. So it's like one big, nice round circle. What do you make of it, Ronak?
Thank you for inviting, Prashant. I agree, there can be 2 aspects to looking at it. One is that the build out is needed to be happening because people are building applications on top of these AI models and people are scaling their use cases across different industries, across different user base. So that is seen. The scale at which these apps have been used today is completely unprecedented. If you see, it is just 3 years back when ChatGPT, the app was launched. That is number one. On the other hand, one can look at it from a financial engineering point of view, whether it is supposed to happen in terms of vendor financing, whether people can scale their balance sheets at such a rapid pace in terms of capex and in terms of capital deployment and lending to their own customers. So you have to balance that view over a period of time and see where the growth actually is going to come from. And the focus, I think, for most people should be on the actual application of the technology and not just having a say that, okay, I have applied AI, but it is just for the namesake and not actually useful in the overall scheme of things. So it's a mixed view in my view. But in the end, you have to be conscious about the valuations you're paying for some of these companies.
Okay, all right.
I think your overseas tech investments is about 11.5% of the overall fund size.
Yes, so we have 4 companies in our global portfolio in the FlexiCap fund.
Yeah.
One is Microsoft, the Alphabet, which is the parent company of Google, Meta Platforms, the parent company of Facebook, Instagram, and we have Amazon, these 4 companies.
So how is this 11.5%? How has it changed in the last 3 months? And what is your view going ahead? Are you looking to bring down or increase your holding given what's happening?
I wouldn't want to give a forward-looking view as to what we will do, but it has been overall in the same range in terms of percentage over the past few months. In fact, if you see from 2022 onwards, that number has declined quite dramatically on account of the Flexi Cap Fund not being able to invest globally from the fresh inflows that we get. So this is the residual amount that we have already invested and some dividends which were reinvested in some of those stocks.
All right. Hi, Ronak. Good afternoon. Good to see you in. Ronak, what about the cash? It continues to remain in mid-20s. You believe better opportunities will come?
We'll see when opportunities will come, but at the moment we are not finding too many attractive opportunities. So within the portfolio, wherever we have an understanding of the business model or the cycle, we are deploying cautiously within those stocks. But broadly, if you see, we have not added too many new things in the portfolio.
You know, one contra call that you'll have gone for big time is IEX. You know, and people are debating weekly expiry. There's going to be some regulation or not. There's a listed and unlisted play. You have gone into the one that's actually come off the top, but there is still not too much clarity out there. Tell us about that call on IEX, because if I look at your last month's sheet as well, you'll have adding on to that position, building a bigger one.
Yes, so IEX has been facing a lot of adverse news flow, if you see, from the past 18 months to 2-year point of view. From the consultation paper coming in and even the dynamics of the market changing. But not much has happened on the ground. That is one aspect of looking at it. The other is when you have an established network effect of a incumbent player who is actually dominant and who actually has the user interface to cater to the demand for shorter term power trading, it is important to understand what is the new proposition that is coming in. So of course, regulatory changes can affect the business model. We are conscious of that, and hence the position has not scaled dramatically. So we have a little bit added to what the existing position was. But on the other hand, we have to see whether the existing competitive advantage remains or not. That is still unclear, like you said. And even the implementation of the overall market coupling, we have to see how it executes over a period of time. So we will take it as the news flow comes in and as the business performance is reported by the company. But so far, there was no need for concern because the existing business model has a very, very strong roots in terms of how they operate.
Okay. Rana, quick question. As a house, what is the view on gold and silver?
So none of our schemes have any commodity exposure, so we don't have a specific view. So our general view has been that these commodities are part of investment portfolios of many people. So asset allocation rules should be followed. You cannot have one asset becoming disproportionate part of your overall portfolio. So as long as people are comfortable with the asset allocation in these commodities, it should be okay.
Okay, great chatting with you. Short one today, but look forward to the next one. Thank you for joining in. Get into a break. On the other side, we'll get you a check on what dealing rooms are saying in our segment D Street Chatter. We'll also get you a few BTST calls. Stay tuned.
से
Welcome back. You're tuned in to Closing Bell, and you're coming to you live from CNBC-TV18 Motilal Oswal newsroom. Well, we have Mitesh Thakkar, who's back with us from Bonanza Portfolio. Hi, Mitesh. The markets tried to pull back. It appeared like we were going to be trying to break into the green, but that's got sold into a little bit. How do you read market action today? If you had bought a contra buy, will you be squaring that, or will you carry the long and fresh trades as well?
So, if you want to buy now, which is basically if you got in at the intraday or the opening point of the day, I think don't carry forward. The reason being, we are sitting at a resistance level, which is what I explained the trend line around this 25,350 mark. So don't carry over. A good positional bet will be if you get the markets closer to about 25,100. That's your positional entry point, and then you can even look at 25,350 or maybe possibly eventually a break beyond that. But if somebody's bought just today with the gap down, I think time to take profits. And on the stock side, Inox Wind is something which is coming on my radar. Inox Wind is a BTST with a stop at about 148 for targets of around 152 half, 153, and the Gas Authority is the other one. Again, that's a BTST with a stop at about 179 for a target of 183.
Okay, all right. Thanks very much for that, Mitesh. Well, we flashed that story on basically the SEBI's thinking on derivative contracts. There's been lots of focus on weekly expiries. There was that talk of a consultation paper which is coming out. Yash has been, of course, getting to us how the thinking at SEBI is evolving. Yash, tell us more.
Well, Prashant, as you rightly pointed out, of course, the whole development around, whether to keep weekly expiry or whether to remove it and move towards longer-term expiry has been taking all the headlines. Now, one very important development that we've been able to pick up from our sources in market regulator SEBI is that any changes to weekly expiry, which is to the current mechanism of weekly contract expiry, will only be made if the data which SEBI is collecting shows heightened activity or involvement from retail investors. Importantly, what we've picked up from our sources is that the data which market regulator SEBI is collecting to study is between July 2024 to September 2025. That 1 year data, approximately a little over 1 year data, if it shows heightened activity from retail investors, only then SEBI might think of doing any changes to weekly expiry. Now, also along with that, what we've been given to understand, even if that data shows some bit of heightened activity from retail investors in the derivatives market, then SEBI might also think of first looking at various other measures. The intention here would be to let the retail activity cool off on its own, and only if that does not happen, that outcome is not achieved, then some changes could be made as far as the weekly expiry or a consultation paper there or the consultation process there is concerned. What are these other measures which could be considered before, making any changes to weekly expiry? One thing that we've been able to pick up from our sources is essentially taking the disincentives away when it comes to long-term contracts. 3-month, 2-month contracts, maybe making them more attractive and taking the current disincentives or the cost which they have, taking them away to sort of automatically let retailers flow into longer-term contracts without making any disruptions to the current mechanism of weekly expiries.
Thank you very much for that. Sudeep Bandyopadhyay is now joining in on this last leg of the show. Sudeep, you want to comment on what Yash was sharing with us?
Well, I think, there is definitely some amount of change which is on the cards. Both the government as well as the regulator and including the central bank. I think they're worried about the speculation which is happening in an unbridled manner through these short duration option contracts, which is leading to significant loss for the retail. They definitely want to do something about it. Now, if things can be done in a manner without disrupting the trade flow, that is, banning the short-term contracts and introducing only long-dated contracts, I think they will definitely try that, because obviously for the health of the market, volume is extremely important. And by removing the short-term option contracts, a significant amount of option volume probably will disappear. And that's is not definitely in the long-term interest of the market. So they will try to marry these two ends and come up with an optimum solution. I think that's the effort, which is what I understand from what is being talked about.
Yeah, no, absolutely. And there certainly does seem to be a little bit of dilution, right, as you said, a rethink on whether, I mean, it should be a hammer approach. And it looks like it's not a hammer approach, as Yash said. They're going to try a lot of other things before they... I mean, basically, the bar to do anything with regards to weekly options seems to be a lot higher as far as SEBI is concerned. Stocks, of course, moved up almost 2,500 rupees now. F&O stats, what's the data looking like? Nigel has walked across to the wall with exactly that. Nigel, tell us.
Well, the kind of setup that we have had, we mentioned earlier today, right, that the market could bounce off the low of the day, and that seems to have played out at least as of now, because we went to a low of around 25,152, and from there we did see a bit of a bounce. And if we just look at the trends, last week's low of around 25,000, and you look at the 20-day MA, it's around 25,050. Till this particular band is held out, you'll fancy your chances that, in fact, the markets could actually continue to be buy on dip and, could trend higher. Maybe some unfinished business at higher levels. Moving to the PCR, on Friday's trading session, it went all the way to around 1.35. Now, because the call writers have come back into play, and you have some put writing as well that's taking place, so the PCR has cooled down to around 1.2 or thereabouts. Just take a look at that. 25,300 call, massive open interest out there. 25,200 call as well, massive open interest out there. Put writing had become a little bit too easy, and now, in fact, the call writers are back in the game. A few stocks that we're looking at from the futures data. RBL Bank, the shorts in the system, they're not getting any kind of follow-through on the downside. The stock continues to remain in the band. But just take a look at it. On a day-to-day basis, it's been recovering from the day's low, and that's precisely what's happened even today. But there are some signs of fresh buying. L&T Finance, stock is up, holding strong with a gain of around 3%, and massive open interest built up on that name. And another financial that's doing pretty well is Federal Bank. Both these two normally don't come on the radar, but on both those two, we are seeing a good amount of buying. So a bit of a squeeze is what we're seeing in today's trading session. F&O data by the end of today will be interesting, but for the time being, the bulls have bounced back and they'll fancy their chances that the 25,000 odd level can hold out.
Thank you very much for that. One stock which has been under pressure since morning has been BLS International. This is after the MEA has barred the company from participating in certain tenders, Indian mission tenders, for a period of 2 years. So we had a chat with the management to understand the impact, and they said they're confident of resolving the issues soon, and there will not be any impact, at least on the existing business. Listen into what they had to say and the kind of clarification they provided.
There were some complaints in some other countries for procedural issues, etc. But we are working actively with the authorities to resolve this issue. I don't see any impact on our revenue, etc. We continue to maintain the growth momentum. Whatever discussions we had in the last few quarters, we continue to actively remain focused on that.
All right, get into a short break on that note. We'll come back with the closing levels. 10 minutes to go. The Nifty is holding on to 25,200 mark. It's just a bit of a downtick of 50 points.
Welcome back. Well, the market's down close to around 50 points, but the good news is the breadth of the market actually has improved quite a bit, because you have close to around 1,000 stocks now that are advancing. Sudeep Bandyopadhyay is with us. Sudeep, wanted your view on Tata Motors. That demerger effectively, takes shape from tomorrow onwards. Today is the last day. Last few minutes, if you want to play that demerger. Tomorrow's a record date. What's your view on the stock? It's corrected big time from the peak. It has had its share of troubles with regard to JLR, but at around the 650 odd mark for a combined entity. What's your view?
Well, Nigel, I'll wait and watch. I think there are still a lot of challenges which JLR faces. Leave aside the cyber attack in UK and what happened there. The demand scenario, both in China as well as in Europe, which are big markets for JLR, is little unstable and uncertain at this stage. There are challenges as far as US is concerned. So at this stage, I'll be a little careful. India also, I'm not saying that there is a problem, but they are not in the leadership position in any of the segments in which they operate. So I think there's a long way to go. If I have to play the four-wheeler or the automobiles pack, I think I will rather go to M&M or even Maruti for that matter.
Okay, all right. Sudeep, you may want to listen into this, story. This is the latest Vahan data with regards to auto sales numbers. Parikshit has looked at this. Parikshit, take it away.
Well, Bajaj Auto leading electric two-wheeler sales in October so far. TVS coming in second. We've seen Ather coming in at number 3 in October. They've been putting up a strong performance. Bajaj Auto has delivered over 11,418 electric two-wheelers to customers in the month of October. Now, this coming despite the shortage of rare earth magnets. We're also told that the company is expecting things to be normal at least till December. Yes, there are fresh restrictions which have been imposed by China, but almost all auto companies are evaluating the impact. But sources tell us that Bajaj Auto at least is well in control of things, at least till December, and they have a strong visibility of the rare earth supply chain at least till December, and after that they'll start working with their suppliers. Having said that, TVS was number 2 with 11,089 electric two-wheelers sold, and they had a 21% market share. Ather sold 9,805 units in October. They increased their market share by 1.4% to 18.8%. Hero sold 6,305 units in October. Their market share remained at the same level as September, as 12%. Ola Electric has seen their market share dip by 1.6% to 11.3%. They sold just about 5,859 units in the first few days of October. Let's see how things go, how the full month is, but it's quite clear that Bajaj Auto and TVS putting up a strong performance with regard to electric two-wheeler deliveries and sales, despite there being supply chain constraints of rare earth magnets.
Okay, all right. Thanks a lot for that, Parikshit. Well, time to wind out on the markets then for today. We go on with the cut-off around 45 to around 50 points, but par for the course, given that the global equity markets itself were in a bit of a tizzy. Adani Ports up 2%, good move out there. Bajaj Auto was up 1.5%, and Bajaj Finance as well, up close to around 1.5%. Interglobe Aviation, it's not cheap, but it continues to hold on to gains. The stock is up close to around 1%. Tata Motors, tomorrow is the record date for the demerger. Today was the last day to effectively buy. So that one, in fact, was up close to around 2.5%, down 2.5% in trade. Tech, that struggled. Infosys, Wipro, both of them are under some pressure in today's trading session. From the broader markets, various stocks are doing a thing of their own. KFin, stock was up 6.5%. BSE, maybe the weekly expiry fears actually are going away now. Yash, our colleague, had put out that big story, and the stock was up 4.5%. MCX as well. Volumes have been very, very strong, so that one did well. So the stock, the market-related players and the exchanges did well. MCX, BSE, throw in there an Angel one as well that was up close to around 2% in today's trading session. What came in for profit taking? Keynes, that was down close to 3.5%. Syngene was down close to 3%. And Avenue Supermarts as well. Well, that one as well was down by close to around 3%. Not a cheap stock. And, that one, in fact, came out of the disappointing set of numbers. What else got hit today? BLS International Services. Stock was down. BLS E-Services as well was down. Negative news flow on BLS International Services. That's why that stock was lower in today's trading session. Tata Communications had a big, big run and optimism with regard to the data center play in Friday's trading session. Today it was down close to around 4.5% in trade today. So all in all, We go home with a cut of around 40-50 points odd, but the bulls will not be feeling too bruised today because of the breadth of the market was one stock declining for one stock advancing for two stocks declining, and we had close to around 1,000 stocks that ended in the green. On that note, we'll wrap up on this edition of Closing Bell. You stay with us. Markets Forward comes up next.
Powered by LIC, हर पल आपके साथ. Co-powered by SBI, बेस्ट है सबको पता है. Co-powered by SBI, बेस्ट है सबको पता है.
Dalal Street ends mixed but sharply off lows. The Nifty and the Sensex end in the red, but manages to hold on to 25,200. Broader markets outperform the blue chips.
The stocks of DMart owner Avenue Supermarts slips after its like-for-like growth tempers and margins crimp. Amid rising competition, DMart Ready also consolidates, pulling back operations to 19 cities from 24 cities in Q1.
Despite the strong investor interest in the IPO, Tata Capital sees a muted listing, with the stock opening at 330 versus an issue price of 326, implying a listing gain of a little over 1%. Hello and welcome to Markets Forward, your go-to show where we aim to get you all the key data points to gear you up for the next trading day. I am Reema Tendulkar. With me is Vinny Motibala. Hi, Vinny.
Hi, Reema. So an interesting day where we saw a bit of a sharper fall in the first half of the trading session. Then we did manage to see that recovery coming in for the Nifty as well. So that is interesting to watch out for because today we've surely seen 25,200 is what the Nifty is managing to hold on to, and a very good recovery coming in, especially in the broader end of the market.
Indeed, the day's low on the Nifty was 25,150. So at one point of time, the Nifty was down in excess of close to about 0.5%. And it looked like, given the way Asia closed, that we would perhaps end in the red. It was a weak start for the Indian markets, but we staged quite the recovery, especially in the last hour of trade, though finally ending with a modest cut of close to about 0.25%. But remember, when we closed up, Europe had opened up and Europe was in the green, trading firmly with a gain of close to about 0.5%. A lot of sectors, lots of stocks on the way up, but I think if you had to pinpoint to one sector, it would be banks. Most of the banking names were higher today. The Nifty banking index off from the day's high, but still managing a positive close. And autos picked up towards the end of the trade, and perhaps that's to do with the October Vahan data.
Absolutely, so an interesting day that's coming for the markets. But, well, we have a very exciting lineup for you all on the show as well. And what's in store for today? We'll start with the top movers and shakers of the day with Vivek Iyer. Avenue Supermarts slipped in trade, and this is following a weak Q2 FY26 number that they posted. Meanwhile, CE Infosystems surged after the Ministry of Railways announced the collaboration with India. We have Fintech Technologies that also gained sharply, buoyed by the ratings upgrade from Brokerage firm Citi. Last but not the least, we'll delve into the key market events to watch out for in tomorrow's trading session. But first up, let's go across to Vivek, who's at the wall to tell us which are the top movers and shakers of the day. Vivek?
Well, thank you so much for that. Well, it was quite a dull trading session, at least for the first half, but activity, picked up quite significantly, especially in the second half of the trading session, and there was a sharp recovery from the intraday lows. In terms of individual stock movers, first on the list, is India or CE Infosystems. Well, very strong volumes for that particular name. Cooled off a little bit, but still on strong volumes. Remember, Ashwini Vaishnav actually went ahead and endorsed this particular name. On the back of that, there was renewed excitement here. Jubilant Ingrevia, one of the top gainers as far as the NSE 500 was concerned. Also will be important to see the monthly data as far as exports are concerned for both chemical as well as pharmaceuticals. Fortis Healthcare, this particular stock, despite the fact that the open offer price was much lower compared to the current market price, despite that you're actually seeing this particular stock continue to move higher. Again, a 3% up move over here. MCX, very, very strong volume activity for this particular name. Analysts believe that QOQ, there has been a significant surge in activity. That stock higher by 3%. And GM Breweries, like we mentioned, follow-up buying seen after what was essentially a very strong Q2. So it moved higher on Friday, and today another 5%. On the other hand, the entire IT pack under significant pressure today. Most of them fell anywhere between 0.5% to 3%. Consumer durables also lagged, especially in the first half. Names like Voltas, Blue Star Havels, all of them did see selling pressure. The consumer durable names are the ones that we are discussing. GK Energy, again, a recent listing. That particular name on a sequential basis actually moderated down almost 2%. You looked at Keynes Technology, this particular stock almost down 10% in the last few trading sessions. And Minda Corp, one of the top laggards as far as the NSE 500 was concerned today.
Let's just have one more stock, BLS International. That was the big accident of the day. Stock ending down close to about 10% after the Ministry of External Affairs prohibited the company from participating in Indian missions for at least the next 2 years. But let's move on and talk about Avenue Supermarts. That fell 2% after disappointed in the second quarter. The like-for-like growth tempered in Q2 versus Q1, and margins declined 30 basis points on a year-on-year basis. Manglam joins in with the fine print.
Well, the street did not like the EBITDA performance of DMart because the revenue was largely in line with the subdued second quarter update that the company had given already. 15.5% on a consolidated basis. The company's same-store sales growth or a rough around 1% mark in terms of expectations. It was below par, but the stock price had adjusted for that. So now there are only two things we have to look at: EBITDA margins as well as the net profit. Net profit too grew at just about 2.3% for DMart, and this was largely on account of higher depreciation and higher finance costs, where the company, has been expanding their store network. Employee costs also were higher this time around as they've increased the the number of stores and increase the number of employees per store to improve service levels as well. So the street is divided on DMart's numbers this time around. Even as the stock is at the low point of trade, some believe that the company is in a transition phase as it battles competition from quick commerce, expands its own network, and battles high valuations as well. While some say that competition and the high valuations stand as headwinds in front of DMart. Today and the day the second quarter update came, the stock saw a bit of a decline, and that's largely on account of the reported performance as against what the street's expectations for the next couple of quarters are for DMart.
Okay, Mangalam, thank you so much for that. But let's bring on board our experts for today. We have Sandeep Bandapadhyay, market expert, as well as Jay Thakkar of ICICI Securities joining us to talk to us about the markets as well as individual stock names as well. Sandeep, I want to start by talking about, Avenue Supermart in terms of numbers that have come in, largely in line, but nothing exciting or specifically that's come in that is a standout. Concerns coming in on DMart Ready side as well. Does this actually give us signals in terms of the side of a move that we could see coming in from such companies, or what are we watching out for now?
Well, Vinny, I think the company is in a transition. They need to do quite a lot to come back to ship. They were leading retailers at one point of time, and the market was really kind of giving them a fantastic valuation and fantastic respect. But things have changed since then. There is tremendous competition, and also the e-commerce, and the quick commerce business has eaten into their market share. They have been trying to do and compete by getting into that space as well. But I think that foray hasn't met with that kind of a success. They're now consolidating there. So while it's a good company, they're doing quite a lot of good things. Store expansion, which is critical, is being undertaken, and that is leading to some of the pain in the P&L, and which is very understandable. But the fact remains that the valuation is not cheap. And at current valuation, even at current valuation, I would say the margin of error is very, very limited. So I'll wait and watch. I don't think I will recommend a buy or even recommend initiating position from a long-term perspective as well. Let's wait and watch how things unfold before taking a call on this.
Got that. Jay, just the way the markets recovered from the day's low, does that give you confidence? What's the positioning for tomorrow in terms of index and any individual stocks on your radar?
Hi, good afternoon to you, Rima. And very well, as far as Nifty is concerned, definitely, we have seen Nifty taking good support around the levels of 25,150 in today's trading session. Our view for the short term, Rima, is positive. We believe that until 25,000 levels on Nifty are held, the overall, trend remains in the short term positive for the targets of, say, 25,400 to 500 range at least, which was the previous swing. Now, also one study which we have done, Rima, is that in last 6 months, if you see, Nifty has tested in last 22 weeks almost 16 times it has tested 25,000 levels. So it's just 6 times that Nifty has either remained above the levels of 25,000 or below. Else, it has hovered somewhere around 25,000 levels. Hence, 25,000 becomes a very critical support levels in the near term. We have seen short covering across the sectors, Rima. If you see in the previous rally from 24,400 to 25,400, and if you compare that to the current rally from 24,600 to the recent one, the banking and financials, which has around 35% kind of a weightage in Nifty, did not perform in last rally. It's performing in this rally. So that's something positive, and it's just the Nifty IT, Rima, which has a good amount of shorts. Nifty IT and Nifty Realty. These are the two sectors which has a good amount of shorts. And apart from that, I think, and which comprises of around 12.5% only of shorts. The rest, I think that we have seen a good short covering and long build-up as well in stock sector specifically. So till 25,000 levels are held, one can remain positive. And stock specifically, as a disclaimer, I would like to say that we might have recommended those to our clients as well. But then Bajaj Auto from the Auto Pack really looks positive. Bajaj Finance, Shriram Finance from the financials looks positive. So the financials and auto are the two sectors which are really performing well. And from the capital market segment, MCX, wherein we have seen good long build-up, Rima is likely to make new highs and inch towards 90-100 levels. So these are the few stock recommendations.
Okay, keeping an eye on the stocks as well. Thanks so much for that, Jay. But let's move on. And in commodities, that's what we should be putting the spotlight on, right? Because that's shining bright. Silver spot prices have hit a high of $50 per ounce, driven by strong physical demand in India. Manisha Gupta is joining with us now to give us details on that front.
And today is yet another day when you have silver trading at all-time highs. We seem to be inching close to that $50 an ounce mark here. And with this, we are up by nearly 6% on week for silver. It's up by 20% on month. Silver has gained 60% in last 6 months. It's up 78% in this year until now. Well, to begin with, it's all about the international markets where we are looking at liquidity concerns in London. Remember, for the last 4 decades, it is London that fixes the silver price. But currently, New York is trading higher than where the London prices are right now. And of course, the government shutdown doesn't make it any easy in sense of custom clearance when it comes to US. The second point is about the borrowing prices for banks, which are much on the higher side when you're buying silver. Silver continues to be very, very volatile. And at these higher prices, markets perhaps thought that India wouldn't buy that amount of silver. But given all of these international conditions, throw in the strong Indian festival demand, even as these prices, and that really seems to be taking prices much higher. For India, we're trading at around 10% premium. I was talking to various jewelers and bullion guys in India, and they say that people are ready to pay 22,000 rupees of a premium per kg to buy silver. So there are delayed deliveries, imports are coming slower, and the demand has been quite strong. But remember, the Indian silver demand is 95% physical and 5% is ETF and digital silver, etc. So it still is physical demand that seems to be setting the criteria for the other markets as well. So while we are looking at physical premiums continuing, that is converting into silver ETFs as well, trading on a premium there. The digital buying is also on the stronger side, with the expectation that this year as well, you could be looking at around 5,500 to 6,000 tons of silver being imported into India.
Thank you, Manisha, for that. The frenzied moves continue in silver, and gold too has been on a tear. Sudeep, from a retail investor point of view, now many funds, mutual funds have stopped the silver fund of funds, ETF fund of funds, but you can still participate via the ETF. So if someone wants to start an SIP in gold, silver, or a combination of gold, silver, the ETFs which are available in the market, and do it via an SIP format for the next, say, 3 years, 5 years, would you recommend starting right now?
Well, Rima, I think I will advise a slightly different course. There are a category of funds called MAF, Multi-Asset Allocation Fund, which invests in equities, bonds, as well as commodities, which is basically gold and silver. Considering the level at which gold and silver is trading, which is near all-time highs and all that, I would recommend, instead of a pure play gold and silver fund or an ETF or any other instrument, rather get into a multi-asset allocation fund where your chances of optimizing returns will be much better. That's pretty much for the retail. I mean, if you are a trader, it's a different strategy.
In fact, we spoke to Tahir Badshah of Invesco in the morning, and we asked him, and he said we have a multi-asset fund, and in that, the holding of gold and silver is close to about 20%. But lots of other stocks, Vinny, that were in focus today?
Absolutely, a lot of other names that were in focus, So let's start with one of the first ones. We'll start with the C Infosystems, or MapMy India. Now, this is buzzing in trade. Yesterday we saw a tweet that came in on... post that came in on X, that is from the Ministry of Railways, that they said that they'll collaborate with MapMy India through an MOU. We had seen Ashwini Vaishnaw tweet about Maples as a technology as well. So that is something that led to a up move in today's stock because of this MOU with the railways. Now, other than that, we have Dreamworks. That's also in focus. We've seen the stock gaining for the last 5 consecutive days. In those 5 days, we've seen almost a 35% up move. Now, this is because there are a lot of recent announcements that have come in after the negative announcements we've seen in the month of July to the beginning of September. We've seen some negative news flows coming in. Now, in the recent news flow, Dreamworks said that they have signed up and tied up with WSFX Global Pay, and they have announced a strategic partnership there. They've announced some club memberships as well for Anchor as well as value-added services. They're moving from that lounge services and domestic lounge services, focusing on the other businesses as well. Vari renewables, that's another one that was buzzing in trade today. Q2 numbers, good set of numbers. Net profits have more than doubled. Revenue also was up by 48%. So stock was buzzing away in trade. And lastly, Fintech. This was after Citi has actually upgraded the stock to a buy. Target price of 1,215 rupees. They said that the company is quite well positioned in terms of benefiting from the mutual fund flows that one has seen coming in. Look at the SIP data this time as well. Strong and steady is what we're seeing in terms of the numbers there. Growth in alternates is increasing. Rise in international clients is something that is aided by Ascent's global capabilities is what Citi highlighted, and that is one of the beneficiaries that comes in there. So these are some of the stocks that were moving away in trade today.
Okay, thank you very much for that, Jay. Quickly, any technical trades in the stocks Vinny was talking about?
Overall, these stocks are likely to trade with a positive bias, Rima, in the short term. And as I said that, the capital market stocks have really done good in the near term. So Fintech, which I think has seen a good short covering, might see further upside, at least until the levels of, say, 1,300 or so in the near term. Because capital markets team overall has been witnessing short covering in the short term. Apart from MCX, wherein we have seen long build-up, rest all the stocks are witnessing short covering. We saw that extending into the BSE as well today. So Fintech is one stock, Rima, which can see further upside of at least 5 to 10%.
Thank you very much, gentlemen, for joining in. We'll get into a short break. On the other side, top corporate voices and the big events to watch tomorrow. Stay tuned.
Welcome back to Markets Forward on CNBC TV18. Now let's talk about Tata Capital, and this is despite a strong investor interest in the IPO. Tata Capital actually made a muted debut on the D Street today, listing at around 330 rupees per share, just above its offer price of 326 rupees. Now, speaking to CNBC TV18, the company's management said that Tata Capital has multiple engines of growth and that 99% of its loan book is organic in nature. Listen in.
If you look at our portfolio, we are present in all segments. We have multiple engines for growth, whether it is the consumer business, whether it's housing, whether it's SME, or it is corporate. So we have believed in a strategy of using multiple engines for growth, and we will continue to do so in the future too. It gives us a big advantage. Even if one segment is not doing well, we have an ability to go conservative in that area and accelerate the other areas so that our overall growth rate does not get impacted. That we do believe helps us in creating a model which is resilient both on growth and quality. We do believe that we know our business well, which we have demonstrated by ensuring a strong growth rate as well as a strong portfolio quality. And that is the reason 99% of our book is organic in nature. And we would like to continue that strategy in the future. Fintechs are playing a big role in the Indian economy. We do partner them for better operating efficiency, but as far as origination is concerned, we want to remain largely organic in nature.
All right, let's now take a look at the key corporate voices that we heard today. So first up, OneSource Specialty Pharma. We asked them about the Biosecure Act, and the management said that this new US Biosecure Act is changing the conversation across the American pharma industry with a focus to diversify supply chains and reduce concentration dependence. The management added that this is actually a significant upside for the Indian CDMO companies. They've already seen an increase in the RFQs, requests for proposals, and queries. And the company believes that a slight shift in demand to India could unlock big opportunities going ahead.
And BLS International, that was tanking in trade today. We spoke to the management today, and they highlighted that the Ministry of External Affairs issued a letter on account of some customer complaints for procedural issues. However, the company remains quite confident that the development will not have any material impact. The management further highlighted that the firm continues to win new tenders and expects a pickup in growth momentum. The Indian mission contributed significantly to both the revenue as well as EBITDA. Revenue was around 10%, while EBITDA was around 8% in Q1 FY26. BLS International currently is operating in more than 70 countries while actively exploring mergers and acquisition opportunities as well.
And before we wrap, let's get you the key market events to watch tomorrow. And I think the big one's going to be the LG Electronics IPO. But Ria, tell us more.
Well, yes, first starting off with the economic data, watch out for the unemployment data coming out of the UK. And in India, we have the inflation print. Also watch out for the results of Persistent Systems as well as Tech Mahindra. Other earnings tomorrow include ICICI Lombard, ICICI Prudential Life, Cyan DLM, Irida as well as Bank of Maharashtra, among others. Star Cement will hold a board meeting to consider a fundraise tomorrow, so watch out for that. Of course, as you said, the listing of the LG Electronics IPO will be the big event to watch out for. And tomorrow is also the record date for the demerger of Tata Motors. In other events, Trump is set to levy a 10% tariff on lumber and a 25% tariff on wooden goods from the 14th of October. IMF will launch its latest World Economic Outlook in Washington, D.C., and they will also be holding a press briefing for the Global Financial Stability Report.
Okay, Ria, thank you so much for that. But with that, we're going to wind down this edition of Markets Forward. Thank you so much for tuning in. More news and updates on the other side.
Co-powered by SBI. बेस्ट है सबको पता है. presented by Standard Chartered.
Hello and welcome to Business 360. I'm Arundhati Ramanan, and here are the headlines that we're tracking for you this evening. Global markets on tenterhooks after US and China trade conflict flares up once again. Stocks edge higher in Europe after President Trump signals openness to dialogue, claiming it will all be fine. Trump also warns China's export control on rare earths is a major barrier to talks. Indian officials will head to Washington for trade talks. Sources highlight good progress in negotiations. Both sides are hopeful of concluding the first tranche of the trade deal by fall. Sensex and Nifty end with marginal losses after a late recovery. Midcaps and bank stocks bucked the downtrend to end in the green. Cryptocurrencies rebound after witnessing the largest liquidation in history over the weekend. The industry saw liquidations to the tune of over $18 billion over the weekend on the back of an escalation in US-China trade tensions. Relief and jubilation across Israel and Gaza as hostages start returning home after 2 years of captivity. Hamas claims all living captives have been freed. Israel approves the release of over 1,700 Palestinian prisoners. US President Trump lands in Tel Aviv amid hostage release, declares that the Gaza war is over. Tata Capital makes a muted debut on the Wall Street. Shares list at a premium of 1.2% over the issue price. Its 15,500 crore rupee issue was India's largest IPO of 2025. Zoho founder Sridhar Vembu calls Aratai, their newly launched messaging app, a contrarian bet, calls the migration of email accounts of central government employees to Zoho platform the start of a Swadeshi awakening, calls for regulations of global capability centers so that innovation developed by Indian talent benefits the country, says the AI bubble could burst. The ruling NDA finalizes seat sharing ahead of Bihar Assembly elections. For the first time since 2005, BJP, placed on an equal footing with Nitish Kumar's JDU, will contest 101 seats each. Chirag Paswan's party will contest 29 seats. The India bloc is expected to finalize their seat-sharing pact today. The top story moving the markets worldwide, the fragile trade truce between the United States and China has been broken. Beijing has launched a barrage of measures over the last few days, rankling Washington. Stock market slumped soon after the retaliation resumed. US bonds tumbled, cryptos crashed, and crude oil prices plunged nearly 5%. Here is a quick look at the sequence of events over the last 2 months that has brought the world's two major economies back on the brink of a trade war once again. On the 11th of August, US and China agreed to extend their trade truce by 90 days. Things were calm for nearly a month, but on the 4th of September, US asked European Union to impose 50 to 100% tariffs on China for buying Russian oil. A few days later on, the 15th of September, things looked upbeat after Washington and Beijing agreed on a framework for a deal over TikTok's US business. But on the same day, China launched an antitrust probe against US semiconductor giant Nvidia, alleging abuse of market dominance. 4 days later, things looked bright once again as President Trump and President Xi held a phone call and agreed to meet each other at the end of October in South Korea at the sidelines of the APEC summit. On the 24th of September, US Treasury Secretary Scott Bessent said Boeing aircraft parts and some chemicals will be important leverage for the US in negotiations with China. On the 1st of October, President Trump said declined soybean purchases by China will be a major topic of discussion when he meets Xi Jinping. On the 7th of October, US lawmakers sought a ban on exporting semiconductor making equipment to China after detecting sales worth millions of dollars in the last 1 year. On the 9th of October, China expanded export controls on rare earths, announcing it will take effect from the 8th of November. All hell broke loose on the 10th of October, with China increasing port fees on American vessels and hitting tech company Qualcomm with a new antitrust probe. President Trump announced 100% tariffs on China, which will take effect from the 1st of November. China is using rare earths as leverage since it controls 90% of all rare earths being refined worldwide.
The US has also ramped up the tariffs, which many trade economists say amounts to a trade embargo. Washington has also threatened to block exports of critical software. So what's next? Both leaders could meet on the sidelines of the APEC meeting in South Korea later this month. The measures announced by both nations will kick in only from November, and many experts are hopeful of a deal before that. President Trump also sounded upbeat about the prospects of a truce.
I think we're going to be fine with China. Look, I have a great relationship with President Xi. He's a very tough man. He's a very smart man. He's a great leader for their country. He's a great leader. And I have a great relationship with him. I think we'll get it set. I know what happened. I really understand what happened. And I'm not even saying he's wrong. But then we met him with something much tougher than what he did to us. Again, because of the tariffs, it's much tougher.
On to the day's market action. Dalal Street ended mixed but sharply off lows. Nifty and Sensex closed the day in the red, but Nifty managed to hold at 25,200 mark. Broader markets outperformed the blue chips. On to the commodity market. Bullion continued its golden run as investors looked for safe haven amidst U.S. President Donald Trump renewed tariff threats against China. Expectations that the U.S. Federal Reserve will interest rate cuts only added to the yellow metals allure. Gold prices have surged nearly 50% so far in 2025. Silver also jumped to an all-time peak, tracking gold's rally. From commodities through cryptos, which have recovered marginally after witnessing the largest liquidation in history over the weekend. The industry saw liquidations to the tune of over $18 billion over the weekend on the back of an escalation in US-China trade tensions. Manisha Gupta is here with all of those details. Manisha, what triggered the sell-off?
Well, it continues to be very, very volatile for the crypto as an overall market. While we have seen some sanity, some rebound happening after that very heavy sell-off that we saw over the weekend, but we are nowhere near the prices before this liquidation happened. Well, Trump threatening China that it would launch another additional 100% tariffs on Chinese goods really led to prices coming off. And that was across asset classes. So whether it was about currencies or commodities, we saw equity markets decline quite sharply. Remember, the US equities saw the steepest decline in 6 months that you saw in that one day. And that's exactly what we saw in case of cryptos as well. So when you look at the overall markets there, Bitcoin was trading at 115. Before this decline, it went all the way down to 103,000. Now, this is nearly 9 to 10% of a decline coming in. Ethereum, which is the second largest crypto in sense of market cap, fell from 4,400 to 3,750. That's a 15% decline. And then you had something like a Solana falling from 223 to 178, which is almost a 20% decline. So it has been very, very sharp declines coming in. When you look at the overall number, then the total liquidations that crypto saw was to the tune of $18.3 billion. Now, this is the largest one-day decline ever in the history that we have seen in sense of liquidation come in for crypto. And within this as well, it was nearly $5 billion of a liquidation in Bitcoin that we saw, $4 billion in Ether, $2 billion in Solana, and then various other cryptos as well. If you look at the prices in the last 1 week or 1 month, we seem to be trading in the negative right now. And within this as well, it's only Bitcoin which has declined the least. If you look at the others, it's anywhere between 10 to 30% of a decline in many of these cryptos that we are clocking in for the last 1 month. But then again, if you look at the last 1 year, it is double-digit to triple-digit gains that many of these cryptos seem to be offering. Bitcoin is up 75% in last 1 year. You have Ethereum up 60%. You have Ripple, Cardano, Binance giving you triple-digit returns as well in the last 1 year. So the near-term volatility clearly seems to be very, very high right now, and much depends upon the kind of developments and statements that we hear from global markets.
Right, Manisha, many thanks for those details. Now, the big macro data of the month, retail inflation eased to 1.54% in September. This is the lowest reading in more than 8 years. Lata Venkatesh is here with all of those details to decode those numbers for us. Lata?
Well, it's as per the CNBC-TV18 poll. Our poll had thrown up about 1.55 thereabouts. It's coming in at 1.54. One should remember that this is way lower than the Reserve Bank's mandate, which is to keep the inflation between 2 and 6%. Basically, keep the inflation at 4% plus or minus 2. It is below the lower bound, and that's very significant. The reason for this is primarily food prices. Food prices have fallen with a thud. It is the 4th month of negative YOY food prices. That is a fall in food prices. It is minus 2.28% lower the food inflation for the month of September. As you can see that we are in negative terrain all the way from June. And, if you look at individual items, there's practically nothing that has risen except a little bit of rise in fruit. Otherwise, cereals have fallen month on month very sharply. And, of course, year on year as well, we have a fairly big... cereals, pulses are important because they're an important source of protein. That's down minus 15% year on year. Cereals up 2%, meat and fish up 2%, egg up 2.7%. None of the food items are up more than about 2%, and many of them are down double digits year on year. So this is a significant reduction in food inflation. It will not even end here because, we have a very big base effect coming up in October as well. And therefore, we are going to see definitely another month, if not couple of months, of negative food inflation numbers. The one that's pushed up the inflation a little bit, taking away the negative impact of food, is core inflation. That's coming at about 4.5%. It's a little difficult to talk about core inflation because many people have a different view on what you should include in core. Basically, services are included in core. What is not importable is included in core. It's non-food, non-fuel prices that are included in core, and that's up 4.5%. The reason why it's up is because year ago, core inflation was very low. It was 3.5%, and therefore, the low base also makes the core inflation look big. Now, what is the other big takeaway other than the low food inflation from these numbers? The average. If you take July, August, September, the Reserve Bank always forecasts the average. The average it forecast for July, August, September in the previous policy was 1.8%, which was a big drop from some 2.7% that was the previous forecast. It had brought it down drastically. And guess what? Now, after we get the September number, the average has fallen to 1.7. So inflation is undershooting the already drastically cut forecast of the Reserve Bank at 1.7%. The expectation is the October inflation is going to be even lower than this 1.54. It is expected to be about 0.6 or 0.7%. So when the Reserve Bank goes into the monetary policy on December 6th, they will have two inflation readings, both of which will be seriously below the lower bound of their inflation mandate of 2%. So guess what they will do? The market expectation, of course, is a repo rate cut.
All right, Lata, many thanks for taking us through those details. Now, trade negotiations between India and the US are likely to happen this week. Sources have said both sides are hopeful that the first tranche of the trade deal will be concluded by the fall deadline. Remember, the Trump administration has imposed 50% tariffs on India, making it the highest tariffs in the world. Shivani Bajaj joins us now with the details. Shivani, what are your sources telling you?
Well, yes, it seems like India's trade engagement with the United States is picking up pace again. A high-level Indian trade team is heading to the Washington, D.C. This week for the next round of discussions on the proposed bilateral trade agreement. This is what Commerce Ministry sources have told CNBC-TV18. So far, 5 rounds of talks have already been held, the last one being in mid-July. And sources say that the progress has been good. Sources in the Commerce Ministry say that both sides are now pushing to finalize the first tranche of the deal by fall deadline, which is October-November 2025, with key focus areas including market access, tariff rationalization and supply chain cooperation. Sources also say that India is now looking at buying more renewable energy from the United States. Now, this development also comes at a time when the new US ambassador to India, Sergio Gore, has finally landed in India. He's known to be close to the United States President Donald Trump, and his appointment is being seen as a signal of continued political will to strengthen the bilateral ties between the two countries. Over the weekend, Gore met Prime Minister Narendra Modi, External Affairs Minister S. Jaishankar, and other senior officials in the Indian government, underscoring the importance both countries are placing on trade, investment, and strategic cooperation. Back to you.
Right, Shivani, many thanks for those details. And speaking of trade negotiations, government sources have said that India and the European Union have made good progress in terms of trade talks. However, issues on auto, agriculture and steel continue to remain unresolved. On that note, it is time for us to head into a short break. But coming up next, Donald Trump makes a historic visit to Israel as the Gaza peace plan gets underway. Israeli hostages start returning home after 2 years. Trump gets a standing ovation at the Israeli parliament. That and more on the other side. Stay tuned. Welcome back. You're still with us on Business 360. The Tata Trust is now divided on taking Tata Sons private. Tata Sons is the holding company of the conglomerate in which Tata Trust owns a 66% stake. The RBI designated Tata Sons as an upper layer non-banking financial company which mandates public listing. But Tata Sons has applied for an exemption and that application is currently under review. Parikshit Luthra is here with all of those details. Parikshit?
Tata Trust, which has always owned a 66% stake in Tata Sons, has maintained that Tata Sons should remain a private entity. It should never get listed. However, in light of the recent tensions and rift between the trustees of the Tata Trust and the removal of Vijay Singh, some trustees are now of the opinion that it might be better for Tata Sons to get listed. Now, Tata Sons has a valuation of $180 billion. They've always had reservations against public listing, but now some of the trustees, we're told by sources close to the Tata Group, are in agreement with the Shapoorji Pallonji Group, which has recently reiterated that Tata Sons should get listed for the sake of transparency and public accountability. Now, the Shapoorji Pallonji Group owns an 18.3% stake in Tata Sons. They've long maintained that a public listing is necessary. Even though there was a resolution a few months ago by all the trustees, and that was passed unanimously, that Tata Sons should be kept private, the recent tensions within the trustees is making people question the resolution and say that perhaps it's time to get a public listing done. While the Tata Sons has paid off its debt of 30,000 crores and they have surrendered their NBFC license, it is up to the RBI to accept this or not. For the moment, the RBI has not said anything on the matter, whether they accept the application to deregister or not. So the final word is still awaited from the RBI. But clearly now there are differences within the Tata Trust about keeping Tata Sons private. And this is a very important step because there are differences over how Tata Sons should be governed, what should be the role of Tata Trusts, and what should be the role of Tata Sons as well. And because of the differences and issues related to corporate governance that some trustees are raising, there are now questions about public listing. Let's see what happens in the days to come.
We'll have to wait and see what happens there. All right, Parikshit, many thanks for those details. Moving on, Zoho founder Sridhar Vembu has called Arattai, their newly launched messaging app, a contrarian bet. Speaking to Shireen Bhan, Vembu called the migration of email accounts of central government employees to Zoho platform the start of a Swadeshi awakening. He has also called for regulations of global capability centers so that innovation developed by Indian talent benefits the country.
Nearly 2 years ago, the government, the NIC, selected Zoho after a very long, arduous process of evaluation, a lot of audits, over 18 audits performed, and it was selected, and it is now already serving a fairly large number of users within the government, I believe about 1.5 million now, and growing. So this happened well before this current episode. Now, how did we arrive at this moment? It's basically, I call it the Swadeshi awakening we are going through. And I have been part of the whole Swadeshi movement, Swadeshi technology movement for a while now. In fact, I am very proud to be associated with the Swadeshi Jagran Manch and Sri Sundaramji from Madurai. And I have actually had long conversations about the need for technology self-reliance in India.
And you can catch the entire conversation right here at 6 p.m. on CNBC-TV18. The big international story we're tracking this evening, all of the remaining living Israeli hostages in Gaza have been released by Hamas and are back in Israel after 2 years of war. A group of 13 hostages were escorted across the border by the Israeli military after a group of 7 hostages was released earlier. Relief and jubilation gripped Israel and its capital of Tel Aviv as thousands of people gathered at Hostages Square. The square has acted as an encampment for families of hostages after Hamas's attacks on the 7th of October 2 years years ago. Meanwhile, several residents of Khan Yunis in Gaza City also filled streets in the anticipation of the return of the 1,700 Palestinian hostages held in Israel. People also surrounded the Nasser hospital in Khan Yunis to welcome the hostages. Israel has approved the release of the Palestinian prisoners, which is set to follow after the release of 28 dead Israeli hostages. As part of the first phase of the US ceasefire agreement, 250 Palestinian prisoners serving life sentences will also be released. US President Donald Trump declared that the war in the Middle East was over before his trip to the region to finalize a peace deal for Gaza. The president reached Israel earlier this morning as the hostages were released. He was welcomed by Prime Minister Benjamin Netanyahu before heading to Israel's parliament. The president received a standing ovation before addressing members of the Knesset. He also spent time with some of the families of the hostages.
Citizens of Israel, my brothers and sisters, this is an emotional evening, an evening of tears, an evening of joy, because tomorrow, sons will return to their borders. This is a historic event that blends sorrow over the release of murderers and joy over the return of hostages. It is a historic event that some believed would never happen. But our fighters believed, many in our nation believed, and I believed.
The US president will travel from Israel to Egypt later today, where world leaders from over 20 countries will gather for the Gaza Peace Summit. President Trump and Egypt's president will chair the summit. British Prime Minister Keir Starmer has already arrived in Egypt for the summit, which will be attended by many leaders, including French President Emmanuel Macron. Prime Minister Modi declined the invitation from Egypt given the short notice. India will be represented by Minister of State for External Affairs Kirti Vardhan Singh. And with that, it is a wrap on this edition of Business 360. More news and updates continue on the other side. Stay tuned.
Presented by Standard Chartered. Co-powered by SBI. Best है सबको पता है.
Hello and welcome to this special macroeconomic analysis show. Inflation for the month of September has slowed to the lowest level seen in the last 100 months. Well, that's actually 8 years. At 1.5%, the reading for September is the lowest since July 2017. This number is in line with CNBC-TV18 poll, which was about 1.5%. This is also above the Reserve Bank's stated mandate to keep the CPI inflation between 2 and 6%. The mandate is for 4% plus or minus 2%. When inflation falls below 2%, clearly the Reserve Bank has not kept to its mandate. So what action should we expect from the Reserve Bank? How will the future trajectory of the CPI be? To parse all this, we are joined by a band of economists, Aditi Nair, the chief economist at ICRA, Madhavi Arora, chief economist at MK Global Financial Services, Anurag Mittal, head of fixed income at UTI Asset Management, and Debopan Chaudhary, the economist from Piramal Enterprises. Ladies and gentlemen, it's an even house. Thank you very much for joining me. Madhavi, first up to you. What's the first takeaway from this? It's a really low food inflation number. Should things get even lower in the month of October?
Yes, Lata. So we're looking at October to go as low as 0.5 or even lower than that. The last 15 days, Monday data is not looking ominous. We will have the full GST effect being felt in the month of October. Even if I assume a 70% pass-through of the GST cuts, you would actually see core inflation coming down by more than 100 pips and headline inflation coming down by 60-70 pips. That would be a big, bump down in inflation for the next 1 year or so before the base effect sort of turns ugly for them. So I think next print would be pretty interesting to watch out for because we'll be looking at CPI inflation actually going below 0.5% for all we know.
Okay. Yes, before this number came, I was getting an average of about 0.7. But as you point out, even this inflation, especially food, has undershot. And therefore, perhaps we should be expecting an even lower than 0.7, maybe a 0.5%. Aditi, your calculation, what are your key takeaways from the current numbers, especially food and core?
Thank you, Lata. Well, we were a little bit higher at 1.8%, so the number has come in, it's been a pleasant surprise and it's been pulled down by the food disinflation being deeper than expected. Interestingly, when we look at the other subsectors, some have actually shown a sequential uptick as well, including housing and miscellaneous. Miscellaneous, of course, is really getting pulled up by the gold and silver price increase. And that will get countered in the current month by the GST rates coming off. So it should be an interesting month. I think I agree with Madhvi that the print in October is likely to be 0.5% or below that. And then after that, the uptrend should resume, but at, the trajectory will be a little lower than what we would have thought earlier, but it's still going to be an uptrend towards the rest of the year. But ending the year with a relatively benign number. So I think now we're going to have to rework our average.
Full year number.
Full year number should now come in, below the 2.6% that the MPC last indicated. How much lower is what we need to work through after the GST impact, plays out through the numbers.
Okay. Well, for the record, the Reserve Bank's forecast for July, August, September was 1.8. If we now do the math of the last 3 months, 1.6 plus 2.07 plus 1.54, you get an average of 1.7. So already the inflation for July, August, September has undershot the Reserve Bank's forecast. If October is going to be 0.5%, as Aditi and Madhavi are telling us, chances are the 1.8% of October, November, December also could be undershot. Debopam, clearly it is a pleasant surprise for you. I remember your expectation was 1.9. This is a sizably lower number. Do you expect, therefore, that December is a sure short rate cut?
Absolutely, yes. I was a little disappointed when the rate cut didn't come through in the previous meeting. And as you rightly said, if inflation is so consistently below the 2% mark, then RBI needs to do something to pump up demand so that inflation starts to go up. So what is true on the higher side of inflation is also true on the lower side of inflation from the RBI charter. So I do expect the rate cut to go through, at least a 25 basis point rate cut to go through in December. And I'm also expecting one more rate cut before this fiscal year ends, that is in February. Another thing that I would like to add is whether this low inflationary trend is going to impact consumer behavior, consumer demand any significantly. Prima facie, it may not, because if you look at the CAGR of the last 3 years or even the last 5 years, it turns out to be 4.5%, 5% in terms of inflation growth. Obviously, because of base impact, etc., we are seeing numbers which are so low. So when you physically go to a market to buy stuff, you may not witness prices which are significantly lower as these numbers suggest. And hence your disposable income may not get that additional leg up to do a lot of discretionary spending at the end of the day. But what is also encouraging is the consistent difference between, or the fact that rural inflation has been below the urban inflation since March of this year. This used to be always the case in India. Obviously, this flipped during COVID, and now again from March, this has resumed, which is a good sign, which means going forward, at least urban food inflation will not get additional, upward pressures because rural inflation is higher than urban inflation. So this is an important point to note that rural inflation once again is consistently being lower than urban inflation.
Okay. So while rural areas are probably going to suffer negative terms of trade because of the fall in food prices, the advantage for rural consumption hopefully will come because inflation is even lower than urban inflation. Well, the bond yields have fallen by 1 basis point since the number was announced. Anurag, from 6.52 to 6.51. What is the market penciling in for December itself? Can it be a 50 in December itself? Because you will have 2 consecutive months of way below 2% inflation.
Good evening and thanks, Lata. See, the bond market, if you look at from the swaps, is largely pricing in 25 basis rate cut in probably in the next policy. I think one of the other factors also to consider is, compared to the previous policy, even for FY26, still the inflation estimate is about 4.5%. So the space for, I think, 50 basis probably at this point is, I would say, slightly lower, unless and until there's a major exogenous growth shock. We would still assume that probably RBI may cut by 25 basis. And of course, between the current inflation prints and by December policy, if India were to stitch together a trade deal with the US, probably even that probability may go down.
Oh, okay. It looks a little difficult because the governor, or rather the stance clearly indicated by the MPC was that there is space opening up to support growth. There can be a very good debate on whether it should be used up in December or whether it should be used up in February or April. But clearly space opens up even more widely after this number is announced. Madhvi, what is your forecast, full year and next year?
So full year, we're looking at this point in time close to around 2.2% with a downside risk of around 30 bips. So it could be as low as 2% for this year. And for next year, as of now, we're looking at a sub-4 print, which is again much lower than the reserve bank. I think it'll be close to around 4.1, 4.2, between 4 to 4.2%, depending on how the pass-through really plays out. So I think the Reserve Bank, while they had downgraded their FY26 forecast for the 4th time since the beginning of the year, I think they still kept some space for a further revision, which probably will happen in the next policy, which could be used as a lever for them to, sort of probably justify a rate cut. Because I think that at 2.6%, they were clearly looking at a further undershoot of at least 40 to 50 bips. And that probably would play out in December, and they would revise it down to close to maybe 2.1, 2.2%.
Yeah. RBI brought down its CPI inflation. The last number we have is, I think, June, the June inflation, right? April, May, June. They had brought it down from 4.9 to 4.5 in the last policy. Now, is it a writing on the wall? They will have to bring it down to probably 4%, you think?
Yes. Because if you look at the MPR also, they kept it close to 4.5% for the whole year for FY27. I think there will be a downshift that will happen owing to GST-led disinflation, which obviously may not be the only reason why they would cut, because that I don't think would be the demand-driven disinflation that you would see. But nonetheless, there is a case for an undershoot for the Reserve Bank in terms of their inflation forecast. And most likely December will also see further downshift in FY26 and 27 inflation, which will be the fifth time that they're revising on FY26 inflation. So I think that could be probably the time for them to act.
Okay, you're at 2.4 for the full year, current year.
As of now, I'll have to see the numbers again, but around 2.2-ish, what I remember is
2.2, okay.
whole year
That's
number.
a far cry from where the Reserve Bank began, which was, I think, at 3.7. So are you going with a rate cut in December 25?
We've been saying that the Reserve Bank had been unwantedly focusing on 1 year at inflation when they're actually going wrong in getting their next month's or next quarter's inflation right. And it is very misplacing on their part to actually put a lot of faith on 1 year at inflation. And I think, there would be a fair reason for them to actually act in the next policy. So we are expecting them to, probably cut in December and beyond, depending on how the tariff effects actually evolve.
Well, actually, President Trump is speaking at the Israeli parliament, the Knesset, and probably something important will come from there. Let me quickly get your views on the next policy and your full year inflation print. Aditi?
Lada, I'm going to say something a little bit different. My full year print, I will rework after seeing the pass-through of GST. It will definitely be 2.5% or less. But how much the GST pass-through happens and how quickly will, affect that. On the rate cut, the space is certainly open. There is a possibility that we will get a rate cut in December.
A little rapidly, okay.
At the point that GST rate rationalization-led fall in inflation is coming with higher demand, not with lower demand. So it's not necessarily, should not...
Is there a cut or not? I have to wrap it quickly, I'm sorry. Is there a rate cut in December?
No, yes.
So far, yes. Okay. Debopam, you are going with the rate cut in December.
Okay.
And your full year
What I
number,
think.
full year inflation would be for this year?
So far, it's still 2.6%. I am a little concerned about food inflation picking up because of untimely rainfall in the eastern parts of the country, which is the rice-producing belt.
Okay.
So
At the moment, cereal prices are absolutely flat month to month and pulses are down 15% on the year. So at the moment, food inflation is not looking very difficult. We'll have to wait and see. Finally, Anurag, the market is only prepared for one more cut, you're saying?
Yes.
Okay.
As of now, that's our case.
It's not penciling in anything in February or next year?
Not right now.
Not right now. All right. We will have to leave it at that and, cut to the Israeli Knesset where the president is speaking. Thank you very much, Aditi, Madhvi, Anurag and Debopam for speaking with us. Expectations are there'll be a drastic cut in inflation forecast and a rate cut in December. Over to President Trump.
He's just a great guy. Everybody loved him. Everybody. I mean, I know some negotiators that are so good, but you wouldn't have had peace in the Middle East. You would be in World War III right now with some of these guys. Everybody loves Steve, and they respect him, and they somehow can relate to him. I've known him for many years, and I've seen it over and over again.
להוציא את חבר הכנסת עודה, להוציא אותו מהאולם, להוציא אותו מיד, החוצה, החוצה, החוצה. להוציא גם את חבר הכנסת כסיף, להוציא את חבר הכנסת כסיף מהאולם, להוציא אותו מיד. Sorry for that, Mr. President.
Thank you.
Please.
That was very efficient. So back to Steve. He's But I tell one story because he was so involved. And then we called in Jared. We called and we need that brain on occasion. We got to get Jared in here. We got to get a certain group of people. But Steve started this all by himself. I call him Henry Kissinger, who doesn't leak. Okay? Henry is a big leaker. He leaked. Steve doesn't leak. Steve just wants to get the job done. He wants to do what's right. But I'll give you just a quick story because, as you know, he's working on the war with Russia and Ukraine, a war that would have never happened if I were president. A shame. 7,000 young soldiers a week are being killed. More than that this last week. It's a shame. It should have never happened. But it did happen, and we won the race, and I took over this horrible war that's been raging, and I thought it would be easily settled. I thought it was a hell of a lot easier than doing what we just did very successfully with Israel and a lot of other people. But this came first, and we'll get that one. But I set up a meeting for him to meet with President Putin, thinking it would be a 15 or a 20-minute meeting. Steve had no idea about Russia, had no idea about Putin too much, didn't know too much about politics, wasn't that interested. He was really good at real estate, but he had that quality that I was looking for, and I didn't see it around in too many ways. And I set up the meeting with Putin, and I called. I said, is Steve finished yet? That was about a half an hour into the meeting. No, sir, he's not. He's still inside. This is in Moscow. I said, well, how's he doing? I don't know, sir. He's still inside. I called up an hour later. Let me speak to Steve. Sir, he's still with Putin. He's with President Putin. I said, wow, it's a long meeting, 1 hour. I called up an hour later, he was still with Putin. 3 hours later, he was still with Putin. 4 hours later, he started to get the word that he was going to be coming out soon. And in 5 hours, he came out. I said, what the hell were you talking about for 5 hours? And he says, just a lot of interesting things. We're talking about a lot of interesting things, including what he went in there for, but you can't talk about it for 5. You can talk about it for a certain period of time, and you know what you're getting. But that's a talent. That's a talent where you can do that. Most people I'd send in, number one, they wouldn't be accepted. Number two, if they were, the meeting would last 5 minutes. And that's what happens with Steve. Everybody loves him. They love him on this side. They love him on the other side. And he really is. He's a great negotiator because he's a great guy. So thank you very much, Steve, very much. And let me also give a very special thanks to someone who truly loves Israel. In fact, loves it so much that my daughter converted. My daughter converted. I didn't know this was going to happen. And Ivanka's here. And Bibi, you do know this was not in the cards for me. You understand that. And she is so happy, and they are so happy. At least I think they're happy. If they're not, we have a big story, right? No, they have a great marriage, and they get along great. They're best friends. They have a very special relationship. But Jared has been so helpful. He really did something very special. He established the Abraham Accords with a group of very wonderful people. I like calling it the Avraham Accords because people that, right? Avraham. It's so cool. It's so much sort of nicer, you know? The Abraham versus the Avraham. I just don't want to sound too sanctimonious when I do it, so, you know, I sort of split it up. This way we keep everybody happy. But we have some very great talent, and they have no excuses for anything that's taken place because we had some unbelievably good people working on this. And then you're going to add a man named Marco Rubio, who is also here. That's right. And I have a prediction that Marco will go down, I mean this, as the greatest Secretary of State in the history of the United States. I believe that. I believe it. And he and I, you know, we really fought it out. You remember, he was tough. He was nasty. Who the hell thought this was going to happen, Marco, right? And now I'm saying he's going to go down as the greatest. He will. He was always smart and sharp, and people respect him. And then we have somebody who's young, but an unbelievable leader. I saw it a long time ago, and he's turned out to be even better than we thought. Right, Susie? I think even better. And that's Pete Hegseth, who is our Secretary of War, formerly Secretary of Defense. And as you know, we decisively won World War I. We decisively won World War II decisively. And everything in between and everything before it, we won everything. And then they had the brilliant idea of changing the name from war, you know, it was war, to defense. And with that went a certain thinking. And we fought in a very politically correct way after that. We always had the strongest military, and now we have a stronger military than we've ever had before. Because of my first term, I've totally rebuilt the military, every aspect of it. But we have, if you think, we settled 8 wars in 8 months. I'm now including this one, by the way, if that's okay. They may say, well, that was quick. Because yesterday I was saying 7, but now I can say 8. The hostages are back. The hostages are back. It is a good feeling. Isn't that nice to say? You know, I just said the hostage. First time I said the hostages are back. It feels so good to say it. But when you settle 8 wars in 8 months, that means you don't like war. Everyone thought I was going to be brutal. In fact, I remember Hillary Clinton during a debate, she said, look at him, he's going to go to war with everybody. And actually, she said, he's got a personality that's all about war. No, and my personality actually is all about stopping wars, and it seems to work. It seems to work. But it also means this name change and our attitude that we're not going to go into a war. But if we do, we're going to win that war like nobody has ever won a war before. We will not be politically correct, but we're not going to be there. And I think, you know, as you mentioned, Bibi, before, peace through strength. And that's what it's all about. The United States has the greatest and most powerful military in the, right now, history of the world. I can tell you we have weapons that nobody's ever dreamt of. I only hope we never have to use them. I rebuilt the military. I was proud to do it, but some of the things I hated to do. I hated certain of the weapons because the level of power is so enormous. It's so dangerous, so bad. But we have to do what we have to do. We make the best weapons in the world, and we've got a lot of them. And we've given a lot to Israel, frankly. And
Co-powered by SBI. Best है सबको पता है. In association with Tata Capital. Count on us. And car ka action hero, Acco.
Hello, welcome to News Center. I'm Parikshit Luthra. Rift within the Tata Trust, the entity that controls 66% of Tata Sons, is the biggest corporate story of the month. Fissures came to the fore just at the cusp of the first death anniversary of the legendary Ratan Tata. We broke the news last week about how 4 trustees of the Tata Trust were allegedly trying to stage a coup. According to sources close to the Tata Group, the 4 trustees include Darius Khambata, Jahangir, H.C. Jahangir, Pramit Javeri and Mehli Mistry. And they've allegedly tried to emasculate the leadership of Noel Tata. Sources close to Mehli Mistry and 3 other trustees claim a false narrative is being painted to make them look like villains. Such had been the extent of the rift within one of India's oldest and biggest conglomerates that it ended up at the doorsteps of the government. Sources indicated that the government intervention was sought by Noel Tata. One of the key demands of the Mehli Mistry camp has been the listing of Tata Sons. Shapur Mistry of Shapurji Palonji Group, the largest private investor in Tata Sons, is a statement called it not just a financial move, but a moral and social imperative. The RBI designated Tata Sons as an upper-layer non-banking financial company which mandates public listing, but Tata Sons has applied for an exemption, and that application is currently under review. The Tata Trust board had met at the iconic Taj Hotel on Friday. As per sources close to the Tata Group, some trustees believe that it may be important to revisit the decision to keep Tata Sons private. Sources say that only 6 months back, the trustees had passed a unanimous resolution to keep Tata Sons private. To take this forward, we're now joined by Thomas Matthew, author of Ratan Tata's biography, and Nirmalya Kumar, former head of strategy and former member of Group Executive Council at Tata Sons. Thank you very much, gentlemen, for joining us. Mr. Matthew, if I can begin by asking...
Thank you, Parikshit. Thank you for having me.
Currently, what we hear, sir, is the fact...
having Professor Nirmalya Kumar on the same panel. You know, I heard so much about it.
Thank you so much, sir. Thanks to both of you for being with us. Let me begin by asking you, currently we hear that there is at least some understanding between Tata trustees to work harmoniously in the days to come. Do you think the differences between members have been resolved or not yet? Do you feel that issues related to the role of Tata Trusts, its governance and control over Tata Sons, all of that is yet to be resolved?
See, Parikshit, according to me, I think we are making a big issue out of something which is not that significant. It is true that there may be some difference of opinion, but I think you're making a mountain out of a molehill. It is true that the difference of opinion would relate to certain significant aspects, but I don't believe there's anything like a coup d'etat here. I mean, who is it being staged by? And are you trying to unseat Mr. Noel? I mean, please understand, to me, this is my personal opinion. Mr. Noel comes from the same bloodline as Jamshedji Tata. And to me, he symbolizes and is emblematic of the values of trust, normative values, integrity, and honesty right from the time of Nusirvanji Tata, the father of Jamshedji Tata. I don't think this is going to be any critical issue, nor is there going to be any situation which will cause reverberations across India's industrial realm or even in Tata Sons. It is normal to have difference of opinion. I'm sure all of them are very mature intellectuals. I'm sure they will be able to understand that they are trustees in a trust which is 100% devoted to philanthropy. And with that as a goal, I'm sure they'll be able to resolve whatever differences they have. This is my personal opinion.
You know, as someone who's worked very closely with the Tata Group, Mr. Matthew, what do you think is the crux of the problem currently?
See, things is what happened in the trust. There could be difference of opinion on processes. There could be difference of opinion on objective, on goals. But that's not causing any seismic tremors anywhere. I don't believe that it is causing any foundational crisis here. But to have certain discussions, to have difference of opinion, is something which is inevitable in any organization for that matter. Even between family members you have between members of the same party. So why will you consider any difference of opinion as something which is earth-shaking and which will cause schism in the trust or in Tata Sons? I personally don't believe it.
Right. Let me go across to Professor Nirmalya Kumar. Professor Nirmalya, we saw just last week a detailed statement by the Shapoorji Pallonji Group, which owns a 18.3% stake in Tata Sons. They called and reiterated their demand for a public listing of Tata Sons, saying it was necessary for public accountability and transparency. We hear that some of the trustees actually agree with the Shapoorji Pallonji Group statement now. What do you think is the right way forward for Tata Sons now when it comes to the listing? Because this is a matter that the RBI has to now decide on.
So I'm not really sure there is a debate over here, because the RBI has already agreed that they should list because they are an upper level financial institution. And given that how large they are and how much control they have in terms of the shareholdings in major Tata companies, it is only natural that there should be some transparency in that Tata Sons. And so listing of Tata Sons is actually a very good thing. It's good for Tata Sons, it's good for the country. So that is why I think the RBI has also said that they should list. Now the question is why not to list and why keep it private? Part of that whole strategy is basically a strategy by some people to put the squeeze on the shareholders. And here, principally shareholders, we are talking about the Shapoorji Pallonji Group. So basically what they're doing is they, at the moment, given that the shares are not tradable, given that the shares are not quotable, given that they have very few rights in terms of appointing directors, the 18% Shapoorji what you call holding, while is valuable in theory, is not valuable in practice because it cannot be traded to anybody else, nor would anybody else accept that kind of shares without having some guarantees with respect to their ability to influence the board of Tata Sons. So in a sense, it's really a squeeze on the Shapoorji Pallonji Group to make sure that the Tata Sons stays private and they can't use any of their wealth which has been put into the trust through their shareholding, which is put into Tata Sons, which is part of their major part of their wealth. So, this is really a fight between the family trying to decide, whether one side of the family should be allowed to monetize its shareholding in Tata Sons. And in fairness, yes, Shapoorji Pallonji should be allowed to monetize their shareholding in Tata Sons at some level, and there should be a method worked out for allowing them to get their money out if they so wish to and sell it to other shareholders. But unfortunately, for the moment, it seems to be locked in with the Tata Trust infighting, and also partially locked in because until the RBI rules whether they have to list or not, we don't know the outcome. If the RBI keeps to its guns and says they have to list, then of course this problem is solved and Shapoorji Pallonji Group can get their money out. If RBI gives them an exemption, which is, I think, rather unlikely because it would go against due process, then, of course, the Shapoorji Pallonji 18.3% holding, which may be worth billions on paper, is still actually in practice worth nothing.
Professor Kumar, I would like to ask you, why do you think it's important for Tata Sons to now get listed? What we have learned from sources is that some trustees believe that it is now necessary because there are differences between the trustees on how Tata Sons needs to be controlled or governed. Therefore, it's important for Tata Sons to be publicly listed. What do you think is the main reason why it should happen now?
So, again, it should have been listed before. The reason it should be listed is because it holds major stakes in major Indian companies. It is a very large holding company. So we want to bring transparency. We want to understand it is in the best interest of the country, in the best interest of transparency to have it listed. Okay, that is the reason to list it. The secondary reason to list it is so that those shareholders who are minority shareholders, if they wish to, can actually find a way to exit Tata Sons and sell their shareholding to others. That's a secondary point. The first point is the reason why RBI wants them to be listed. The RBI doesn't want them to list so that minority shareholders can cash out. RBI wants them to list because any holding company that is this large and holds so much stake in so many major Indian companies should have the veil of transparency lifted.
All right. Let me go back to Mr. Thomas Matthew. Mr. Matthew, what's your view on this matter? Do you think it's time for Tata Sons to be publicly listed?
Parishit, please pardon me. I'm going to take a slightly contrarian view. Having spent some time in the capital market, there is a certain point I would like to make here. Listing as a genre, listing as a principle is good. That is because you need to have transparency. You need to have a lot of public disclosures. Now, listing, when you talk about listing, you normally talk about companies which are privately owned for profit making. I would like to draw a very fine distinction, but fundamental distinction between the Tata Group and the other companies. We need to understand that successive Tatas have put their monies in Tata Trust for the sole purpose of philanthropy, point one. Point number two is that the 66% held by Tata Trust and Tata Sons give them the profits or the dividends for them to run the philanthropic organization. Now, Tatas had been right from the beginning, been the epitome of transparency, integrity, and honesty. Like the present chairman says, what is good for India is only good for the Tatas. That's what Mr. Chandrasekharan has very proudly declared. Now, let me take you back. I have to take you to a historical perspective. You need to understand that Jamshedji, the founder, the novitiate Parsi, devout religious man, had religious underpinnings when he talked about philanthropy because it is ingrained in the religion. Like Mahatma Gandhi says, in numbers they may be beyond content, but in contribution far more. They deserve the praise. Okay. Now, please understand, you're talking about an organization where Jamshedji, when he had his trading company go into bankruptcy, the creditors said, after observing his honesty and integrity, said, what would you do? You be the liquidator and I'll pay you 20 pounds a month. You're dealing with such a philanthropic organization. And if you list Tata Sons, I personally believe the core reason why Tata Sons exist today will be lost forever. And what would happen? And what are the consequences of it? Please understand, Professor Nirmala Kumar may disagree with me, and so will be several others. But I'm not trying to say that I'm completely against listing. But when it comes to Tata Sons, let me explain this to you. If you look at Tata Sons' history, Tata Company's history, profit has not been their sole motive. Let me come to an example of the Mundra, super efficient, that is power plant. R&T during the several interviews he had with me and confirmed by Menon, Prasad Menon, said that this plant was established not for profit motive, but in order to show others that as a large organization, you can establish something for the benefit of the country. But they knew that they were taking a risk. But at the same time, they said if a large organization is not going to take the risk for the sake of the country, who would? Now, if you had listed, do you think that would happen? Second example, let me give you.
All right.
During the COVID-19 crisis, Tata
Mr. Matthew,
Sons
I have to take a break.
Sorry.
Right. Mr. Matthew, I have to take a break. I'm going to come back and I'm going to ask you this question again, and maybe you can elaborate at that time, and we'll also get Mr. Professor Nirmalya Kumar to respond to that. Just stay with us. We're taking a break and we'll be right back. Welcome back. You're watching News Center, and we are discussing whether it is time for Tata Sons to go public or not. Now, this is a debate within the Tata Trust as well right now. Let me go across to Mr. Thomas Matthew and Professor Nirmalya Kumar, who continue being with us. Mr. Matthew, we were talking about the listing of Tata Sons. If I were to ask you, what would have been Ratan Tata's wish when it comes to the future of Tata Sons? Should Tata Sons be listed now? Would this have been his wish as well currently?
Parishit, we had discussed this topic on many occasions. Okay, he was unequivocal in his conviction that Tata Sons actually should not be listed, and I could not agree with him more. Let me just, Tata Sons and Tata Trust embody a very unique system. Please understand, it is not only in India that you have this. In fact, at that time, we studied the Robert Bosch Straffung, or the foundation. Now, 92% of that is Bosch GmbH, that is private limited company, is owned by the foundation. And please understand, there is no listing whatsoever, number one. And it is not that they do not raise public funds. Through bonds, in the last 10 years alone, they have raised almost, if my memory serves me right, about 11 billion euros. And the entire funding is for philanthropy. Now, this is not my point of view. You need to understand the successive chairman of Tata Sons like JRD had no property. He didn't have a car. He lived in a rented house. And let me tell you something very, very important, which we need to absorb and understand. In 1957, because the capital markets were very nascent in this country, Jamshedji went to New York to raise funds for Tisco. And you know what Time magazine said? That his reputation and integrity of Tata would ensure that he will get more than what he's going to request or what he's going to desire from the US market. So here we are looking at a completely different being. And honestly, if you ask me, would making an exception for Tata's sons be against the law? My answer to this is no, because in India, equality is to be maintained between equals, and to treat unequals equally is against the law. So therefore, to me,
all right,
okay.
Let me put that final question. Okay, let me put that final question to Professor Nirmalya Kumar. Professor Nirmalya Kumar, what are some of the questions that the Tata Group is now going to confront over the next few weeks? This matter has gone to the government. Two very senior cabinet ministers have held meetings with leaders of Tata Trust and Tata Sons. What do you think is the road ahead? And some questions that the group was faced, because over the last few weeks, we've seen issues over the appointment of nominee directors on the Tata Sons board. There was contention and differences over the exit removal of Vijay Singh as well. What do you think will happen next?
So I think in terms of Tata, I disagree with pretty much everything that the previous speaker said, because I generally find the more people talk, the less they have to say. But, the important thing to remember is Tata Sons is operating as a company. They have to run as a company. A holding company means we are trying to improve the performance of the subsidiary companies and maximize the profit at the holding company. The way you do the best for Tata Trust, which is the charitable arm, the way you do the best for the Tata Trust is by making more money at Tata Sons and giving the dividend to Tata Trust so they have more money to spend. If you don't make any money at Tata Sons level, you're not going to be able to give any money to Tata Trust. So you have to make money at Tata Sons level, and the more money you make there, the more money you have available for Tata Trust as dividend to spend on charitable things. Second thing to remember is Tata Trust, while it's called Tata Trust, is not a family trust. It is a non-profitable charitable trust, okay, devoted to developing India. Thirdly, you have to remember that for the most part, the Tata Sons will only be impacted by the Tata Trust nominees. Otherwise, I'm sure Chandrasekaran and I'm sure that the team at Tata Sons will be running the companies, and all the company CEOs will be running their companies and not getting diverted by this little fracas that is taking place at the Tata Trust level, because it doesn't really impact them directly, except for the couple of board members that Tata Trust nominates for the Tata Sons board. As far as the disagreement on Vijay Singh and retiring Vijay Singh, I think Vijay Singh should have been retired a long time ago, so I don't see any problem over there. I'm sure that he's been replaced by somebody who would be more able to do the job. So I think in the end, RBI has made a ruling. They need to list. I suspect that to get an exemption from this ruling will not be as easy as people think it is, nor there is any reason for an exemption to be given, because the Tata Sons is a major holding company with a lot of holdings in major Indian companies, which are important for both the shareholders in India as well as the consumers in India. So we need more visibility, we need more transparency. And so in the end, you can try to squeeze some minority shareholders because you want them. It's done all the time in India. I know that minority shareholders are supposed to have no rights in India because the promoters, they are at the mercy of the promoter, whatever the promoter wants to throw their way. Fair enough, and I know that a lot of people believe in that model because
finally,
they lived up with that model.
Was there also a difference between Cyrus Mistry and other leaders at the Tata Group over this issue, over listing?
We never talked about listing. It wasn't really an issue for us at that time, to tell you the truth. It hadn't come up at that time because RBI had not ruled at that time for us, right? So, you know, it was not really an issue. Of course, Ratan Tata would have wanted to keep it private because his job was to squeeze the minority shareholders. So that I have no disagreement on. I'm sure he wanted to do that.
Okay.
Here.
Mr. Matthew.
You know, the previous speaker tried to overdo me by speaking more than I did, but I'm not going to attribute that he has nothing less to say. What he said is a different point of view. And I certainly do understand that Nirmalya Kumar has some grievance because he was asked to leave, and therefore he has some hurt in him. I agree that Cyrus Mistry was a good man and the situation should not have arisen. But to attribute a statement that R&T wanted to excuse minority shareholder
completely run out of time.
Is unbecoming of anybody with the eminence of Professor Nirmalya Kumar to make that statement.
All right. We've completely run out of time, but thank you very much, Mr. Matthew and Mr. Nirmalya Kumar, for joining us with two sides of the view when it comes to this debate. Let's see what happens in the days to come. With that, it's a wrap with this edition of News Center. More news and updates continue right here.
Co-powered by SBI. Best है सबको पता है. In association with Tata Capital. Count on us. And कार का action hero, Acco. Presented by Policy Bazaar.
CNBC-TV18, the Policy Bazaar Insurance Show.
Imagine saving thousands of rupees every year on your insurance premium, and that without even changing your policy or reducing your coverage. That's the power that a tax component on insurance could bring, specifically this time around, the GST component as far as insurance is concerned. Welcome to the Policy Bazaar Insurance Show. I'm your host Yash Jain, and in this episode we explore how GST relief can take away a lot of burden away from policyholders across India. And to break this down further, joining me on the show today are Sharad Mathur, Managing Director and CEO at Universal Sompo General Insurance Company, Mahesh Balasubramaniam, MD and CEO, Kotak Life Insurance, Saravir Singh, Joint Group CEO, PB Fintech. So we have a blend of the entire insurance ecosystem, of course, the distributor, life insurance company, as well as the general insurance company, which gives a fair bit of understanding as far as health insurance is concerned. Let's start with you, Sharad. What exactly was the government's announcement as far as GST on health insurance is concerned? Could you break down that for our viewers just to understand the basics and clear out the foundation for it?
The industry has been asking for it since quite some time, and it's a very welcome move. The whole concept revolves around customer affordability. And when government announced GST, we have been hearing that whether benefit would be passed on to customers or not. So in no way insurance industry, whether it is non-life insurance or life insurance or standalone health insurers, ever thought to have it in pricing adjustments. So it is for the customers, for the common man, and this would going to get passed to them. As a result, say if there was a 100 rupee premium, for example, so policy now would be reduced by 18%, say in case of individual health, PA, and accidental and travel insurance. So it would help us in achieving our end objective, which is insurance inclusion, reaching out to the last mile. We have seen that there are various government schemes for underprivileged communities and for affluent population, which are in urban, semi-urban state capitals. We have seen that affordability is not much of an issue and they are able to buy health insurance, so to say. But the middle group, we call them missing middle. I think affordability was one of the elements where we were seeing that there is not enough offtake willingly also. So now we have to work, industry would be collectively working on the reachability element. Affordability seems to be getting addressed with this GST got implemented on 22nd September. So it is a great benefit for the common man and would have insurance inclusion. And I think sooner, why we should await until 2047 as the government and regulatory goals are.
To you, Saravir, their cuts have been announced as far as GST is concerned on various aspects, and you deal with all those products, health insurance, term life insurance, ULIP, as well as endowment and annuity. In your understanding, how would these different categories benefit different kinds of users? What is the adaptability of these different products? Do you think that the benefits would be quite equally distributed amongst all these important products?
I think, yes, first, just to reiterate, I think what has been announced is that all individual life and health policies, there will be no GST, which means that for term and health insurance, there is an 18% reduction in the total outgo from a customer's perspective. In ULIP and endowment products, it's a little different. In ULIPs, the amounts involved are smaller and they are part of the product construct as well. In endowment and non-par policies, there's a 4.5% GST in the first year and 2.25 in the succeeding years. So that will be removed. So I think that is the context in terms of how much a customer will benefit. From our perspective, I think the most important thing is that protection products, right, which from a middle class perspective are the most important. I think for a middle class family, having term insurance, having health insurance are very, very critical. And both these products will enjoy the highest benefit of 18%. So what we expect is that, and in fact, what the early days are showing also is that on the protection side, both term and health insurance, there is a very smart pickup in demand in September towards the end of the month. And this is something which we hope will continue going forward. Because I think this has been a long-standing demand of the industry, of consumers as well, that on such basic necessities of life, we should not have GST. So I think it's a really very, very big monumental move that the government has done. And I must tell you that even amongst countries around the world, this is one of a very, very, I would say, forward-looking step where a country has recognized that these basic forms of insurance are essential and should not be charged GST.
Very fair point. This has been a demand from the industry that GST shouldn't be so high as far as the basic necessity like insurance is concerned. But to come to you, Mahesh, we often have this discussion, but more often than not, it remains inconclusive. Was a tax cut or a GST cut in this situation the only trigger as far as making insurance affordable is concerned? Or are there more elements to it which will have to be, pushed together to make insurance affordable? We speak about the penetration, of course, that is very low as per global average. But do you think only making, a lower tax or exempt tax on insurance, the single solution to drive affordability and hence penetration?
First of all, as an industry, we laud the Prime Minister, the Finance Minister, and the GST Council for exempting individual life insurance products from GST. I think it's a landmark initiative, and it'll go a long way in increasing penetration in this country. Life insurance penetration is a paltry 2.8% of GDP. But what's more worrying, as Sarabveer pointed out, is a protection gap. Because real insurance is basically the term insurance that people take. The protection gap is as high as 80%, valued at about $16.5 trillion. The retail sum assured as a percentage of GDP, which is reflective of the extent of protection in the country, is less than 25%. Even neighboring countries in Southeast Asia are close to 100%. So obviously there's a long way to go. And there's a very significant step in that direction. But is that the only reason why the penetration was low? Obviously the answer is no. And that is where the industry has been working towards building what we call now the AAA of insurance: awareness, accessibility, and affordability. This addresses the affordability portion. The accessibility and awareness is being worked on by the industry. If you see, I think across both LI and GI, a slew of campaigns have been going on from the LI Council and the GI Council in the last 1 or 2 months, where we are trying to make the awareness of insurance significantly go up. And accessibility, of course, through increased distribution network, increased online presence, etc. So all channels are being activated for increasing the accessibility as well. But AAA is what is required: awareness, affordability, and accessibility.
Okay. Sharad, to come to you, help us understand a GST exempt from earlier 18% with no input tax credit benefit, no inverted duty structure benefit. How does that impact the industry's revenue, profitability, financials as a whole?
What is coming out very clearly that the impact currently, commercial impact, would hover around 3 to 4%, which I do not think is so substantial as opposed to the upside, which is it would result into increasing penetration on population base that currently we still have about 35% population of on a base of 1.40 billion population, which has some or the other form of health insurance. So I believe if this results into solid uptick in gross revenues, premiums for the insurance companies. So the downside, which is loss of 3 to 4%, which would be charged to the revenue input tax credit, which insurers are not able to claim now, would going to fizzle out. So we are not seeing this transactional element as impact on the insurance sector, but the strategic upside, which is increase in revenue and enabling insurance sector to support in increasing the contribution to nation's GDP. We have at an industry level rolled out campaigns, and as individual insurers also we are doing a lot of promotion and creating awareness around. So this thing would going to uphold our initiatives which revolve around transactional as well as strategic as we go and bring the entire nation into social security ambit. health insurance, life insurance are something in the most developed market. If I talk about health insurance, say Australia, for example, we have 70-80% population having health insurance. Or in not so, or say developing markets like Vietnam, also about 60-70 population has health insurance. So I think those are the things which we have started incorporating in our scenarios, and we are making 3 to 5 year projections and how we will use this, leverage this benefit which government has been kind enough to roll out for the common man, to make sure that now common man finds it easy to have coverage under health insurance.
Mahesh, just to follow up on what you said, given that from September 22nd, insurers won't be receiving any GST. So what happens, to the input tax credit that they were using so far? Will it be borne by the policyholders? If so, what could be the net benefit that policyholders might get as far as the GST changes and everything that it brings together with itself is concerned?
So there are input tax implications, I think, for the life insurance industry, and all of us have been doing our workings, and as an industry, we have understood the impact on the input tax credit, right? But right now, I think we need to look at the bigger picture. I think all of us unilaterally as an industry participants have all passed on the benefit of the prices to our customers, both on the fresh policies and the renewal policies. I think the big picture is we all need to support this initiative of the government in terms of increasing awareness and protection in this country. Along the way, I think some of these issues will be taken up. The industry is in dialogue with all its constituent stakeholders, and I think appropriate solutions will be found over a period of time. But right now, I think the most important thing is to make sure that the communication that now insurance is GST free is something that we need to communicate to the broader spectrum of the society. And the price benefits have all been passed on to all the customers across the board.
Sarbvir, let me come to you and let me bring you a very specific scenario. Just to understand, suppose a policyholder buys a long-term policy, say a 5-year plan. This, let's say, assuming was bought in May 2025. Now, if GST relief is announced, which becomes effective September 22nd, how will the tax on that particular product be calculated? Will GST apply on a pro rata basis for the period from May to September, or will it be charged on the entire first year upfront? How would the math behind this in a situation of a long-term policy be applicable?
I think the fact of the matter is that it all depends on how you're paying for the policy. If you've already paid an annual premium, then for the first year, you've already paid GST, and that is over and done with. If you are paying with on a monthly or quarterly basis, as your payments come due, at that moment, post September 22nd, no more GST will be charged. So just as an example, supposing you pay every month, so when your installment for October will come due, let's say it's on the 5th of every month, on 5th October, you will not have to pay GST. So it's fairly straightforward. Till September 21st, there was GST. After September 21st, there is no more GST, and all payments will not include any of the GST charge.
Thank you so much, Sarbvir. But on that note, let's take a very short break. We continue the discussion on the other side of this very short break. A few more important clarifications, a few more points of understanding lined up on the other side of this break.
CNBC-TV18, the Policy Bazaar Insurance Show. CNBC-TV18, the Policy Bazaar Insurance Show.
Welcome back to the Policy Bazaar Insurance Show. And, on this particular episode, we are exploring the most important development that would have happened in the insurance sector, the changes with respect to GST, the relief which those changes bring as far as policyholders across the country are concerned. Sharad, let me start the second segment with you. Also, and just to understand this thing better, if a policy had to be renewed, let's say before September 22nd, which is before the GST changes became applicable, and the policyholder did not renew it using the grace period for renewal, let's say he postpones the renewal by a month, will they be able to avail the GST relief in that situation?
Yeah, so if policy start date is beyond 22nd September, so then they will going to get the GST benefit. And there are quite a few cases we have seen that people had put their renewal on hold, and we supported them, and they got renewed very recently in the current week, and they got GST benefit. Because it's very simple, any policy being issued, renewal on 22nd September and beyond 22nd September, so they will be eligible for GST benefit.
Okay. Saravi, to you, what happens, to group policies purchased by, let's say, a particular corporate for its employees? Will the GST benefit automatically flow through into those individual members also? Or does that remain out of the ambit as far as the GST exempt category is concerned?
Yes, so the rule is very, very clear. It is only for individual policies bought by individuals where this rule applies. For group policies, whether, there are various kinds of group policies, including the health example that you gave. In that case, the GST will continue as it is at 18%. So I think, that there should be absolute clarity on this. It's for individual life and health policies. Group policies continue as they were earlier.
Mahesh, to come to you, do you see insurers using a GST reduction as an important opportunity to rather innovate with low-ticket mass market products, or will the savings simply make the existing insurance policies cheaper? Which way do you see insurers going largely?
Well, I see dual impact, Ayash. First and foremost, India is both an uninsured country and an underinsured country, right? The way I see it is that an 18% reduction can translate in two ways. It can bring in new people who are hitherto not insured to the fold of insurance because they'll find it cheaper. The existing customers can upgrade their cover now because India is also a large underinsured country, right? So both the phenomenon, I see that certainly playing out. But having said that, I think the mass market innovations continue. I think even before the GST era, I think many of us experimented with mass market innovations, sachet-sized products, etc. There, I think the environment needs to be a little bit strengthened in terms of the data flowing through. I think the biggest problem insurers face when they try to do mass market policies is the element of frauds which creep in. Because these are masked underwritten policies where it's pre-underwritten, etc. So therefore, it's light on underwriting, which also means that it exposes the risk for the insurers. So I think these experiments continue, innovations will continue. In fact, last 3-4 years have been a great period for life insurance industry. And Sarbvir will corroborate that because he also sells most of these products on the platform, whether it is annuity, whether it is return of premium on term, whether it is ULIP blended with term insurance. I think a lot of innovations are happening. And this will only probably hasten the innovations because affordability goes up, which means any product we put out there, we'll be able to address a larger population than what we did in the past. No? So I think it's a continuous exercise, and this is only going to energize the innovation stream. Having said that, I think all of us continue to innovate across the various platforms available in the life insurance industry.
With that, we've almost come to the end of this discussion. But one final question as far as all three of our esteemed guests are concerned. And this question relates to the larger goal of insurance for all by 2047. The question is that GST relief is certainly a first step towards achieving that aspirational goal of insurance for all by 2047. What more can be expected and should be done by the government and the regulator? If I could have one suggestion from all our guests, Starting with Sharad, what is that one thing that you would want the government and the regulator to look at and do? Because there is this intent from the government, and hence we have the GST changes also coming through. There's a new chairman at the regulatory body, so can't be a better time to understand this thing. With you, Sharad, starting one suggestion.
So with GST exemption, which in itself is a big move, we need trust and transparency to be enhanced amongst all our existing customers or potential customers, those who have not bought insurance yet. And as we want to achieve insurance inclusion, it becomes all the more necessity to have all service providers, all health entities in the insurance ecosystem, in overall health ecosystem. So the point I'm trying to make is health hospitals, if can also be brought under regulations, only to ensure that there is enough transparency and its standardization of rates for various procedures will going to create a lot of comfort for people, those who have not yet bought health insurance. So affordability plus enough transparency, visibility to how all health service providers ranging from hospitals or insurance companies, diagnostic centers, wellness service providers. So all under one ambit would going to make a big difference. And also to begin with, the National Health Claims Exchange, a government initiative, if we can also have hospitals there. So that itself will going to be a big initial move to support the two elements of trust and transparency.
Mahesh, to you with the same question.
I think I would probably answer this in two parts. One is what I call triple B of insurance, which is Bima Sugam, Bima Vahak, and Bima Vistar. I think we need better execution, faster execution of all three initiatives that will probably aid in the awareness, affordability, and accessibility. The second is use of data. I think across life, health, motor, non-life, etc. I think if we can all put together a very robust ecosystem of data, I think we'll be able to underwrite better quality, and we'll be able to reduce the instance of fraudulent claims, which can all translate to better pricing and better insurance penetration in this country. So I would say data and triple B execution is what I would say are the critical levers going forward.
Saravir, finally, one suggestion coming in from the entity which does a great job at distribution, managing, of course, the regulations on both health and life side. What will be your suggestion?
I think, yes, we are the voice of the consumer. I think the voice of the consumer is very clear. Insurance is a very, very important part of social security in India, because I think consumers need it. They want simplicity. I think there has to be simplicity in terms of what is the contract, what am I paying for, and how much will I get when I need to make a claim. So I think whatever we can do, and I think it's not just on the regulator and the government. I would say that both the regulator and the government have done their part. And I think now it's incumbent upon the industry, participants, all of us, to make sure that we communicate this message very clearly, that look, this is what the industry is doing. These are the number of claims that are being paid out. These are the instances where things have not gone well, so that, again, there is full transparency on that. And I think the more we can simplify the product at heart is a very simple product. You pay premium, you will get a claim. But we have complicated it needlessly sometimes. And if we can simplify it, I think customers will buy this themselves. I think the era of insurance being sold should change to the insurance being bought. And I hope that it will happen very soon.
Well, very well said. The era of insurance sold should come to an end, and that should be replaced by insurance being bought. But on that very positive note, that's all we have as far as this special edition of the Policy Bazaar show is concerned. We will see you soon with a new topic, with a new set of guests. But until then, it's time to say goodbye and take good care of yourself. Stay safe, stay insured.
CNBC-TV18, the Policy Bazaar Insurance Show.
WhatsApp has a new challenger in India. Zoho's Aratai is climbing up the charts in India. It's now amongst the most downloaded apps in the country. The word Aratai in Tamil translates into chit-chat or casual talk. The app's traffic has soared over 100 times in the last few days, rising from over 3,000 sign-ups a day to more than 4 lakh per day. It's not just this messaging app. Zoho is throwing down the gauntlet to big tech companies with its product suite. Zoho has an office suite with over 50 products covering customer relationship, accounting, HR, document editing, presentation, and many more. This directly challenges global giants like Microsoft, Google, and Salesforce, among others. So what is working in favor of Zoho? The products are made in India and the company wants to be interoperable like the UPI. The company hosts its own data in India and is not dependent on global cloud service providers like Microsoft Azure or Amazon's AWS. But Zoho does face challenges as well. How will it overcome the network effects of global tech giants which have huge installed bases? Can it compete against Silicon Valley's scale and capital? And what about monetization and building a lucrative business model? To answer all of this and more, we're joined by the man behind Zoho, Sridhar Vembu, who's now the chief scientist. Sridhar Vembu, Aratai Arambika Lama.
Arambikala. Let's start.
Well, let's start, sir. You know, I want to talk about something that you've passionately believed in, and people may not realize it, but Zoho has been in existence for almost 3 decades now. You've often said that for more than 29 years, we've been bucking Silicon Valley trends. If I were to ask you today, Mr. Vembu, as you look back at the journey that Zoho has made, what have been some of your biggest contrarian bets so far?
Yeah, well, building Aratai would be a contrarian bet by itself. And building all of the email, the office suite, those are fairly big contrarian bets. And building out our rural development centers, starting in Tenkasi, where I live right now, that is a big contrarian bet. Our Zoho schools of learning, an alternative to college education, that's a contrarian bet. But all of these, I want to be clear, these were not made in the spirit that to be a contrarian. In fact, I'm a pretty conventional person in many ways, right? And so what is contrarian is really we are deriving these from first principles. Well, there's a lot of talent, rural talent. Let's go seek them. A lot of times college is not adding much value, so let's build alternatives. And we need all of these technologies to be built in India. Otherwise, we risk technology getting weaponized against us. That's why we need to build all of this technology, and that thinking then culminates in something like Aratai. So really, it's what is, if you go look back behind the curtain on why these seemingly contrarian bets are made, there's a very rational thought process behind it. That I want to emphasize.
Now, I get that, and I will build on that in just a second. But, you talked about wanting to make in India because you believe that technology is often weaponized, can be weaponized, is being weaponized. But, 2025, you're having if I can call it that, a breakout moment in India. You've got government ministers tweeting, saying that they're moving to Zoho, urging and nudging other citizens to move to Zoho as well. But does it surprise you that Zoho Mail, for instance, turned 15 in 2023? Zoho Office Suite, the upgraded version, was launched in 2018. Zoho Workplace was launched in 2017. And yet, we're now in 2025 when you're finally having this breakout moment in India. How do you explain that?
Yeah. So, first of all, the technology had to have been built in order for it to be adopted. And if you look at Zoho Mail, nearly 2 years ago, the government, the NIC, selected Zoho after a very long, arduous process of evaluation, a lot of audits, over 18 audits performed, and it was selected. And it is now already serving a fairly large number of users within the government, I believe about 1.5 million now, and growing. So this happened well before this current episode. Now, how did we arrive at this moment? It's basically I call it the Swadeshi awakening we are going through. And I've been part of the whole Swadeshi movement, Swadeshi technology movement for a while now. In fact, I am very proud to be associated with the Swadeshi Jagran Manch and Sri Sundaramji from Madurai. And I've actually had long conversations about the need for technology self-reliance in India. And that now message, I'm very happy to see this awakening happening. This is not only government. I want to emphasize this Swadeshi movement is happening across our private businesses, our educational institutions, our common citizens, right? Everywhere I see this. And the reason it's for that is, of course, the global landscape, which has changed fairly dramatically. And to be honest, some of us expected this global landscape shift because, I always felt the global trading system itself was built on a very, unsound foundation. And that was prone to collapse, and it's creating these conflicts. And those conflicts, once they emerged, we can see that on why we need the Swadeshi movement now. So I'm very happy to see the awakening happening right now.
Well, you talk about this Swadeshi awakening, Mr. Vembu, but I want to understand from you now that where does this now lead to? What do you believe the next steps will need to be? Because you're a firm believer in R&D. In your vocabulary, R&D has also come to mean rural development, which is a large part of the ethos at Zoho. But what do you believe the next steps will need to be, both as far as private enterprise are concerned, as well as the government in terms of policy to ensure that we build on this momentum of self-reliance, that we build on this momentum of creating Indian technology for India and for the world as well?
Yeah. If you look at today, technology has come to go on every aspect of our lives, be it in education, in healthcare, our daily interactions with our friends and family, all of it mediated through technology now. So technology is pervasive. It surrounds us. It envelops us. In fact, we are often in a cocoon of technology today. So it's important to ask who controls the technology. And that's the awakening that is happening, and social media to all of it, and the power they have over us. So we must gain that power back, both as nation and as individuals. That is the moment that is starting to happen now. So I do believe that with this awakening that's happening, what needs to happen now is we have to identify all of the critical technologies, and not just in software, not just in what we consider digital technology or AI, any of that, but even things like metallurgy, in material science, in drones, in robots. All of these technologies, we have to have a very strong investment going in. These are very long-range investments. We cannot produce any magical results. For example, fighter jet, that can be a 10, 15, 20-year project. But we need to have very strong investments going in, long-term investment. We have to assemble the teams, empower them, and then get out of their way. Give them the freedom to dream and invent and create. That's the approach we have taken. That approach actually works because we have the talent pool, we have the dreamers, we have the hardworking engineers and scientists. We have to put them to work in this nation.
Well, speaking about, investments, and I know that you've often believed that a lot more needs to be done to create a long-lasting R&D culture, because as you point out, Zoho was not built in a day, and many of these technologies that you speak of will not be built in a day either. Now, there has been, perhaps for reasons well known, lack of appetite, but also constraints as far as capital are concerned. Private enterprise has not invested as much in R&D as it ought to have. The government is now starting to invest in R&D as well. Where do you believe the challenge lies? How do we unlock the kind of R&D investments, the R&D spends that are required, that are necessary to meet the objectives that you just spoke of?
Yeah. So first of all, I want to say R&D by itself is not really hugely capital intensive. It is hugely brain intensive, but it's not capital intensive. It's time intensive in the sense that it can take 5-10 years to produce meaningful, commercially viable technologies that are, that can go win in the marketplace. And even to match the global competition, to even replicate the capabilities that other countries have, it takes time. It takes time. That's our message throughout. And it's not just the capital. We cannot say, hey, I'm willing to put $20 billion. Can we get all of these technologies right now? That's not possible because a lot of these technologies, they are not actually available at any price to purchase. They're a lot of them under export control, or a lot of them, other countries hoard them. So it's important for us to realize that other countries hoard these technologies. So our only option then, realistic option, is to go build the teams to do this. And it's not only an investment. And investment is important, but the more equally critical part is getting that R&D culture right. And the R&D culture, I'll describe it for you. When I'm sitting with engineers, my title, none of that matters. We are a group of engineers, we are trying to figure out a problem. And that is how most of the work happens in Zoho. All of the titles, all of these really don't matter at all. This is something new to a lot of companies, but it's essential to get R&D right. If you look at companies that do cutting edge work in any technology, you will see that they have this culture of this maker culture, this engineering culture, this figuring things out culture, that lack of that whole, formalized, very rigid hierarchies. All of that is important. So it's as much a cultural challenge as an investment challenge. That's something that I really repeatedly emphasize.
I think that's important that you point that out, that it's not just about capital or investment, it's also about creating a culture of recognizing talent, appreciating talent, and as you pointed out, getting out of the way. But let me ask you this in the context of the challenge that the Indian IT services sector is faced with. And it's not the first time that we've heard this question being asked, that what next now as far as the IT services model is concerned? Is it going to continue to be relevant, and so on and so forth? How do you see the problem today? How do you see the challenge that's facing the Indian IT services sector? Because this is a huge job generator for the country. It's also a huge forex earner for the country. What do you specifically see as the challenge and the way forward?
Yeah. So the challenge is, of course, all of these changes happening. And one increasing challenge is the productivity that is coming in the traditional kind of IT services work, the level of automation, driven in part by AI, but also by a rise of tooling, all of it, where maybe what used to take 6 months to do can be done in a month. That's a challenge because a lot of employment was riding on this. At the same time, we have an asset. We have a large number of people trained who know a lot of technologies, and we have to imaginatively use them for other purposes now. It's a reinvention required. So this is a time of reinvention. And our services companies also have another advantage. They do have fairly large pools of capital available to them. They have often fairly substantial cash hoards. They still have massive cash flows. And they have the human knowledge base, the people who can get this done. So what it requires is imaginative leadership that set people free, set up small teams to go after specific opportunities. I believe with the right vision, it can be done. I sincerely believe it can be done.
You know, this aspiration of India moving from a services nation to a product nation, that's an aspiration and ambition that you've spent the last 30 years trying to fulfill. Are we anywhere close to making that transition? Is it a next 5-year, 10-year transition? Do you believe we're at an inflection point today? How do you see this transition from services to product?
Yeah. So it's, tell you, it is at least a 10-15-year journey, but it is also, there is a kind of a backloading effect. So what I mean by that is, a lot of these you toil for long periods, seemingly without any magical things happening, then a lot of these compound. It's the nature of these exponentials, where it looks like an exponential, or you can think of it like a hockey stick, where in the beginning it seems slow, 3 years in, 5 years in, I don't see anything magical. And then these efforts compound, they build up on themselves. And then maybe the 12th year, 13th year, 15th year, you start seeing, oh, it's growing very rapidly. That is what we need. That's why we need to invest right now to reap the rewards in a decade or so from now. And I don't see any real shortcut there. Maybe we can license some technologies wherever it's available. We can license technologies, build on a foundation that's already erected. But still, we have to figure out all the technologies we license too. Just because somebody gives you all the technology doesn't mean you can just immediately build on it. We need experts who understand it, who completely grasp it, then we can improve on it. So all of that is needed, and that still takes time. So which is why I think the best time to start would have been 40, 50 years ago. The next best time is right now.
Well, you know, speaking about what you mentioned earlier, that this is the time to gain back power, and you talk about this Swadeshi awakening. You know, we've been an open market. We've allowed MNCs to come in. This is now not just their largest talent base, but also amongst their largest consumer bases, amongst their largest customer bases. So how do we balance this Swadeshi awakening with the fact that this is now an open market, trading with the world, allowing companies from the world to invest and set up shop in India? The China model, the China template clearly doesn't seem like an option for us any further.
Yeah. I don't believe this necessarily the China model for us. I believe we will remain an open market. I think we should. I do believe that. At the same time, we have to ensure that we have sufficient technological base here. We are sufficiently good in sufficient number of technologies that we can trade on equal terms with the world. And nobody can hold, weaponized technology against us. That's really the key. So that's why I distinguish between the word self-reliance, just to me trading on equal terms like that, versus self-sufficiency, where try to do it all ourselves, that we won't trade with the world. I don't think that is the correct model. Even China is a trading nation. They just close themselves off a little bit more than maybe what we can do realistically at this point. But I do think that we should be self-reliant in the sense of being able to trade on equal terms. In this, another important matter, for example, there is a global capability center, GCC boom in India.
Yeah.
We can require some useful regulations here, force all of the IP built up in these centers to be registered in India, and ensure that India does have the right to license these technologies or right to use these technologies without somebody else's export controls, all of it. This is an important point. There are times where an IP is built in India by Indian talent, Indian citizens residing in India, and yet some other nation gets to control whether India can consume the products from it. Can India buy those products? That is not acceptable. No, you're building it in India with Indian talent, with Indian citizens here. They should be subject to Indian law. Indian customers should have the right to buy those products. I think all of these have to be brought in legislation, and Indian taxes must be paid on that IP. There is today, you cannot allow the global capability centers to be treated only as cost centers, where they will simply send about the amount of money required to pay the salaries and nothing more. A part of the profit has to be booked in India and taxes paid in India. There must be regulations around all of this. Then we can benefit from all this trading, and we also can prevent technology built in India being weaponized against us.
Mr. Bimbu, it's an important point that you raised there, and you're right. We're seeing this boom as far as global capability centers are concerned, 1,800 or 2,000 at last count, if I remember correctly. The government is also now very keenly backing them. There was a mention of GCCs and a GCC framework, even as far as the budget is concerned. What you're saying, have you discussed this in any formal or informal fashion with the government? Is this the thinking within policymakers as well, as far as GCCs are concerned? And do you believe that if India were to go down the path that you're suggesting, which is to ensure that IP is retained in India, that there is tax paid here in India, that it would act as a deterrent to further investments in GCCs?
Yeah, this is always this question comes up, right? Will it be a deterrent? I tell you, GCs are coming because we have the massive talent pool here. No other nation, not even China, has the potential talent pool, the latent talent pool that we offer. No nation can match this scale today. So we must be more confident about ourselves. If we do this, maybe some companies, initially they'll always complain, right? Everybody wants it to, have it too easy, right? So they'll complain. But if we insist, they'll swallow hard and accept the terms. That's how all these negotiations work. But we must start insisting, and this is something that I've already started offering as a suggestion. GCCs must face a similar thing to Indian companies do, which is the IP is registered in India, and IP is available to Indian companies and Indian government, all of it. Third, taxes are paid in India. All of this we must try to ensure through regulation.
You said that you've offered this as a suggestion. Have you heard back from the government? Do they take your suggestion on board? Are they in agreement? Is there resonance for your suggestion within government?
These are all, ongoing conversations, right? These are not, this is obviously, it will take a while to achieve any kind of a consensus. Obviously, what the point you mentioned, would it be a deterrent? Would it stop the capability center GCC boom that's happening in India? I don't believe so. But I'm sure that people will argue I'm wrong on this. I'm happy to have the debate. So this has to be debated and settled. This is not something for me to decide, but I can only put forward a suggestion,
Well, I'm sure that this is going to certainly spark a debate, Mr. Vembu. I would imagine that a lot of people are going to weigh in on the point that you've raised, and perhaps we'll get to see reactions coming in and see which side or which direction the wind is blowing as far as this particular issue is concerned. But let me come back to Zoho now. And you said designations don't matter. But at the end of the day, you've moved on as CEO now. You are the chief scientist. What excites you today? Aratai, of course, is having its big breakout moment, as we just discussed. But what excites you today? What are you feeling most concerned about? And what would you prioritize as chief scientist today?
Yeah, I am working in code. I go to bed with code and I wake up with code. So I am about 70% of the time immersed in code. So all of this time I'm spending thinking about it. When I'm waiting in the airport, I'm thinking about something, I'm reading about something about code, all of that. So that's where I am 70% of the time on it. And I like spending time this way. Technology is the most vital, crucial thing we do. And we have still a lot more to do in Zoho. So that's what I'm focused on. And I do have reviews with the Aratai team almost every single day now, follow up. And we are actually rolling out all of those updates as we speak. So there's a lot more coming there. And so my own personal time is focused on building technology, mostly code.
And I think another debate that is currently underway is whether a company like Zoho should approach the public markets. Should it be a listed entity or not? I know your thoughts and your views on that, and you're not the only person who believes that staying private has its own benefits. But is this a philosophical issue? Is this an ideological issue, Mr. Vembu? Or would you at some point in time believe that perhaps that would be the right thing to do for Zoho?
Yeah, so this is also a philosophical point of view here. Even in America, recently, there was a suggestion that maybe they should not have quarter-to-quarter reporting, maybe only once in 6 months, right? And which tells you that even America is thinking about these problems, this very extreme short-termism by companies. Now, if you have to report every quarter, you are optimizing for that reporting, so your decisions inevitably get colored by it. Here, forget 6 months. Something like Aratai has taken 5, 6, 7 years to arrive here in terms of the product, and we still have ways to go. And we don't have any immediate revenue potential. Purely on a profit and loss next quarter or 3 quarters from now, it makes no sense. But as a nation, we need to invest in these technologies. So the public markets, even the VC investment, is not necessarily the best vehicle to support all this long-term technology development. People always will point to a Google or Microsoft and say this, but they forget that there's a lot of prior work happened before all of this came into public markets. Not just necessarily in those companies. There was R&D happening in Stanford. There's R&D happening in the broader ecosystem. Today we are having to do this within companies, a lot of it. And so staying private is what allows us to invest in these and not have to worry about daily stock fluctuations. As a practical matter, I've seen this in public companies in the US. this daily stock fluctuation becomes a matter of huge distraction for everyone. So I'm very glad that we are not dealing with that right now.
What's the next milestone then, Sridhar Vembu, as far as Zoho is concerned? You know, you're operating here in India, but again, many people may not realize that you operate across different geographies. You've got data centers in, I think, 19 locations at last count. Does the global ambition, the global aspiration remain as strong? And, you know, in terms of using your money, of course, to build your own capabilities, but to also nurture capabilities of other Indian developers, other Indian startups. Is that something that you would choose to do?
We are already doing it, ma'am. We have invested in at least about 10 deep tech companies in the last 4 or 5 years. All of them are busy developing the technologies. Some of them are known, like Signal Chip, and there are drones, and a lot of things are being built right now. All of them in the labs or prototype, or in some in early field trial stage. But they'll all, in due course, they'll mature and come out as products in the market. So we're doing our part there. And in terms of our own evolution, we are evolving in medical, med tech, in robotics, and all of these fields. We are investing, having heavy R&D investment. As I mentioned, R&D investment is not expensive, but it is time intensive. We cannot expect immediate returns. Those are the kinds of areas we are actually investing in right now.
You know, I know you're not a big believer in cryptos, or perhaps not a believer at all in cryptos. You continue to back gold. But what about AI, and why this non-believer attitude as far as cryptos are concerned?
Yeah. So, you know, ultimately we are looking for a secure, what is gold, right? It's a store of wealth, as I say. Traditionally, it's a store of wealth. If you have some surplus savings, you buy gold. To this day, most Indians, and particularly Indian women, that's what they do, and it's actually a good thing. I actually believe it's a good thing that it's a store of wealth. It sustains across decades and generations, and so that is our traditional store of wealth. Now let's apply that same principle to crypto. What is it? It's a string of bits. It's digital information. It's like a file that you have it in your phone or something, or securely in a server. What it is backed by is a global system of exchange where these bits are worth something. Okay? It really is conditional on the existence of that global the network, and can that network be stopped by some state actor or a non-state actor? All of these questions arise. If you have gold in your possession, you have gold. You know, you have it. You can use it, right? You can sell it. But I don't know about Bitcoin or any of these long term. So you really, these assets, long term store of wealth, can only be proved long term. I mean, here's a critical question. In 2050, 2100, would still Bitcoin be around? That's the question. And, you know, that can only be proved after maybe some of our lifetimes, maybe mine. But only after that does the proof actually arise. Having survived hundreds of years, then it can survive hundreds of years more. Gold has survived thousands of years.
What do you think?
That's why I am not a believer.
Will it still be around in 2050?
Well, the fact that I'm avoiding it tells you that I'm not very sure about this question, right?
Yes, that is very clear. But on AI, because again, that's, you know, since we're talking about debates, there is a debate on whether we're in a hype cycle at this point in time, whether we're likely to see any kind of a correction. The valuations, of course, completely mind-boggling. But what do you make of not just the valuations, but the value that AI is creating today and what it means over the next few years?
Yeah. First, objectively, there's a lot of what they call round tripping, very questionable financial maneuvers going in the world of AI, where, you know, one company funds another and that becomes revenue, and there's a lot of this round tripping going on right now. Okay, many people have posted about this, pointed this out, all of that. So these valuations, extreme valuations, are often supported on just the hope that all of this will work out. And we have seen that movie before, and it doesn't end well. In fact, independent of e-commerce was a bubble in 2000. We are all buying everything online today. But the companies that were in a bubble, most of them did not survive, except Amazon. Most of them did not survive. So that's why it's important to distinguish between the usefulness, the long-term usefulness and potential of a technology versus the immediate financial bubble. Financial bubbles don't last even if the underlying technology, whether it's fiber optics, whether it's e-commerce, all of these proved very beneficial. This call is being carried over fiber optic lines, so the technology works and it's useful today. But it doesn't mean all the tens of billions poured in 2000 got a meaningful return. It's exactly the same. For AI, the risk is that a lot of smaller models that you can run on your phone or your computer, they can get the job done as well as this big giant data center based AI. And then that raises also the other question of the energy impact of AI. Today, all these data centers require massive power stations, power plants, which, in India, we already, we are sufficient power we have today. But if we have to unleash all of these massive AI data centers, would we still have enough power? Can we build all of those power plants? So these are important questions. So that's why I am all for a energy efficient AI. But the current frenzy ignores all of these questions, simply pours money. Trillions of dollars, not just billions anymore. It's 10 to the power 12. So that's why I think I'm not very comfortable with the current boom. But I also am a believer in the long-term potential of this technology, particularly the technology that has applied, has brought to in an energy efficient way to your end devices, all of it.
Well, not very comfortable with the current boom and a lot of round tripping going on in AI. That's, again, an important point that you make there, and a point that is one of the global debates that is currently happening online and, of course, offline as well. But, Sridhar Vembu, let me end by asking you, as you look at the world today, there are geopolitical challenges, there's geopolitical uncertainty. One day we see export controls, the next day we see some deals being done and so on and so forth. As a technology entrepreneur today, what are you most worried about? What are you most concerned about? What would you ascribe as the biggest risk?
Yeah. So the biggest risk is that the global system of trade we have today has rested on very shaky foundations. That has been true for a long time. All the tensions you see, all the trade frictions actually came directly from it. In fact, you can trace it back to the global financial crisis, how it was supposedly resolved with all of the QE and all of the money printing, all of it. In fact, that is also why I prefer gold. I do not trust the global system of this monetary base that is being built over the last few decades. Now, coming to this, that is the biggest risk to the world. It's not from this trade policy or that. It is that the entire system is on a shaky foundation. And it's prone to, severe malfunction. And unfortunately, if this AI bubble collapses, the collateral damage it could inflict to the global trading system. Because a lot of America's GDP growth is now coming from AI investment. All these data centers and associated technologies. And if that investment boom the bubble hits its pin, that could have actually global repercussions. That's what I'm most worried about. It's really not just a technology risk, it's actually a financial risk.
Bubble? Do you believe that we're in the midst of an AI bubble today?
Definitely, I do believe that there is a very strong bubble element to it. As I repeat, very useful technologies could still be in a massive bubble. The bubble could burst and the technology development can continue long term. It happened in wireless, it happened in fiber optics, it happened in e-commerce. And similarly, AI could be useful in 15 years, 10 years, but still it could be a massive bubble today. Those two things are not mutually exclusive.
Yeah.
So, and if this AI bubble, current bubble, the financial bubble we are on, as opposed to technology development, if it bursts, it poses a risk to the global financial system itself, the trading system.
A quick update from you. Since the time that we've seen Minister Vaishnav, Home Minister Amit Shah and many others tweeting about it, we've of course seen that big surge as far as the Aratai numbers are concerned. But, have you seen a big up move on Zoho Mail, Work Suite, etc. as well?
Definitely. We are very grateful for their support, and and we are very proud to receive the support as Indians, patriotic Indians. We are very grateful that our government is recognizing this. We are definitely seeing an uptick, not just from government, from the private sector, from from non-profits, all around we are seeing an uptick. That's a surge in that whole Swadeshi sentiment around the nation.
Sridhar Vembu, many thanks for joining us. Appreciate your time here on the record. We wish you the very best of luck with your future plans. Thanks very much for today. With that, it is time for us to wrap up this edition of On the Record with me, Shireen Bhan. From all of us on the program, many thanks for watching.
Hello and welcome to Startup Street. I'm Ritu Singh and with me is Arundhati Ramanan. Here are the key headlines from the startup space. Wealth tech platform Deserve adds $40 million to its kitty. The Series C round was led by Premji Invest and Axel's Global Growth Fund, with participation from Elevation Capital and Z47. These will be used to enhance client experience, strengthen tech stack, and expand offerings.
CNBC-TV18 exclusive SpeakX bagged $16 million in a pre-Series B round led by Westbridge, Elevation and Goodwater Capital also participate. Will use the funds to power new regional language launches and make AI-led English learning accessible across India's heartland.
Chara Technologies raises 52 crore rupees in a Series A round that was led by Arkham Ventures with participation from Xfinity Ventures, Kalari Capital and IIMA Ventures. It plans to use the funds to expand manufacturing capacity and accelerate new product development.
Bengaluru-based Fintech Good Score bags $13 million. The Series A funding was led by Peak 15 Partners with participation from Stellaris Venture Partners and Saison Capital. The proceeds will be used to expand its AI systems, add product and engineering talent, and grow its credit marketplace that connects borrowers and lenders.
Cryptocurrencies rebound after witnessing the largest liquidation in history over the weekend. The industry saw liquidations to the tune of over $18 billion on the back of an escalation in US-China trade tensions. So those are the headlines we're tracking for you today. But our top story, wealth tech startup Deserve has raised 350 crore rupees in a Series C funding round, which brings its total capital raise to more than 850 crore rupees. This round was all primary. It was backed by its existing investors, Premji Invest and Axel's Global Growth Fund, with continued participation from Elevation Capital and Z47. Now, founded in 2021, Deserve already manages more than 14,000 crores in assets and says it has helped 5 lakh users track 2 lakh crores in personal wealth. Joining us now is Sandeep Jethwani, the co-founder of Deserve, to discuss this funding milestone, the growth strategy, and of course, the company's ambition to redefine wealth management for India's emerging class of wealth creators. Sandeep, welcome to the show and thanks so much for being here. Congratulations on this fundraise. Start by telling us what the key drivers behind this round were and how do you plan to deploy this fresh capital?
Thanks, Ritu, and great to see you again. Thank you for the congratulations. From our perspective, look, India's wealth creation story is just beginning. We are at 12 trillion of savings right now, likely to go to about 100 trillion in savings in the next 20 to 25 years. Hardworking wealth creators are creating significant wealth. We are expecting nearly 1 crore crore-patis in India. Now, to serve this particular emerging segment, I think that we have a responsibility to elevate our client experience. And how do we do that? One is to improve the technology experience, the UI, UX that these individuals face. So working heavily with the account aggregator ecosystem to be able to track net worth across the board. The second is how can we improve and develop our investment solutions, go deeper into newer asset classes and be able to serve these clients with complex wealth management problems. And the third is to strengthen our relationship manager base and be able to help our relationship managers serve a much larger client segment. So those are the areas, Ritu, that we are investing in.
Sandeep, 1 crore crore-patis, what will that mean in terms of business? You've crossed about 14,000 crores in assets that you manage. How sustainable is this pace of growth and what kind of client acquisition costs and retention metrics are telling you about scale efficiency?
Ritu, I think in our business, as trust develops, as clients begin to experience a better wealth management experience overall, they refer clients to us. So the cost of acquisition declines. But I think more importantly, they trust us with more of their capital. All of these individuals are people whose wallet size is also expanding. So I think it's a big responsibility and an opportunity for us to serve them well so that they stay with us. Currently, retention numbers are very, very strong. We believe that most of these clients are here with us for the long term, so long as we keep doing right by them, and that's the objective.
But what will this 14,000 crore number, Sandeep, look like, say, a year, 2 years down the line? What sort of internal targets are you working with?
Ritu, I think we should continue to double our assets under management on a yearly basis. I actually feel that even our existing clients, the behaviors that we are seeing as they are coming in and adding more to their portfolios at deserve. So that's a very clear trend line. We're also able to acquire clients at a much faster clip. So doubling every year, at least for the foreseeable future, should be possible.
All right, doubling every year on a relatively smaller base. But Sandeep, we keep hearing about this Bharat opportunity across corporates, across sectors. Even with investors, there's record growth, there's rising affluence you spoke of, beyond just the tier one, beyond metros. Where are you, though, seeing the strongest demand, across these? And are these young professionals? Are these business owners? Just give us some trends you see.
Ritu, I think it's a massive opportunity ahead of us. If you look at the tier one segment, there's opportunity to go deeper. Newer businesses, especially in the new economy category, are getting created. So we are seeing founders, CXOs, creating meaningful wealth. You're seeing a spate of these IPOs that are happening. So that's one. Secondly, even within tier one, we are seeing senior working professionals, CXOs, create meaningful wealth, even in sort of traditional businesses. So that's one part of it. On what you call Bharat or tier two, we are seeing a whole host of SMB owners create meaningful wealth. There's a massive formalization of economy that we are seeing. And as more of this formalizes, incrementally, a lot of this capital is flowing into financial assets. So I think there's a trend of greater formalization compounded by financialization, and that's really interesting for us right now.
Just quickly, last question, Sandeep. Reserve has spoken about transitioning into this full stack wealth manager. We want to understand beyond what you're already offering, what does this look like in practical terms for clients, and how close are you to achieving that vision?
Ritu, honestly, on that, it's early days, but I think we are being guided by our clients into areas where they need help from us. So obviously, there's the asset side where they want us to manage more of their portfolio, but there are also issues that they face around the loans that they have or the liabilities in their own balance sheets, and the needs around risk and protection, which is how do they secure themselves and their families. So I think these two categories, which is liabilities and risk and protection, are areas where we will deepen our offerings on.
All right, we'll wait to hear more on that, Sandeep. Thank you so much for your time here today, and congratulations again on your fundraise. Thank you.
Thank you for having me, Ritu.
On what's brewing, India's AI-powered edtech story is getting louder and more profitable. SpeakX.ai, the country's largest generative AI English-speaking platform, has just raised $16 million in a pre-Series B round led by Westbridge, Elevation and Goodwater Capital. The startup, already EBITDA positive, helps millions of Indians improve spoken English through AI-driven conversation. With over 200,000 paying subscribers and a $7.5 million ARR, SpeakX says this funding will power new regional language launches and make AI-led English learning accessible across India's heartland. Joining me now to discuss this further is Arpit Mittal, the founder and CEO of SpeakX. Arpit, thank you so much for taking time out and being here with us on Startup Street. Before we get to this fundraise, right, if you could sort of talk to us about what SpeakX does and, take us through your key offerings.
Sure. Hi, thank you for having me on the show. What we do at SpeakX, we help people improve their English communication skills. So as we know, a large part of India can actually operate in English, right? Even when we go to tier 2 towns and tier 3 towns, we see all these billboards written in English. It means that people can fundamentally read and comprehend English to some level. Now, the challenge was that they don't have enough confidence to speak properly, right? They have a fear that others will make fun of them. What if they make mistakes? So they generally avoid speaking in English. So what we do is we help them overcome this judgmental pressure from their peers and help them improve their English communication skills.
Congratulations on the fundraise, right? $16 million in a pre-Series B round. It's quite a strong vote of confidence for, your model. So what will be your top 3 priorities for this capital, especially when you're, how you plan to sort of disburse the funds?
Sure. I think primarily we are going to use the fund to build a stronger product. So learning anything is a multi-year process, right? It takes time for people to really master a skill. So what we are doing is we are creating stronger modes within the product, gamify the product, improve the AI experience, improve the latency, try and help our learners achieve their goals. Because how we look at it is we are a very strong impact product. So we help people transform their lives. So idea is that if we can utilize this capital wisely to improve the product experience, that is going to give us help us achieve our long-term goals.
Sure. And you've already achieved profitability, right? And you have a $7.5 million ARR currently. What's sort of driving this efficiency and sustainable growth at this point?
I believe that was a choice we made around 2 years back. We said that we'll use the capital to build the product, but we'll not use the capital to grow the product. So when we actually grew, we kept in mind that we need to be very cost efficient, and we did it from the very beginning, because to serve for the Indian market, that's what you require. Like you cannot ask dollar value from the Indian customers, right? It need to be in INR. And to do that, the systems need to be very cost efficient. So we are able to scale it up at a very cost efficient way that helped us drive profitability. And for us, the role model was Nikhil Kamath. Like we have seen in the past that even pure tech startups can practically scale with profitability, and that's exactly what we did in the last 18 months.
All right. And you know, SpeakX has over 200,000 paying users and 1 million monthly learners, right? So where is this demand coming from? Is it the metros, tier 2, 3 cities or beyond? So, and where do you want to focus all your attention going forward?
Sure. So primarily, these are people who come from middle class and lower middle class, right? Even someone coming from a metro city. So the background is they come from humble backgrounds who have a very high aspiration to learn English. So we have customers across from tier 1 to metros to tier 2, tier 3. The spread is across. Primarily, we have expanded in the Hindi-speaking belt right now. And going forward, we have already started expanding to other native languages like Tamil, Telugu, Malayalam, Kannada. So that's where the next 1 year is going to be for us to focus on.
All right, you know, that was actually going to be my next question, because 70% of your learners, you know, being Hindi speaking, how will sort of the regional language expansion, like you mentioned, into Tamil, Telugu, Marathi and others, sort of shape your next phase of growth?
Yes, so we believe India is a very large market for a product like us, right? We are relevant for every Indian. So practically, what we are now going to do is we have stabilized our engagement, we have stabilized our funnels, and we have achieved great unit economics. So the idea is to expand into different regional territories and grow the market, capture the market in those territories as well. So the capital that we have raised will help us expanding faster with profitability in place.
With profitability in place. And if you could quickly answer, you've set ambitious targets. You've got like 100 crore annual EBITDA and a 300 to 400 million business in 2 to 3 years, right? What sort of gives you that confidence that SpeakX can achieve this?
Sure. So I'll tell you, the product that we have built is relevant at a population level. So it's not a product for few, it's a product for all. So if you look at India as a market whole, so 40% of Indians actually have an aspiration to learn to speak English, and I'm primarily talking about young Indians, right? With that kind of a market, and this is a new market which has been created because of Gen AI. Because prior to Gen AI, it was practically not possible to teach people any spoken language for that matter using technology. So the only alternative was that a human need to teach that part. So we are targeting like 10 to 15% of India at a population level. And we being the first mover in the market have a clear edge, and we have spent last 1.5 years building a very strong product. So that gives us the confidence that we will be able to scale it in the next 2 years to more than 100 million, more than $200 million of revenue with 100 crores of top line EBITDA positive. Yeah.
All right, Arpit, thank you so much for taking time out and being here with us on Startup Street, and we wish you all the best going forward.
Thank you so much.
On that note, it is time for us to head into a short break. Coming up next, in a bid to empower over 75 ambitious startups across India, Kotak Mahindra Bank launches Season 2 of its flagship CSR initiative, the Kotak Biz Labs Accelerator Program. Details when we come back. Stay tuned.
Welcome back. You're tuned into Startup Street. Now, Kotak Mahindra Bank has just launched Season 2 of its flagship CSR initiative, which is the Kotak Biz Labs Accelerator Program, and it is aimed at empowering more than 75 startups across India, with partnerships spanning top incubators from IIT Delhi, IIM A Ventures, IIM Bangalore, T-Hub, and others. It promises deep mentorship, catalytic funding, and expanded reach into Tier 2 and Tier 3 cities as well. Joining us today to talk about this initiative are Rohit Bhasin, President and Head of Affluent NRI and Business Banking and Chief Marketing Officer at Kotak Mahindra Bank, and with him, Himanshu Nivsarkar, the Head of CSR and ESG at the bank. Also with me is my colleague Arundhati. Rohit, Himanshu, both of you, thank you so much for your time here. Rohit, let me start with you. In Season 1, we read that there were 1,500 or more applications and 32 startups ended up receiving the funding from Kotak. First, start by telling us, how the follow-on rate of these 32 ventures has been, how they performed, and the thinking behind now scaling it to more than 75 this time.
Thanks, Chitu, for having us here today. So look, when we started Kotak Biz Labs Season 1, we just realized the real problems, three fundamental problems that we saw in the startup ecosystem in India. The first one was that 90% of the startups fail to survive beyond the year 5, and they don't really get access to strategic mentorship, markets and funding. The second thing we saw was there's a gap in the ecosystem, that the early revenue startups don't really make up to the product market fit, and they don't have access to quality acceleration platforms. The third key insight for us was that startups are not just a privy of the metros, but there's a huge hunger and drive and desire in startups in the Tier 2 and Tier 3 cities as well. What they just want is the platform. And that really made us, start Kotak Biz Labs in the first season. The three things that we are providing is access to funding, mentoring, and networking. And we worked with, quality accelerator platforms from IIM A Ventures, NSRCL from IIM Bangalore and T-Hub. And we've, as you said, we've kind of got 55 plus startups who've got selected as a part of the first season. So we're very excited with the results which we've got in the first season. It's very early because we just started the first season at the beginning of the year. It's just been over 6 months. But we're very happy with the initial results that we're seeing the startups trying to build sustainable businesses.
Sure. Himanshu, let me bring you into the conversation. If you could sort of tell us what the key learnings from the first phase that you've learned that you've applied to Season 2's design and strategy, especially, when it comes to closing the gap in how early revenue startups are supported in India right now.
So a couple of things. I think one, we sort of expanded our presence in the Tier 2, Tier 3. So this year we are planning to do more in Tier 2, Tier 3. So that's one expansion of the footprint which is happening, which is a clear important one. The other thing was we started out working with 3 different incubators. Each had their own way of running the program. While we have not interfered with that, we have harmonized it so that a company which is sort of working with, let's say, in Bangalore with NSRCL has a similar sort of an experience as a company which may be working with IIM Ahmedabad, IIM A Ventures in Ahmedabad. So we have tried to harmonize the areas, and that's represented in the way we have gone about shortlisting the companies, the way we would go about funding these companies. So there's a lot more harmonization that has happened.
Well, Rohit, let me get back to what we were talking about in terms of 1,500 applications, but 32 funded. Of course, we know you have a process, but we're talking about a 2% success rate for these companies. What happens to the rest? Do they get lost in the process, or is there a way you're capturing the learnings or follow-ups beyond the winner circle?
So there is a light touch model as well as a more deeper model where we taken a few of the startups and taken them all the way. So about 800 plus startups were given mentorship, guidance to our network from our 3 incubators that we worked with, wherein they engaged with them on a lighter touch model. And they still have access to the startups ecosystem, the incubators ecosystem that we have. The 55 startups which are selected and taken to the final stage are the one which will have a much deeper integration in terms of helping them run through the whole process and finally giving them access to funding and networking in the markets. But we have provided guidance to the 800 startups who don't make it to the next round, but still have access to the guidance of these incubator platforms.
Sure. And, Himanshu, we're running out of time, but if you could quickly tell us, we understand, Kotak's focus is on Tier 2 and Tier 3 cities, right? So how is the program structured to identify and nurture innovation emerging from these sort of less visible ecosystems? Founders in those regions often cite lack of access to serious investors. So how will BizLabs connect them to actual capital and not just mentorship or workshops?
So right from the selection of the incubators, we've chosen entities which have a similar philosophy, which is basically to take the incubation to Tier 2 and Tier 3 cities. We are doing a lot of road shows in these smaller cities where we will spread awareness about BizLabs, and we will continue to engage. So it's not just that, at the beginning of the program, you do some road shows and then you forget about it. We will continue to engage with these city-based network over a full year. So that way we will be able to get a much deeper sort of an engagement in these cities.
Rohit, finally, traditionally banks have been risk-averse institutions, and how does Kotak reconcile the DNA with supporting these what you call audacious founders who may not fit conventional business models?
To our fundamental belief, which is our brand promise of "Hausla hai to ho jayega," is that doesn't matter if you're the son of the richest businessman in this country or the son of a chai wala wanting to start your own business. As long as you have an audacious dream, you have the aspiration, you believe that you can make something about your life, you want to be the partner that backs you into empowering you to achieve those dreams. That's our fundamental belief, which is our brand proposition. And we really think this is about bringing our brand purpose to life, making it the heart of our business model. Our purpose has to be about financial empowerment for all. Skewed financial growth is not going to work in the country, and we really want to make sure that anyone who has a dream, we can be the backing or the partner or the harness in helping you achieve those dreams. That's really what our objective is and our purpose in life is.
Well, that's nice to hear, but we're out of time. Rohit and Himanshu, we wish you the best with Season 2, and it's been a pleasure having you here. Thanks for your time.
Thank you. Thank you.
And with that, it is a wrap on this edition of Startup Street. More news and updates coming up on the other side. Stay tuned.
Presented by Policy Bazaar.
CNBC-TV18, the Policy Bazaar Insurance Show.
Imagine saving thousands of rupees every year on your insurance premium, and that without even changing your policy or reducing your coverage. That's the power that a tax component on insurance could bring. Specifically this time around, the GST component as far as insurance is concerned. Welcome to the Policy Bazaar Insurance Show. I'm your host Yash Jain, and in this episode we explore how GST relief can take away a lot of burden away from policyholders across India. And to break this down further, joining me on the show today are Sharad Mathur, Managing Director and CEO at Universal Sompo General Insurance Company, Mahesh Balasubramaniam, MD and CEO, Kotak Life Insurance, Saravir Singh, Joint Group CEO, PB Fintech. So we have a blend of the entire insurance ecosystem, of course, the distributor, life insurance company, as well as the general insurance company, which gives a fair bit of understanding as far as health insurance is concerned. Let's start with you, Sharad. What exactly was the government's announcement as far as GST on health insurance is concerned? Could you break down that for our viewers just to understand the basics and clear out the foundation for it?
The industry has been asking for it since quite some time, and it's a very welcome move. The whole concept revolves around customer affordability. And when government announced GST, we have been hearing that whether benefit would be passed on to customers or not. So in no way insurance industry, whether it is non-life insurance or life insurance or standalone health insurers, ever thought to have it in pricing adjustments. So it is for the customers, for the common man, and this would going to get passed to them. As a result, say if there was a 100 rupee premium, for example, so policy now would be reduced by 18%, say in case of individual health, PA, and accidental and travel insurance. So it would help us in achieving our end objective, which is insurance inclusion, reaching out to the last mile. We have seen that there are various government schemes for underprivileged communities and for affluent population, which are in urban, semi-urban state capitals. We have seen that affordability is not much of an issue and they are able to buy health insurance, so to say. But the middle group, we call them missing middle, I think affordability was one of the elements where we were seeing that there is not enough offtake willingly also. So now we have to work, industry would be collectively working on the reachability element. Affordability seems to be getting addressed with this GST got implemented on 22nd September. So it is a great benefit for the common man and would have insurance inclusion. And I think sooner, why we should await until 2047 as the government and regulatory goals are.
To you, Saravir, there cuts have been announced as far as GST is concerned on various aspects, and you deal with all those products: health insurance, term life insurance, ULIP, as well as endowment and annuity. In your understanding, how would these different categories benefit different kinds of users? What is the adaptability of these different products? Do you think that the benefits would be quite equally distributed amongst all these important products?
I think, yes, first, just to reiterate, I think what has been announced is that all individual life and health policies, there will be no GST, which means that for term and health insurance, there is an 18% reduction in the total outgo from a customer's perspective. In ULIP and endowment products, it's a little different. In ULIPs, the amounts involved are smaller and they are part of the product construct as well. In endowment and non-par policies, there's a 4.5% GST in the first year and 2.25 in the succeeding years. So that will be removed. So I think that is the context in terms of how much a customer will benefit. From our perspective, I think the most important thing is that protection products, right, which from a middle class perspective are the most important. I think for a middle class family, having term insurance, having health insurance are very, very critical. And both these products will enjoy the highest benefit of 18%. So what we expect is that, and in fact, what the early days are showing also, is that on the protection side, both term and health insurance, there is a very smart pickup in demand in September towards the end of the month. And this is something which we hope will continue going forward because I think this has been a long-standing demand of the industry, of consumers as well, that on such basic necessities of life, we should not have GST. So I think it's a really very, very big monumental move that the government has done. And I must tell you that even amongst countries around the world, this is one of a very, very, I would say, forward-looking step where a country has recognized that these basic forms of insurance are essential and should not be charged GST.
Very fair point. This has been a demand from the industry that GST shouldn't be so high as far as the basic necessity like insurance is concerned. But to come to you, Mahesh, we often have this discussion, but more often than not, it remains inconclusive. Was a tax cut or a GST cut in this situation the only trigger as far as making insurance affordable is concerned? Or are there more elements to it which will have to be, pushed together to make insurance affordable? We speak about the penetration, of course, that is very low as per global average. But do you think only making, a lower tax or exempt tax on insurance, the single solution to drive affordability and hence penetration?
First of all, as an industry, we laud the Prime Minister, the Finance Minister, and the GST Council for exempting individual life insurance products from GST. I think it's a landmark initiative, and it'll go a long way in increasing penetration in this country. Life insurance penetration is a paltry 2.8% of GDP. But what's more worrying, as Saravir pointed out, is a protection gap. Because real insurance is basically the term insurance that people take. The protection gap is as high as 80%, valued at about $16.5 trillion. The retail sum assured as a percentage of GDP, which is reflective of the extent of protection in the country, is less than 25%. Even neighboring countries in Southeast Asia are close to 100%. So obviously there's a long way to go. And there's a very significant step in that direction. But is that the only reason why the penetration was low? Obviously, the answer is no. And that is where the industry has been working towards building what we call now the AAA of insurance: awareness, accessibility, and affordability. This addresses the affordability portion. The accessibility and awareness is being worked on by the industry. If you see, I think across both LI and GI, a slew of campaigns have been going on from the LI Council and the GI Council in the last 1 or 2 months, where we are trying to make the awareness of insurance significantly go up. And accessibility, of course, through increased distribution network, increased online presence, etc. So all channels are being activated for increasing the accessibility as well. But AAA is what is required: awareness, affordability, and accessibility.
Okay. Sharad, to come to you, help us understand a GST exempt from earlier 18% with no input tax credit benefit, no inverted duty structure benefit. How does that impact the industry's revenue, profitability, financials as a whole?
What is coming out very clearly that the impact currently, commercial impact, would hover around 3 to 4%, which I do not think is so substantial as opposed to the upside, which is it would result into increasing penetration on population base that currently we still have about 35% population of on a base of 1.40 billion population, which has some or the other form of health insurance. So I believe if this results into solid uptick in gross revenues, premiums for the insurance companies. So the downside, which is loss of 3 to 4%, which would be charged to the revenue input tax credit, which insurers are not able to claim now, going to fizzle out. So we are not seeing this transactional element as impact on the insurance sector, but the strategic upside, which is increase in revenue and enabling insurance sector to support in increasing the contribution to nation's GDP. We have at an industry level rolled out campaigns, and as individual insurers also we are doing a lot of promotion and creating awareness around. So this thing would going to uphold our initiatives which revolve around transactional as well as strategic as we go and bring the entire nation into social security ambit. Health insurance, life insurance are something in the most developed market. If I talk about health insurance, in Australia, for example, we have 70-80% population having health insurance. Or in not so, or say, developing markets like Vietnam, also about 60-70 population has health insurance. So I think those are the things which we have started incorporating in our scenarios, and we are making 3 to 5 year projections and how we will use this, leverage this benefit which government has been kind enough to roll out for the common man, to make sure that now common man finds it easy to have coverage under health insurance.
Mahesh, just to follow up on what you said, given that from September 22nd, insurers won't be receiving any GST. So what happens, to the input tax credit that they were using so far? Will it be borne by the policyholders? If so, what could be the net benefit that policyholders might get as far as the GST changes and everything that it brings together with itself is concerned?
So there are input tax implications, I think, for the life insurance industry, and all of us have been doing our workings, and as an industry, we have understood the impact on the input tax credit, right? But right now, I think we need to look at the bigger picture. I think all of us unilaterally as an industry participants have all passed on the benefit of the prices to our customers, both on the fresh policies and the renewal policies. I think the big picture is we all need to support this initiative of the government in terms of increasing awareness and protection in this country. Along the way, I think some of these issues will be taken up. The industry is in dialogue with all its constituent stakeholders, and I think appropriate solutions will be found over a period of time. But right now, I think the most important thing is to make sure that the communication that now insurance is GST free is something that we need to communicate to the broader spectrum of the society. and the price benefits have all been passed on to all the customers across the board.
Saravir, let me come to you and let me bring you a very specific scenario. Just to understand, suppose a policyholder buys a long-term policy, say a 5-year plan. This, let's say, assuming was bought in May 2025. Now, if GST relief is announced, which becomes effective September 22nd, how will the tax on that particular product be calculated? Will GST apply on a pro rata basis for the period from May to September, or will it be charged on the entire first year upfront? How would the math behind this in a situation of a long-term policy be applicable?
I think the fact of the matter is that it all depends on how you're paying for the policy. If you've already paid an annual premium, then for the first year, you've already paid GST, and that is over and done with. If you are paying with on a monthly or quarterly basis, as your payments come due, at that moment, post September 22nd, no more GST will be charged. So just as an example, supposing you pay every month, so when your installment for October will come due, let's say it's on the 5th of every month, on 5th October, you will not have to pay GST. So it's fairly straightforward. Till September 21st, there was GST. After September 21st, there is no more GST, and all payments will not include any of the GST charge.
Thank you so much, Saravir. But on that note, let's take a very short break. We continue the discussion on the other side of this very short break. A few more important clarifications, a few more points of understanding lined up on the other side of this break.
CNBC-TV18, the Policy Bazaar Insurance Show. CNBC-TV18, the Policy Bazaar Insurance Show.
Welcome back to the Policy Bazaar Insurance Show. And, on this particular episode, we are exploring the most important development that would have happened in the insurance sector, the changes with respect to GST, the relief which those changes bring as far as policyholders across the country are concerned. Sharad, let me start the second segment with you. Also, and just to understand this thing better, if a policy had to be renewed, let's say before September 22nd, which is before the GST changes became applicable, and the policyholder did not renew it using the grace period for renewal, let's say he postpones the renewal by a month, will they be able to avail the GST relief in that situation?
Yeah, so if policy start date is beyond 22nd September, so then they will going to get the GST benefit. And there are quite a few cases we have seen that people had put their renewal on hold, and we supported them, and they got renewed very recently in the current week, and they got GST benefit. Because it's very simple, any policy being issued, renewal on 22nd September and beyond 22nd September, so they will be eligible for GST benefit.
Okay. Saravi, to you, what happens, to group policies purchased by, let's say, a particular corporate for its employees? Will the GST benefit automatically flow through into those individual members also? Or does that remain out of the ambit as far as the GST exempt category is concerned?
Yes, so the rule is very, very clear. It is only for individual policies bought by individuals where this rule applies. For group policies, whether, there are various kinds of group policies, including the health example that you gave. In that case, the GST will continue as it is at 18%. So I think, that there should be absolute clarity on this. It's for individual life and health policies. Group policies continue as they were earlier.
Mahesh, to come to you, do you see insurers using GST reduction as an important opportunity to rather innovate with low-ticket mass market products, or will the savings simply make the existing insurance policies cheaper? Which way do you see insurers going largely?
Well, I see dual impact, Ayash. First and foremost, India is both an uninsured country and an underinsured country, right? The way I see it is that an 18% reduction can translate in two ways. It can bring in new people who are hitherto not insured to the fold of insurance because they'll find it cheaper. The existing customers can upgrade their cover now because India is also a large underinsured country, right? So both the phenomenon, I see that certainly playing out. But having said that, I think the mass market innovations continue. I think even before the GST era, I think many of us experimented with mass market innovations, sachet-sized products, etc. There, I think the environment needs to be a little bit strengthened in terms of the data flowing through. I think the biggest problem insurers face when they try to do mass market policies is the element of frauds which creep in. Because these are masked underwritten policies where it's pre-underwritten, etc. So therefore, it's light on underwriting, which also means that it exposes the risk for the insurers. So I think these experiments continue, innovations will continue. In fact, last 3-4 years have been a great period for life insurance industry. And Sarbvir will corroborate that because he also sells most of these products on the platform, whether it is annuity, whether it is return of premium on term, whether it is ULIP blended with term insurance. I think a lot of innovations are happening. And this will only probably hasten the innovations because affordability goes up, which means any product we put out there, we'll be able to address a larger population than what we did in the past. No? So I think it's a continuous exercise, and this is only going to energize the innovation stream. Having said that, I think all of us continue to innovate across the various platforms available in the life insurance industry.
With that, we've almost come to the end of this discussion. But